But they trimmed about 13% of their holdings in the first quarter. That's more than $20 billion. We don't know the sales price, or it's around $20 billion, I should say. We don't know the price they sold, but it's some big numbers. We're going to run through those numbers. And I just finished talking to Tim Cook about it. He did know that this was coming. He talked to Warren about it yesterday, Warren Buffett. He said that they had a long conversation with it. He pointed out that they're still a very large shareholder, their largest.
More than 5%.
And that Apple is still by far Berkshire's largest holding.
That's right.
He said he feels good about it, and he says it is a privilege to have them as a shareholder. So that's the comment from Tim Cook coming off of this. He knew this was coming, already had spoken to Warren about it, and said that this is a privilege to have Berkshire as a shareholder.
Yeah, and it remains so. It's still about 40% of Berkshire's portfolio is in Apple shares. About 115 million shares, it seems, were sold in the course of the quarter. And of course, we were talking all day yesterday about this pop in Apple shares on its results, on its new buyback program. And all day we were trying to calculate what the Berkshire gain from the Apple shares were. And of course, it's a little bit less than that, but it's worth noting since the end of March, when this holding, we now have the updated holdings for Berkshire Hathaway, the stock is up. I did note that in the first quarter, Berkshire's net sales approximated Apple's share buybacks over the quarter.
Oh,
so I was also saying yesterday, hey, Apple's buying back stock from everybody else, but Berkshire raising their stake. Not quite the case, but again, Apple still seems more than 40% of Berkshire holdings, and Berkshire's
Berkshire
more than 5%
portfolio.
Apple.
This is a massive portfolio. But Apple makes up the vast bulk of that portfolio and still does after these sales.
And it was up big last year, Apple shares.
Yes.
So the way to think about it is if it's dollar value, it got pretty big. But we'll be interested to hear perhaps if Warren is asked.
Yeah.
And if he says much about it.
Yeah, I mean, it's just a very interesting news. And again, it's the news that we've been digging through for the last hour since this filing came out. I mean, there's a lot more to look at in those
Plenty more to look at. The operating
Yeah.
results were actually good, pretty good growth in the insurance earnings and things like that.
And I think Berkshire Hathaway Energy showed some improvement, too, in the operating numbers.
Had come back,
So it's very interesting.
Also, the cash holdings at Berkshire up close to 190 billion, so up, I think, about 20 billion in the quarter.
And that's a big stash of cash. What do you do with that? And that's been a big question for Berkshire for a while. That cash hoard just keeps getting bigger.
Warren likes to talk about how they are perhaps the single biggest buyer of Treasury bills.
That's right.
And they own a ton.
And you can actually point to one person in the office who makes all of those purchases, because the home office here is only about 24 people at headquarters. Small number of people who do all of these things, including putting out these the 10Q that we've been pouring through this morning. On the earnings level, it looks like, it was a much smaller earnings number from the quarter ago, but that was because of investment gains that were much bigger a year ago in that quarter.
Yeah, they have to mark their portfolio to market.
They complain about that all the time.
Sell it. It's just on paper.
Right, which is why they look at operating earnings. Operating earnings were actually up 11.2 billion from 8.06 billion. In the year-ago quarter. And they bought back a lot of shares, too, something like $2.6 billion in Berkshire share buybacks.
It's a decent pace, so $10 billion. I mean, again, Berkshire's over $800 billion market cap now, so it's kind of tough to make a huge dent in that capital base. But for sure, I think we have Steve Kovac, our tech correspondent, to talk a little bit about Apple and Berkshire kind of lightening up. Steve. So, as I said, we spent all day yesterday talking about Apple's financial engineering and the fact that they're sharing all this cash with shareholders. And here you have a little bit of a trim, a profit-taking move, I would say, by Warren Buffett.
Yeah, and this could also, Mike, kind of attribute to some of the slump that we've seen in Apple shares all quarter, or the first quarter of the year, rather, underperforming those big tech peers that we've just seen get such a huge lift off of artificial intelligence promises and the like. With Apple, it's been such a different story for the first 3 months of the year. First of all, no artificial intelligence story to tell in the sense of generative AI that's really captured everyone's imagination. Of course, I was with Tim Cook just a couple of days ago when they reported earnings, and he was telling me about the anticipated artificial intelligence announcement that they're going to have next month at the Worldwide Developers Conference, or at least that's when we presume it's going to happen. But it's also been these iPhone sales that have been a real drag on the company. iPhone sales were down 10% for the quarter. Now, Apple says that's a one-off thing, that there's some kind of COVID production wonkiness that happened at the end of 2022 that caused some people to start buying at a different time and so on and so forth. But he also told me that China is improving and that China sales, iPhone sales, that is, in mainland China, not greater China, but mainland China, actually grew in the quarter. That kind of counters this narrative that we had been hearing all quarter long, that sales were just kind of falling off a cliff and it was like an iPhone apocalypse out there in China. That did not materialize. In fact, quarter over quarter, the China business is improving, and Cook told me that he's quite optimistic about China in the long term still, despite this short-term bump that we're seeing. And then, of course, the question is, how much of that decline that we've seen in Apple shares was from these Berkshire sales throughout the quarter as well, guys?
Yeah, obviously a significant, bit of selling pressure, although I would say Apple's a vast company, and, you can, one thing I believe that Berkshire probably tries to do is be smart about how they're, lightening up their positions. But you're right, it does reflect the fact that people, in general, investors seem like Apple stock up a lot last year. The growth outlook may be a little bit more muddled. Although I would say, Steve, that the rationale initially, and as Warren has explained it over the years, is that he considers it a branded consumer staples company in a sense. Slow and steady, huge installed base. The services business looks great. People don't get rid of their iPhones. Yeah,
and it's the moat too. And our Kif Lessing on CNBC.com kind of wrote about this theme, that moat might not be as strong as it used to be. We are seeing so many regulatory challenges across the world, especially in Europe, kind of forcing Apple to open up its ecosystem to allow more competitors in. That's a moat breakdown and could potentially give people to stop buying iPhones if it plays out the way the EU would probably like it. And then not to mention the Department of Justice antitrust case that was filed this spring against Apple as well, covering a lot of those same issues. And then on top of that, there's the DOJ antitrust case against Google, which in a weird way impacts Apple because Google pays Apple up to $20 billion. That's part of services revenue to be that default search engine. So that's another thing. But look, also on this earnings, you got to kind of wonder if there's a one-off thing or what, but this is like a slump buster earnings after, so much negative story around Apple this entire first few months of the year. There's a more positive story, at least on this earnings call, not just the buyback, but also a return to growth coming in the June quarter. That's what they guided to. And then also teasing up this big artificial intelligence announcement coming next month, guys.
Yeah, and Steve, if you talk to the Verizons and the AT&T specifically said that they saw a slowdown in sales of smartphones, not just for Apple, also Samsung, but they attributed it really more. I spoke with the CFO at the time of AT&T. He attributed it more to just the idea that these phones last a lot longer. The new phones didn't really have things that made people decide they had to go out and get new ones. It was the same story when we spoke to Irv Blumkin earlier this weekend. He's the CEO of Nebraska Furniture Mart, and he said, yeah, they saw a slowdown too in sales of smartphones, but I wouldn't write that off as being the idea of Apple losing any of its really great holding power with people who have those phones and are in the ecosystem. That would be the one thing. Maybe it's slowed down, but as these earnings showed, it wasn't that big of a deal. Just for the short term.
And it's under threat for sure. And then Verizon told the same story. We had Hans Vestberg on after his earnings. Yeah. He was on your show saying a very similar thing. Just, they need innovative devices to get people to upgrade, every 2 years instead of every 3 to 5 years. That is a big thing. So that is why there's enormous pressure, not just on this artificial intelligence announcement for Apple, but also in the fall to do something new with the iPhone 16, perhaps on the AI front, that will convince people to upgrade maybe sooner than they normally would, Becky.
You just keep giving me a better phone and I'm in. I get a better camera for your phone and I'm in. That's all that I really want these things for. All right, Steve, thank you.
Thanks,
good to talk to you. Folks, right now, we want to give you a look at the day's schedule. The morning question and answer period kicks off at 10:15 a.m. Eastern Time. It's going to end around 1 p.m. Eastern, and that's when we will join you once again right here to break down everything that we heard in that first session. Once Warren and company recharge, that afternoon session will start. That should be right around 2 p.m. Eastern Time, and it's going to run for another 2 hours. Then we'll wrap up the day with a post-meeting analysis. That lasts until 4:30 p.m. Eastern Time.
All right, well, we did just discuss Buffett reducing his Apple stake. Joining us now to discuss is veteran Berkshire meeting attendee and value investor John Rogers. John, of course, Ariel Investments Chairman and co-CEO. John, great to see you this morning.
Great to be here.
Just your quick first impression on the change in the Apple position, how it fits into what you're expecting in general out of Buffett this year.
Well, we all know Warren's a very much of a long-term investor, is always thinking long-term, but every once in a while he gets an idea that maybe the market's a little expensive. And I think we've had a long time without a recession. You're starting to see some consumer stocks having disappointing earnings. So maybe he's getting out ahead of that a little bit.
Do you see it as a little more of a portfolio manicuring to a degree as well? I mean, he had over 40% of the public securities portfolio was in one stock. I don't know. He seems willing to sort of hold things forever, even as they get big, but might have played into it.
Well, also, I would think the concerns around China and what's happening there. You know, Tim Cook is a terrific CEO, but he can't control the geopolitical challenges that we're facing. And I know Warren's had some concerns about Chinese exposure, so that could be a part of it also.
You know, you mentioned, once in a while the market gets expensive. I wonder what your view is of Berkshire shares themselves at this level. It's like 1.5 times book value, sort of the upper end of a 15-year range or something like that. They bought back some in the quarter, maybe not a ton. What's your current take if you were talking about initiating or adding to a position of Berkshire?
I tell people all the time, just get started. You know, it's like one of the best investments of all time. So there's never a bad time to buy Berkshire. But I think also at this time, maybe it is a little bit in the high end, so maybe you wouldn't go all in. You just do dollar cost averaging in building your position.
How long have you been a shareholder, and how long have you been coming here, John?
I've been coming here over 20 years, and I've been a shareholder over 20 years. I really wished I had started 40 years ago, and I keep kicking myself. It's how could I have missed that?
When you look at what you've learned over time, I mean, Charlie Munger isn't here this year. This is the first meeting. He's not going to be part of that. But coming here every year, you tend to hear a lot of the same messages, both from Charlie Munger and from Warren Buffett. But they both are people, or even Charlie was a person, who would kind of question his own knowledge, question his own biases on a constant basis. And so if you've been coming for a long time, you tend to hear things that change over time, too. And I just wonder if there's anything that's kind of stood out to you or any lesson you've taken away that made you challenge your own implied biases and the things that you thought you knew were absolute truths.
I think one of the things that it's just been reinforced over and over again, the importance of always just thinking long term, that you don't have to worry about the headlines, what's happening with interest rates today or inflation rates or what's happening with the pandemic. Eventually, as he always says, a capitalist democracy is the best system ever invented. And just realize we're going to get back on track and things will be great. So I've had those values reinforced. Also the reinforcement of staying within your circle of competence. Invest in what you know and understand. Don't stretch outside of what you really know really well. And then you can interpret whether the moat is strong enough to keep that company strong.
Okay, what do you think about Paramount shares with that as the perspective? Because there's a bid that's come in. They were in an exclusive bargaining period. Now you've got the second bid from Apollo and Sony that comes in. As a shareholder, which bid do you think is the better offer? Which one would you like to see them take?
Oh, for sure. It's not even a close call. The Sony Apollo deal is the best. World-class international media company with a world-class private equity firm. All kinds of great leadership there. So it's not even a close call. We're really rooting for them and hoping that the independent board members do the right thing. I have a lot of confidence in them, and I think they're looking at this the right way now.
And if they don't do the right thing, what will you do?
Well, we will continue to challenge it. We have, been public with our perspective and concerns. We've written a letter to the shareholders. Of course, we've been talking and looking at all of our legal options because we've been told over and over again that the B shareholders will be treated fairly. And we've taken people at their word.
John, I want to thank you very much for joining us today.
Great to be here.
Great to see you. All right, right now, we want to take you to this year's annual meeting for the first time ever. The Berkshire Hathaway movie will be shown right here on air and online. It's long been only shown in the arena, so only the people there get to see it. It's a compilation of Buffett skits, advertisements from holding companies, and Buffett interviews. Now, the Berkshire Hathaway movie and annual meeting. So, Charlie, you were born on the first day of 1924. You have seen a century of history. Do you ever stop?
Not only that, I lived in the aftermath of a previous century of history. You could argue that about 90% of the progress of man has happened in civilization has occurred in the last 2 centuries. There was no car. There was no broadcasting. It was a very different world. We figured out so very, very much that was quite important as a start. And of course, that's what brought the economic system up, so man had enough leisure, had enough time to think. That's pretty much all of modern biology, modern medicine, and modern industrial civilization. Just imagine what the world would be like.
It's extraordinary how resistant some people are to learning anything.
Competency is a relative concept. And what a lot of us need, including the one speaking, is what I needed to get ahead was to compete against idiots. And luckily, there's a large supply. And everybody wants fiscal virtue, but not quite yet. They're like that guy who felt that way about sex. He was willing to give it up, but not quite yet. Yeah, I think you would understand any presentation using the word EBITDA. If every time you saw that word, you just substituted the phrase bullshit earnings.
I knew he'd do it sooner or later, folks.
I like cryptocurrencies a lot less than you do. And so, to me, it's just dementia. And I think the people who are professional traders that go into trading cryptocurrencies, it's just disgusting. It's like somebody else is trading turds and you decide I can't be left out. But those of you who are about to enter business school or who are there, I recommend you learn to do it our way, but at least until you're out of school, you have to pretend to do it their way. Accounting, you can do things like they do in Italy when they have trouble with the mail. You know, it piles up and irritates the postal employees. They just throw away a few carloads and then everything flows smoothly thereafter.
Folks. That happened in some unnamed international country.
Yeah, Italy. It's perfectly obvious, at least to me, that to say that derivative accounting in America is a sewer is an insult to sewage.
People don't seem to get that point. You have any idea why, Charlie?
Warren, if people weren't so often wrong, we wouldn't be so rich.
Before Ben and Jerry, Oprah and Gail, or Sergey Brin and Larry Page, there was Warren Buffett and Charlie Munger. Born and raised in Omaha, Nebraska, both worked at Buffett's grandfather's grocery store, but their paths didn't cross until Buffett was 29 years old and Munger was 35. To understand the most successful couple in business, it's best to start at the beginning and how they first met.
Well, want to tell a story?
Go ahead.
There was a doctor couple, very prominent in Omaha, and His name was Eddie Davis. Her name was Dorothy Davis. And it was Mrs. Davis that called me, naturally. She did everything. And she said, we've heard that you manage money, and we'd be kind of interested in listening to your story about how you do it and what we might do with you. So I went over, and I talked to him, and I was all full of myself. And I couldn't talk fast enough about stocks in those days. And Dorothy Davis, very smart, and she listened to every word. And the doctor was kind of over in the corner spinning a yo-yo or something, and I didn't pay much attention. And the wife looked over at the doctor, and he said, I'm going to give him $100,000. And I was managing about $500 at the time, so it was a big deal. And in a very nice way, I said, Dr. Davis, I said, you really haven't paid much attention to what I've been saying. Everything. I'd kind of like to know why you're giving me this $100,000. I was much more modest than that, the way I edged into it. And Dr. Davis looked at me and he said, well, he says you remind me of Charlie Munger. And I said, well, I don't know who Charlie Munger is, but I like him. And it sort of became their mission that sometime they wanted to get me and Charlie together. So Charlie, in 1959, his dad died, and he came back to Omaha. His mother lived there, and the Davises really got us together. And so they arranged a dinner. About 5 minutes into it, Charlie was sort of rolling on the floor laughing at his own jokes, which is exactly the same thing I did. So I thought, I'm not going to find anything out like this. And we just hit it off.
Charlie, what did they first tell you about Warren? How did they describe him to you?
Well, the Davises were like a second set of parents to me. There were two sets of three children. My father's best friend was Eddie Davis. My mother's best friend was Mrs. Davis. I lived in that house back and forth as though it were an alternate house of the Mungers. And Mrs. Davis gave me the honor of switching my legs when I misbehaved, just as if I were one of her own.
You probably gave her plenty of cause, too.
Anything the Davises asked me to do, I was going to do.
What did you think of Warren when you first met him?
We got along fine.
Oh, well. Both of our wives thought, my God, another one.
What I like about Warren is the irreverence. We don't have automatic reverence for the pompous heads of all civilization.
Is that something that came with age, or you guys were born with that?
We were kind of always the way. We were a little more extreme. I've learned to behave a little bit better. Charlie really hasn't learned to be much better. But, I just knew instantly Charlie was the kind of guy that I was going to like him, and I was going to learn from. But it wasn't anything calculated decision or anything like that. It was natural, and we have had nothing but fun.
I think part of the popularity of Berkshire Hathaway is that we look like people who found a trick. It's not brilliance, it's just avoiding stupidity. And you say, but it's the same thing, just stated differently. Well, maybe it's the same thing, just stated differently, but you understand it better if you go at it the way we do. Is to identify the main stupidities that do bright people in, and then organize your patterns of thinking and development so you don't stumble into those stupidities. Berkshire Hathaway is constantly kissing off ideas, and he went about 2 seconds flat. We know we've got opportunity X, which is better than the new opportunity. Why do we want to space 2 seconds thinking about X? Many of you come from places that don't do that. You've got to have one horse, one rabbit, one something or other, and that rabbit is going to be thinking about something which would be ruled out immediately by an opportunity cost available generally to the place. But it's in a different department, and you have to be diversified, and so on and so on. So it's easy to drift into this idea that opportunities don't matter, and you've got some different way of doing things that are better. It isn't better. The right way to make decisions in practical life is based on your opportunity costs. When you get married, you have to choose the best you can find that'll have you. And the rest of life is the same damn way. And you have have to figure these things out if you want good results in life. And if you don't, well, you have to pretend that you can get good results in life. And if you have enough sales ability, maybe you can get by with it. Sure, there are a lot of things in life way more important than wealth. All that said, some people do get confused. I play golf with a man, and he says, "What good is health? You can't buy money with it." If I can be optimistic when I'm nearly dead, surely the rest of you can handle a little inflation.
If you mix the mathematics of the chain letter or the Ponzi scheme with some legitimate development like the development of the internet, you are mixing something which is wretched and irrational and has bad consequences with something that has very good consequences. But you know, if you mix raisins with turds, they're still turds.
That's why they have me write the annual report.
I would rather throw a viper down my shirt front than hire a compensation consultant. A director getting $150,000 a year from a company who needs it is not an independent director.
Being put on the comp committee of American corporations, as I've said, they're looking for Chihuahuas and not Great Danes or Dobermans yeah. And I hope I'm not insulting any of my friends that are on comp committees.
You're insulting the dogs. It's not that great a business as a business, casualty insurance. It's a tough game. There are temptations to be stupid in it. It's like banking. Once I asked the man who just left a large investment bank, and I said, "How does your firm make its money?" He said, "Off the top, off the bottom, off both sides, and in the middle." The general system for money management requires people to pretend that they can do something that they can't do, and to pretend to like it when they really don't. And I think that's a terrible way to spend your life, but it's very well paid.
Charlie, I don't know why I'm giving you another shot, but
I think I've offended enough people.
right. There's 2 or 3 in the balcony. We were mental partners right from the moment we met.
I want to know, going back 50 years, what it was like when you first met Warren.
Well, I thought he was a prodigy. And I got a lot of criticism. My wife said, "Why are you paying such enormous respect to that young man with a crew cut who won't eat vegetables?"
He's ungodly smart. He's got a much broader intellect than I do. And he's magnificent at being able to condense important ideas into just a very few words.
If you're not interested in the economic scene right now, you're mentally dead.
Charlie has no tact.
All right, let's talk a little bit about bankers. Charlie on Friday compared them to heroin addicts.
Yeah, well, that's colorful, Charlie, but I would not have chosen that.
I once wrote of him that when they handed out humility, he didn't get his fair share.
The ideal way to run a headquarters is to have one man, preferably over 80, sitting in an office by himself. Anything else is pure frippery.
He's always honest in what he tells me, so I listen to him.
We never had an argument. We just kind of roll with it easily. Suppose Warren doesn't want to do something that I would have done. And suppose that happens 4 times over 40 years or something. What the hell difference does it make to me? Net, the record is working out fine. Warren, your obsession with Hollywood is starting to worry me.
Well, Mr. B, I look forward to serving as your number 2.
Well, actually, I already have a number 2. Meet Charlie, my Dwight.
You don't look so tough.
Well, actually, there are 18 ways I could kill you right now.
I'm in. I'll raise. I fold.
Where's Warren?
Well, unfortunately, I wasn't Warren's type.
Oh, well, who needs a billionaire anyway, right?
Oh, I got myself a billionaire. It's just not Warren. Come in, sweetie.
Hi, girls.
This is Charlie.
Hi, Charlie.
You come here and sit right down, and I will grab us a couple of beers.
Deal me in. Is this really Jamie Lee Curtis?
Is this really Mr. Munger, excuse me. Please call me Jamie as long as I can call you Charlie.
Hi, Charlie. I'm Susan Lucci. Oh, haven't you heard about the deal between Warren and me? He's going to be a big star at All My Children, and I'm going to be taking over Berkshire Hathaway.
Well, you certainly got some important qualities that Warren lacks.
Well, thank you, Charlie. There's some changes I really think we need to make around here. The first thing we need to look at is our dividend policy. I have never heard of anything so cheap and so unfair to our wonderful shareholders. We need to change it.
Sounds good to me.
Charlie, have you seen the new trailer for Iron Man 3? It's really amazing.
Iron who?
Charlie will get on his knees for you. I can
Check,
tell you.
please.
Yeah. Do we have a deal?
Okay, yes. Oh, thank you.
Charlie, it's about done. I'm right.
Oh, is that Charlie? Oh, give me the phone. Give me the phone. Give me the phone. Charlie, it's Jamie. Oh, it's so great talking to you, too.
1, 2, 3.
Warren Buffett.
Jesse. All right. I'm going to call my partner and have him draw up the papers.
Wait a minute. Did you just put that piece of brittle back in the batch?
That's right there.
Contaminated the whole thing.
Charlie?
It's done.
Slick, yo. Brittle, bitches.
Well, a Berkshire Hathaway shareholders meeting is partly a fun festival. It's sort of a Mardi Gras for people that come every year. It's a chance for us to have a lot of fun and meet the people that have entrusted us with their money.
Well, we used to have just 30 people in a cafeteria, and now we have this huge public spectacle. Celebration is part of making a group of people work well together. It's a celebration.
I think investors who own Berkshire Hathaway, they see themselves as a part of a community. There are more long-term holders of Berkshire than any company. People consider it a religion.
They don't buy it with the idea they're going to sell it next week. I think most of them buy it with the intent of holding it for their lifetime, just like they buy a farm or buy an apartment house. At Berkshire, everybody gets the same information from the comprehensive annual report. We don't meet with the analysts. I'm not interested in what an analyst thinks about Berkshire. I'm interested in what the owners of Berkshire think about Berkshire.
He came out of a private partnership where people he knew were trusting him. And he had his relatives in the partnership, and they were not rich. And as it got bigger, started treating everybody else the way he treated his relatives.
In terms of our feeling toward the people who are shareholders, we regard them as our partners. They're not some faceless group of people. And that's why at the annual meeting, I love seeing 40,000 of them. It gives real meaning to what we're doing every day. Warren Buffett. And that's me with Charlie in an unscripted and spontaneous photo taken in Savannah, Georgia, early in 1982. Our wives could tell us apart, as long as we wore name tags. When Charlie and I first met in 1959, it was as if twins who had been separated at birth were reunited. But there were a few important differences between Charlie and me that many people missed. Let me elaborate. For one thing, I was only interested in whether things worked. Charlie wanted to know how things worked. I would turn on a switch, and if the TV or light bulb went on, I could not care less about what had caused that miracle. Charlie, however, would want to understand every aspect of how the generator worked, how electricity traveled to his home, the merits of AC versus DC, whatever. You could say that Charlie understood electricity better than Thomas Edison ever did. Like his hero, Ben Franklin, Charlie wanted to understand everything, and he pretty well succeeded. Additionally, Charlie liked to design things. When we met in 1959, he was designing and building the house in which he lived throughout his life. He once wanted to design a home for me in Santa Barbara on a piece of property Berkshire inherited. Fat chance. In 1958, I bought the house I now live in, but I would have been happy with any of 100 or more houses as long as it was in the general neighborhood of where I was then renting. Of course, I wanted my wife to like it, and I wanted to have room for 4 or 5 kids. But what it looked like inside, outside, was irrelevant. The difference, of course, was of supreme importance to Berkshire. Charlie's architectural thoughts led to the Berkshire Hathaway of today. Some of you may be surprised that Charlie first became a director of Berkshire in 1978. Through a small partnership, I had bought control of Berkshire early in 1965. Charlie then didn't have a penny invested in Berkshire, but he immediately told me my purchase was just plain dumb, which it was. Charlie then did for me what needed to be done to correct my error, and over time, we worked together to achieve his vision. Charlie, in effect, became the architect of today's Berkshire. The architect is the person who dreams of, then designs, then finally supervises the construction of great structures. The carpenters and the roofers, that's me, are needed, but the architect is the genius who provides the blueprint. Berkshire has become a great company with a unique group of owners. The directors of Berkshire are the trustees of the structure Charlie designed that lives beyond his lifetime and will live far beyond mine. I'm now going to introduce these directors and give you a short first quarter report and the outlook for the company. After that, we will take your questions. Please turn up the lights, and I hope you'll join me in applauding Charlie Munger, the architect of Berkshire. Yeah, don't wear out all your clapping on Charlie. I mean, we got. In addition, well, we have, first of all, Greg Abel, a director, and Ajit Jain, sitting next to him, who runs insurance. And moving then to this back of this first section, if each of the directors there would remain standing till we finish, we'll go alphabetically down the line. And we've got Howard Buffett. We have Susan Buffett, Steve Burke, Ken Chenault, Chris Davis, Sue Decker, Charlotte Guyman, Tom Murphy Jr., Ron Olson, Wally Weitz, and Merrill Whitmer. Okay. There are 2 people I would like to thank, and then we'll get on to the brief description of the results of the first quarter. First of all, I'd like to thank Melissa Shapiro, who put this whole event together. You can't imagine the work that goes into it. She just reported to me that we set a new record for See's candy. I think they brought along 6 tons, and they will sell out. And one thing I do want to mention, we have only one book at the bookstore, the Bookworm, this year. Normally we have about 25, but we have Poor Charlie's Almanac, 4th edition, and I think we sold about 2,400 of them yesterday, and that will be the only book. Next year we'll go back to having our usual selection, but we thought we would just turn it over to Charlie this year. And then I would like to introduce one further person, and that's the person who put that movie together. And you can't imagine the amount of work it is, because, for example, on those scenes that we've used from the past, if they involved Hollywood stars or various people, we needed to get permission all over again to show it, because we told them originally we would only show it within the confines of our auditorium here, and of course it went out on CNBC, and you just can't imagine how much effort, but also the great cooperation we got from all those desperate housewives and Jamie Lee, and with the Desperate Housewives, we had to get Disney's okay, and that was easy to get, but running down 5 Desperate Housewives, that one came in toward the end. But the job of putting this together has been handled by the same fellow that handles us. Been doing these for years and years and years and years, and I just would appreciate it if you could just put the spotlight on Brad Underwood for just a minute. Okay, we put out some results for the first quarter this morning at 7 o'clock our time, and some few sharp-eyed analysts and press people already picked up 1 or 2 items from it, which I'm sure we'll get some questions on later. But if we could start out with slide number 1, which should be showing now, you'll see that in the first quarter, the way, and we talk about operating earnings at Berkshire, we've explained that many times. This is why we think these figures that we give you are the most descriptive of what's really going on in the business, and take out the wild swings in the market that otherwise just can have us reporting big earnings one quarter and big losses another quarter. We pay no attention to those at Berkshire, but you will see that we had a better than average quarter, and Ajit Jain wants me to point out to everyone that you cannot take the insurance earnings of the first quarter and multiply by 4. It just doesn't work that way in insurance, and while we insure storms around the world, the major storms, for example, that would affect our earnings would be, probably number 1 would be something that went along that came in at the wrong place from our standpoint, and that just kept going up the East Coast, and that's our number 1 risk as we evaluate things. But we're in all kinds of risks. There can be an earthquake tomorrow. There can be an earthquake 10 years from now, and there can, we're in that sort of business. But the first quarter does hit should be our best quarter. Certainly shouldn't be our worst quarter. The most likely quarter to be the worst quarter is the third quarter. But anything can happen in insurance. But fortunately, nothing much happened in insurance during the first quarter. So we had much improved earnings in insurance underwriting, and then our investment income was almost bound to, well, it was almost certain to increase. And I said that in the annual report because yields are so much higher than they were last year. And we have a lot of fixed short-term investments that are very responsive to the changes in interest rates. So that figure is up substantially, and I can predict that one will be up for the year. We've got more money to invest, as we'll get to in a minute, and that's fairly predictable. So that number will be up. When you get into the railroad earnings were down modestly, but we should, not immediately, but we should be earning somewhat more money than we are earning under present traffic conditions, and then traffic conditions could also hit the it's a potential earnings of the railroad. And if you want, every Wednesday you can get car loadings from the previous week, and I'll regard you as a little deranged if you do get them, but I get them every week. They're available, and you'll see that car loadings have been running for the industry, have been running down modestly, and these earnings were as is expected, but we should earn somewhat more money than that on the equivalent amount of car loadings. And we in the energy company, we had better earnings, but our earnings were distorted. Well, they were affected by conditions that I wrote about in the annual report, and we'll undoubtedly discuss more this morning. But off a low base of last year, they were up somewhat, and so you get down to the final figure, and 11.2 billion is it's quite an improvement from last year, but we would expect our earnings should go up modestly from year to year, because after all, we're retaining like 37 billion last year of earnings. So if we put 37 billion more, you left it with us, we should do something that's satisfactory. And the goal of Berkshire, economic goal, is to increase the operating earnings and decrease the shares outstanding. It's that simple to describe. It's not quite so simple to pull off necessarily, but that's what we're attempting to do. And if we'll turn to slide 2, please. I've got the history, and I just picked the pre-pandemic year of when we hit 24 billion, and then we fell off in the first year of the pandemic, and then, as you see, we've moved up from 27 to 30 to 37 billion. And interesting thing about these earnings is they're after depreciation and amortization and taxes and all that sort of thing. So you can figure that essentially Berkshire has a little over $100 million per day, including weekends and holidays, coming in to deploy. And we've said out many times what we're attempting to deploy that money, but we have that responsibility. And sometimes, if you'll turn to the next page, well, you'll see how that's built up the shareholders' equity, so that Berkshire had at March 31st, 574 billion, and through retaining earnings, and we've been retaining earnings ever since we took control of Berkshire Hathaway, except one day, as I remember, I think it was maybe 1968 or 9, the directors declared a 10-cent a share dividend, and I think I must have been in the restroom or something at the time. So if you leave out that period of madness, we've been retaining we've been saving your money, putting it to work, and sometimes we've done things that were big mistakes, but we never get close to fatal mistakes, and every now and then we do something that really works. And as Charlie had pointed out in the past, there's probably been a half a dozen to a dozen over 57 or 58 or whatever it would be, really important big decisions, and there's been nothing close to fatal. So that continues to be the guideline, and we have accumulated $571 billion, and I couldn't help but look at who's second, and J.P. Morgan had $327 billion at year end, and they're up to 338, I believe, at the end of the quarter. But they pay significant dividends. They repurchase shares. They've got a business that earns better returns on equity, but they don't plow it, and they shouldn't. They don't plow it back exactly like we have. And this does show what can be done, really without any miracles. If you save money over time, and we have a group of shareholders. We had a group of partners originally, Charlie and I did, that wanted to save money and left their money with, like, in that film you just saw, you saw Eddie and Dorothy Davis, and the Davis family and the children and the grandchildren periodically did some other things with the money, but they also basically left it with us, and we were a savings vehicle, and they were able to live very well, but they weren't trying to live like the kings and queens of earlier capitalism, and used to build the houses in New England, and have a servant but standing behind everybody eating and all that sort of thing. So we've had very few what I would call look at me type people that are attracted to. There's nothing wrong with it, but they just go someplace else, and they are spending sort of unbelievable sums after a while by the standards of the past. And our people, we have nobody that's a miser or a hoarder or anything like that in our group. They live very well. But the math of compounding and a long runway have done wonders, and we will talk a little later. Right before lunch, we'll give an illustration of that, of what can be done with that sort of philosophy. So our cash and treasury bills were $182 billion at the quarter end, and I think it's a fair assumption that they probably give about $200 billion at the end of this quarter. We'd love to spend it, but we won't spend it unless we think we're doing something that has very little risk and can make us a lot of money, and our stock is at a level where it adds slightly to value when we buy in shares, but we would really buy it in a big way, except you can't buy it in a big way because people don't want to sell it in a big way. But under certain market conditions, we could deploy quite a bit of money in repurchases. And as you'll see on the final slide, we have bought in the last 5 years. We can't buy it in like a great many other companies because it just doesn't trade that way. The volume isn't the same because we have investors, and the investors, the people in this room really, they don't think about selling. They probably, I would hope many of you don't even check the price daily or weekly. The people who check the price daily have not made the money that the people who've forgotten about it basically have over the years. And that's sort of the story of Berkshire. We'll try to increase operating earnings, and we will try to reduce shares when it makes sense to do so, and we will hope for an occasional big opportunity. And we're quite satisfied with the position we're in. So with that background, I think we'll turn it over to Becky Quick, and we will alternate questions between Becky and those of you in the audience. And Becky, do you want to start with the first question?
Sure. Thanks, Warren. Let's start, just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, I would, but we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have. Now, one interesting thing is that Charlie and I looked at common stocks or marketable equities or the things that people love to look at as being businesses. And so when we own a Dairy Queen or we own whatever it may be, we look at that as a business. And when we own Coca-Cola or American Express or Apple, we look at that as a business. Now, we can buy really wonderful companies in the market as businesses. We can't buy all of them. All of their shares. We can't buy 90% or 80% or anything like that. But when we look at Coca-Cola and American Express and Apple, we look at them as businesses. Now, there's differences in tax factors. There's difference in managerial responsibility, a whole bunch of things. But in terms of deploying your money, we always look at every stock as a business. And we have no attempt made to predict markets. We have no attempt made to pick stocks. I went through many, many years doing the wrong thing. I got interested in stocks very early, and I was fascinated by them. And I wasn't wasting my time because I was reading every book possible and everything else. But finally, I picked up a copy of The Intelligent Investor in Lincoln, and there was a few sentences in there that said much more eloquently than I can say it. But if you look at stocks as a business and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time than if you try to take charts and listen to people talk about moving averages and look at the Fed pronouncements and all of that sort of thing. And so that made a lot of sense to me then. And the way I've been allowed to deploy it, and Charlie and I talked about this, of course, constantly. It's changed over the years as the amount of capital we have, and it's changed and all of that. But the basic principle was laid out by Ben Graham in that book, which I picked up for a couple of dollars, and which basically said to me, you've been wasting your time now, but maybe you can use what you've learned or been reading about and put it to better use. And then Charlie came along and told me how to put it to even better use. And that's sort of the story of why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business. And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place. It's such a simple approach that it's almost deceptive. Most things, if you keep working harder and harder at it, you learn a little more math or you learn a little more physics. But investments, you don't really have to do that. You really have to have your mind set properly. So we will end up, unless something dramatically happens that really changes capital allocation, a strategy, and we will have Apple as our largest investment, but I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive. And one thing that may surprise you, but almost everybody I know pays a lot more attention to not paying taxes than I think they should. We don't mind paying taxes at Berkshire, and we are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And the federal government owns a part of the earnings of the business we make. They don't own the assets, but they own a percentage of the earnings. And they can change that percentage any year. And the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give, and I think that higher taxes are quite likely, and the government wants to take a greater share of your income or mine or Berkshire's, they can do it. And they may decide that someday they don't want the fiscal deficit to be this large, because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it. And we always hope at Berkshire to pay substantial federal income taxes. We think it's appropriate that a country that's been has been as generous to our owners. It's been the place I was lucky, Berkshire was lucky it was here. And if we we send in a check like we did last year. We send in over $5 billion to the U.S. federal government. And if 800 other companies had done the same thing, no other person in the United States would have had to pay a dime of federal taxes, whether income taxes. No Social Security taxes, no estate taxes, no, it's up and down the line. Now, I would like to, I hope things develop well enough with Berkshire that we say we're in the 800 club and maybe even move up a few notches. It doesn't bother me in the least to write that check. And I would really hope with all that America's done for all of you, it shouldn't bother you that we do it. And if I'm doing it at 21% this year and we're doing it at a higher percentage later on, I don't think you'll actually mind the fact that we sold a little Apple this year. Okay, let's go to section 1.
Hi, Mr. Buffett. This is Matthew Lai from China, Hong Kong. I'm running my listed listing company called FW, and we are so grateful that to learn from you, and you really inspire us. My question is, besides the electrical car company, BYD, under what circumstances you will reinvest and reconsider to invest Hong Kong and China company? Thank you.
Yeah. Well, our primary investments will always be in the United States. We do think it. Now, the companies we invest in the United States, American Express does business around the world, and no company hardly does business around the world like Coca-Cola. I mean, they are the preferred soft drink. You know, something maybe like 170 or 180 out of 200 countries. Those are rough approximations from a few years back, probably, but that degree of acceptance worldwide is, I think it's almost unmatched. I can't really think of any company that has it. American Express has a position in the credit card field, which I think is extremely strong. And part of that was part of the reasons for that is one of the directors that I introduced a few minutes ago, Ken Chenault. But it has strengthened dramatically over the last 20 years for a lot of reasons. So we will, the BYD investment was we made the commitment in Japan, which I did 5 years ago, and that was just overwhelmingly, it was compelling. It was extraordinarily compelling, and we bought it as fast as we could, and we spent a year, and we got a few percent of our assets in 5 very big companies, but that's the problem of being our size. But you won't find us making a lot of investments outside the United States, although we're participating through these other companies in the world economy. But I understand the United States rules, weaknesses, strengths, whatever it may be. I don't have the same feeling for economies generally around the world. I don't pick up on other cultures extremely well, and the lucky thing is I don't have to, because I don't live in some tiny little country that has just doesn't have a big economy, but I'm in an economy already that has, after starting out with a 0.5% of the world's population has ended up with well over 20% of the world's output in an amazingly short period of time. So we will be American-oriented. I mean, if we do something really big, it's extremely likely to be in the United States. Charlie, in all those years, there's only 2 times he's told me that, this one is really, he would always go along with me and say, well, when I was suggesting something, he'd say, well, this is really not that great, but it's probably the best you'll come up with, so I'll go along with the idea. But Charlie twice has pounded the table with me and just said, buy. And BYD was one of them, and Costco was the other. And we bought a certain amount of Costco, and we bought quite a bit of BYD. But looking back, he already was aggressive, but I should have been more aggressive. In Costco, it wasn't fatal that we weren't, but he was right big time in both companies. And I'm aware of what goes on in most markets, but I think it's unlikely that we make any large commitments in almost any country you can name, although, we don't rule it out entirely. And I feel extremely good about our Japanese position, and we'll have that, I don't know how many years. Greg will be sitting with that at some point, and we couldn't be happier with that. But we really have a different outlook in looking at we look at your money, which we couldn't bear to lose, and we feel that we're very less likely to make any truly major mistakes in the United States than in many other countries. Okay, Becky.
This next question comes from Stanley Holmes, who is a Berkshire shareholder from Salt Lake City. He asks, in his 2024 annual letter to shareholders, Chairman Buffett noted the severe earnings disappointment experienced at Berkshire Hathaway Energy last year and expressed concern about earnings and asset values in the utility industry. Recognizing that investors are worried about climate change-related expenses and that new uncertainties cloud the regulatory environment, the chairman suggested that some jurisdictions may adopt the public power model. There are now signs that policymakers in Utah, citing state sovereignty, may already be poised to move in that direction. The Utah legislature recently mandated the state's right to serve as sole purchaser of energy from an in-state power plant and, under some circumstances, purchase the power plant before it can be retired. The state utility regulator will be legally bound to prioritize public purchases of power and facilities that could include assets owned by Berkshire Hathaway Energy's Pacific Core utility, Rocky Mountain Power. Will Berkshire, through BHE, continue to invest resources in jurisdictions where corporate assets may be subject to confiscatory state policies and actions? And how is Berkshire Energy working with officials in Utah to minimize potential corporate losses if and when state control is asserted over its electrical utility sector?
Yeah, I will let Greg join with me in the answer on this, but I would say our feeling is that Utah is actually very likely to treat us fairly, whether the action is in granting appropriate rates that give us the return we generally expected in terms of our own properties, or if they decide for some reason to go to public power, I think they would compensate us fairly. In the 1930s, George Norris, a senator from Nebraska, just turned Nebraska into a public power state, and our experience in Iowa would indicate that free enterprise has its role, and that we we can run a privately owned utility company that will be more efficient for society than at least in most states people can do with public power. But what has happened is that there's going to be enormous amounts of money spent on power. And if you're going to do it with private owners, there's nobody better situated than Berkshire to satisfy the portion, but a large portion of the needs of the country, and we will do it at a rate of return that is not, it's not designed to make us rich or anything like that. It's a sensible rate of return, but we won't do it if we think we're not going to get any return. It'd be kind of crazy. And we've seen actions in a few states where some of the costs associated with climate change are not being regarded as costs that the utility shouldn't incur. Well, believe me, if it was publicly owned, they would have incurred it too. But we'll do what society tells us, and we have got the money, and we've got the knowledge to participate big in something that is enormously important for the country. But we're not going to do it. We're not going to throw good money after bad in the field. I don't worry about. My understanding is, and Greg can elaborate on this now immediately, but I don't regard Utah as being unfriendly to the idea of utilities being treated fairly. Charlie? Charlie, I'm so used to I had actually checked myself a couple times already, but I'll slip again.
That's a great honor, Warren. Yeah, Warren, you touched on it initially in your letter relative to the challenges in the industry, and then you've just alluded to the significant investment that has to go into the energy industry, the utility sector for many years to come. And I think if we start there, if I think of our different utilities, and we'll definitely come to Utah and Pacific Corp, but if you look at the underlying demand that is building in each of those utilities and the amount of dollars that are going to have to go in to meet that demand, it's absolutely incredible. So when you raised it in your letter, it's a really important issue. We have to have a regulatory compact that works between, if it's a public utility, it has to work in concert with the state, Utah being an example, or it ultimately becomes potentially a public power entity. So just to set the frame a little bit, if I think of Iowa, which you mentioned, and the underlying, we've made substantial investments there. It's been very consistent with both the public policy that the state and legislature wanted, and they enacted very specific laws to encourage that. But that utility is more than 100 years old right now. And if we look at the demand that's in place for Mid-American Iowa utility over the next, say, into the mid-2030s, associated with AI and the data centers, that demand doubles in that short period of time. And that happened, and it took 100 years plus to get where we are today. And now it's going to double. And that will require substantial amounts of capital from Mid-American and its shareholders. And how that will function is if we have a proper regulatory compact in place, which you've highlighted. If we then go to, say, Nevada, where we own 2 utilities there and cover the lion's share in Nevada, if you go over a similar time frame and you look at the underlying demand in that utility and say go into the later 2030s, it triples the underlying demand, and billions of dollars have to be put in. Our rate base will literally go from, it's not a modest level now, but you're talking probably an incremental 6 to 10 billion at least of rate base going into that type of entity, which requires again, alignment with the state and their policies and a proper recovery of our underlying both capital and a return on capital. So when we come to the wildfires, that's been a substantial challenge because it's the first time there's been a lot of discussion around one of our utilities, experienced significant losses associated with the wildfires. What portion of those costs will be recovered? And that's really the dialogue we're in, and does that properly work? When I think of the wildfires, there's been many claims, and a recent additional claim last week for $30 billion, and we don't take that lightly, but it is an incremental claim to an already existing lawsuit that's in place. And when I think of Pacific Corp, we're in a place where, first and foremost, all that litigation will be challenged because the basis for it, at least we believe there's places where it's unfounded, and we'll continue to challenge it. And it will take many years to be resolved, as Warren highlighted in the letter. But if you think of Pacific Corp, and the litigation there. Number one, how we think and operate those assets have to change. Because we've had we have worked with the states, across all our states for many years, with the fundamental goal to keep the power on. And our teams and our employees worked incredibly hard to keep the power on day in, day out, through storms, unfortunately through the 2020 fires. The instincts were not to turn off the power. The instinct was to keep the power on, to keep hospitals, fire stations responding. It's not in their mind or at least culturally, it wasn't in our minds to de-energize. So the first thing we had to do was step back and say, we've got to fundamentally change the culture, not just at Pacific Corp, but across all our utilities. The first thing we have to recognize is that there's now going to be situations where we prioritize de-energizing the assets. And that's completely different than how we've operated those assets, as I've highlighted, for 100+ years. So we start with the culture. We had to change that. The second thing is we've now changed our operating systems so that we can turn off the power very quickly if there's a fire that's encroaching. We will turn off our systems now, and we'll go the minute the conditions are safe again. We'll re-energize it, but we've had to do that. And then the third thing is continuing to invest in a way that allows us to try to minimize the risk of the fire. But when you get back to Utah and Pacific Corp, the challenge we do have is within Pacific Corp, as we go through both litigation and through continuing to operate that entity, it generates a certain amount of capital and profits that will remain in that entity and be reinvested back into that business. But fundamentally, as we go forward, we need both legislative and regulatory reform across the Pacific Corp states if we're going to deploy incremental capital, make incremental contributions into that business. As Warren said, we don't want to throw good capital after bad capital. So we'll be very disciplined there. But the reality is there are opportunities to both solve the legislative and regulatory solutions. And the best example we actually have, and I think it's the gold standard across the country, is Utah. So as Warren touched on, it's a state we're happy we're investing in. It is part of Pacific Corp, so there's a certain amount of balance there as to how we do it. But in the last legislative session that existed, Utah actually passed a bill that does a couple very important things. One, it caps non-economic damages on wildfire claims. So if you go back to the wildfires we have in Oregon, and the claims you're hearing filed for, there's economic damages associated with them, and those harms should receive the economic damages associated with that. But unfortunately, and even though there's legislature and case law in Oregon that says wildfire non-economic damages should not be awarded, there's very substantial non-economic damages being awarded there. Utah took a very proactive position to say, we will cap those non-economic damages. And it creates an environment, again, it's back to that, is there an environment where you want to invest in? Yes. And then incrementally, they've created a very substantial fund. It's literally called the Wildfire Fund for fires in Utah that will help facilitate both liquidity and the ability to resolve the situation. So Utah, we believe, including the legislation that a lot of other things came out of it, is the actual gold standard as we go forward. So very important issue for Berkshire Hathaway Energy. But at the same time, it is a Pacific Corp issue. The risk of regulatory compacts not being respected is a much broader one that we'll always evaluate and be careful how we deploy our capital. But both Pacific Corp will manage through it, and I see other very good and significant opportunities in Pacific Corp. In Berkshire Hathaway Energy.
The return on equity investment, it's been promulgated and been achieved over the years, has been, particularly in recent years, well below the return on equity that has been achieved by American industry generally. And so whether you earn X or X plus 0.5% or X minus 0.5%, that differs by state. And some states are more attractive than others. But whether you earn X or go broke is not an equation that works. And we won't put our shareholders' money. They didn't give it to us to lose it all. And we might like it if it's better when it's X plus 0.5% than X minus 0.5%. But the electric utility industry will never be as good as, just remotely as good as, the kind of businesses we own in other arenas. You look at the return on tangible equity at Coca-Cola or American Express and to really top it off, Apple. It's just a whole different game. But in utilities, the trade has been, the compact has been that you get a modest return, and climate change comes along and it causes way more fires. That's just a cost of doing business, and it doesn't mean that we can't do things to mitigate fires in the future, and you can make different policies on when you turn off the lights. But somebody's going to put up many, many hundreds of billions, maybe in the trillions, and climate change enters into that. And it can be done through public power, or it can be done through private enterprise to quite a degree. And we would be certainly good for 100 billion or more, but we're not going to throw good money after bad. Okay, let's do station 4.
Hi, I'm Joe, visiting from San Francisco. How do you think about the role of technological advances, especially generative AI, on more traditional industries? Thank you.
Yeah, I made a mistake in calling on 4, but I'll get back to 2 later on. I don't know anything about AI, but I do have. That doesn't mean I deny its existence or importance or anything of the sort. And last year I said, that we let a genie out of the bottle when we developed nuclear weapons, and that genie has been doing some terrible things lately. And the power of that genie scares the hell out of me. And on the other hand, I don't know any way to get the genie back in the bottle. And AI is somewhat similar. It's part way out of the bottle, and it's enormously important, and it's going to be done by somebody. So we may wish we'd never seen that genie, or may do wonderful things. And I'm certainly not the person that can evaluate that. And I probably wouldn't have been the person that could have evaluated it during World War II, whether we tested a 20,000-ton bomb that we felt was absolutely necessary for the United States and would actually save lives in the long run, but where we also had Edmund Teller, I think it was on a parallel with Einstein in terms of saying you may, with this test, ignite the atmosphere in such a way that civilization doesn't continue. And we decided to let the genie out of the bottle, and it accomplished the immediate objective, but whether it's going to change the future of society, we will find out later. Now, AI, I had one experience that does make me a little nervous, and I'll just explain it. That very recently, fairly recently, I saw an image in front of my eyes on the screen, and it was me, and it was my voice, and wearing the kind of clothes I wear, and my wife or my daughter wouldn't have been able to detect any difference, and it was delivering a message that no way came from me. So when you think of the potential for scamming people, if you can reproduce images that I can't even tell, that say, I need money, it's your daughter, I've just had a car crash, I need $50,000 wired. I mean, scamming has always been part of the American scene, but this would make me, if I was interested in investing in scamming, it's going to be the growth industry of all time, and it's enabled in a way. Now, maybe, obviously AI has potential for good things too, but I don't know how you, based on the one I saw recently, I practically would send money to myself over in some crazy country. I don't have any advice on how the world handles it, because I don't think we know how to handle what we did with the nuclear genie. But I do think, as someone who doesn't understand a damn thing about it, that it has enormous potential for good and enormous potential for harm, and I just don't know how that plays out. I'd like to mention to Becky that Ajit will not be participating in the afternoon session, so if you could focus on if there are insurance questions you want to ask, that'd be a good one.
Yeah, this next question is for both Warren and Ajit. It's from Ben Knoll, who's a Minneapolis shareholder who's been a shareholder since 1995. And he says, in an interview this past year, Todd Combs said that in first meeting you in 2010, he told you Geico is better at marketing and branding, but Progressive is a data company and data is going to win in the long run. But it appears you did not prioritize data analytics at Geico until a decade later when you made Todd CEO. As business units like Geico age and need new strategic direction, I wonder if Berkshire's hands-off management approach is a source of vulnerability. Will you please review your thinking on changes made at Geico and explain how Berkshire is structured to react if the Berkshire CEO sees that a business unit is strategically off track? And a G, I hope you will continue to update us on yours and Todd's progress at remedying the data analytics shortcomings at Geico.
Jay, would you like to?
Yeah. As Warren has pointed out in the past, one of the drawbacks that Geico is faced with, it hasn't been doing as good a job as matching rate with risk and segmenting and pricing the product based on the risk characteristics. This has been a disadvantage at Geico for a few years now. We are trying to still play catch up. Technology is something that is unfortunately a bottleneck, but there again, we are making progress. And equally importantly, we have hired people who are much better than what they inherited in terms of data analytics and pricing and slicing data. So yes, I recognize we're still behind. We're taking steps to bridge the gap, and hopefully certainly by the end of 25, we should be able to be along with the best of players when it comes to data analytics, whether it's pricing, whether it's claims, or any other factor that drives the economics of the insurance business.
I would add that equating rate with risk obviously is important in every line of insurance business. I mean, that's what you're involved with, is deciding whether a given rate offers us the chance or the probability that we will make a little money on it, and that sometimes we're only risking losing a little, and sometimes we're risking losing huge amounts. But Geico and Progressive has done a better job in that recently. But our fundamental advantage at Geico, of course, is that we have lower costs than virtually anybody, and that cost advantage has been dramatic. We've driven our underwriting expense ratio below 10%, and there's just very, very, very few companies that can compete with that. So it isn't. It's not in the least a survival question, and it isn't even exactly a profitability thing. But we would rather have X% of the market than a half of X%. But we roughly, I think in the month of March, we didn't lose policyholders, and we got 16 million or whatever it is of them, and we've got the lowest cost operation. So it's not a threat. It's not remotely a threat to survival. It's not a threat to even profitability. But on the other hand, we would like to be growing with something that is the best model around in the insurance business of delivering at a low cost. And we now have a recognition that we didn't have back when Leo Goodwin started in 1936. But the same principle that worked then is that if you can offer somebody a good product cheaper than the other guy, and everybody has to buy it, and it's a big business, it's very attractive to be in. And Geico is a very attractive business and has got its lowest cost thing, and it does have to do a better job of matching rate to risk. But our low costs have masked the fact that for a while that we could do without progressing as much as we should have in the matching of rate to risk. And now Todd has been working intensively at that, and he's made a lot of progress, but there's there's still work to be done. But in the meantime, we're not going to shrink, and we're going to. We should make better underwriting profits than most companies in the auto insurance business. Okay, I'm going to back up and go to. I think I left station 2 out of it earlier, so. Do we have somebody there?
Yeah. Good morning. My name is Sebastian Sartor. I'm from Munich, Germany. Berkshire Hathaway is a very respected company in Germany. And my question is, who are your most trusted advisors today? Is it Ted and Todd? Is it Greg and Ajit? Is it your wife, your children? And what do you value about them? Thank you.
Well, it depends whether they're advising me on money or on other things. I trust my children and my wife totally, but that doesn't mean I ask them what stocks to buy. I was, in terms of managing money, there wasn't anybody better in the world to talk to for, many, many decades than Charlie. And that doesn't mean I didn't talk to other people. But if I didn't think I could do it myself, I wouldn't have done it. I mean, to some extent, I talk to myself on investments, and I think my children have gotten a whole lot wiser over the years, and so I listen to them on a lot of things. I'll listen to my daughter on who to vote for locally, because she knows a lot more about that than I do, and I'll listen to my wife on a lot of things, and I won't get into details. So it is important. I mean, if you don't live a life where you surround yourself and limit yourself to people you trust, it won't be much fun. I mean, I literally have been in the position ever since I was in my 20s of being able to have people I trusted around me, and I've made mistakes occasionally, but they filter out over time. You learn, and when I found Charlie, for example, in all kinds of matters, not just investment, I knew I'd have somebody well, I'll put it this way, you can think about this. Charlie, in all the years we worked together, not only never once lied to me, ever, but he didn't even shape things so that he told half lies or quarter lies to sort of stack the deck in the direction he wanted to go. He absolutely he considered it total utmost importance that he never lied. Now, that occasionally got him in trouble at dinner parties or something. If he said to the woman, "I really prefer the way you used to do your hair, or the way that somebody over across the room does it." I mean, but in terms of having a partner, I simply cannot think of a conversation I ever had with Charlie that in the least he misled me or shaped it his way or anything of the sort. So when you get that in your life, you cherish those people and you sort of forget about the rest. Okay. Okay.
This question's for Ajit. It comes from Meher Baruka. Climate change seems to be impacting the insurance industry heavily, with major players pulling out of markets like California because of wildfire and flooding risks, combined with payouts increasing. How does Mr. Jain see this risk expanding to other regions, and how has the thesis on insurance investments changed because of it?
climate change, climate risk is certainly a factor that has come into focus in a very, very big way more recently. Now, the one thing that mitigates the problem for us, especially in some of the reinsurance operations we are in, is our contractual liabilities are limited to a year in most cases. So as a result of which, at the end of a year, we get the opportunity to reprice, including the decision to get out of the business altogether if we don't like the pricing in the business. But the fact that we are making bets that tie us down to 1 year at a time certainly makes it possible for us to stay in the business longer term than we might have otherwise. Because of climate change, clearly prices need to go up. It is difficult to be very scientific about how much the prices need to go up. They need to go up a lot, and we keep increasing prices and hope we stay ahead of the curve. But that doesn't happen in all cases. The regulators don't make it any easier by tying our feet to the ground and making it difficult for us to withdraw from certain territories or to make dramatic changes in the pricing of certain products. As a result of which, a number of insurance carriers, including ourselves, have decided to not write business in certain states. I think the regulators are getting a little more realistic about and they are waking up to the fact that the insurance carriers need to make some kind of a return, a decent return for us to keep deploying our capital. It's a constant battle back and forth. It's been against the capital providers these last few years, but I think we are coming back into balance. If you look at the results that have been recently announced by the insurance carriers, everyone's now making record profits. Obviously, that will not last, but certainly for the next several months, I think the insurance industry, in spite of climate change, in spite of increased risk of fires and flooding, it's going to be an okay place to be in.
Yeah, climate change increases risks, and in the end, it makes our business bigger over time. But not if we misprice them, we'll also go broke. But we do it 1 year at a time, overwhelmingly. And I would say this: I would rather have Ajit assessing this than any 1,000 underwriters or insurance managers in the world. I mean, the factors aren't, we'll take Atlantic hurricanes, which would be probably our biggest risk. There's no question that you can measure the temperature of the water in the Atlantic, and you know what warm water does to hurricanes, but you don't know whether that's good or bad, because it may cause them to turn faster, and it may change the path as well as the intensity and frequency of losses. But we'll write it 1 year at a time, and we'll have Ajit underwriting it, and we don't have to tell you what's going to happen 5 years from now or 10 years from now. And people who don't have sort of analytical insurance minds that comment on this subject really don't expand our knowledge. We get a lot of letters from people that I'm sure have good IQs, but they don't really know. They don't understand the insurance business, and they're not wrong, I don't think, in my mind, about climate change. But if there was no risk, there'd be no insurance business, and we're in the business of evaluating it, and we do it 1 year at a time. And there's some exceptions where you can't do it, where your decisions extend for a long time in the future, and we try to avoid those. But again, you don't need 1,000 people analyzing water currents. I think you need one very, very, very smart guy, and we've got him. Okay.
Yeah, the only thing I'd add is that climate change, much like inflation, done right, can be a friend of the risk bearer.
And it has been for us. If you look at Geico, it had 175,000 policies roughly in 1950, and it was getting roughly $40 a car. So that was 7 million of volume. And, now we're getting over $2,000. Well, all the advances in technology and everything like that. If we had been wedded to some formula, what we did with $40, we'd have had a terrible business. But in effect, by making the cars much safer, they've also made them much more expensive to repair, and a whole bunch of things have happened, including inflation. So now we have a $40 billion business from something that was 7 million back when I called on it. So if we'd operated in a non-inflationary world, Geico would not be a $40 billion company. Okay, we're now finally coordinated to where Station 3, I believe.
Hello. Hi, everyone. Hi, Warren. I'm Liam. I'm 27 from Newmark, Ontario, Canada. I got invested in Berkshire thanks to my dad, who brought me down to this meeting. I'm so excited to be here. Most 27-year-olds have idols who are rappers, but instead, my idols are Warren, Charlie, who we'll miss forever, and also your cousin Jimmy, who unfortunately had to go this year too. It's been a tough year. As a Canadian, similar with Greg, I always wonder about our Canadian economy and what you think about the Canadian economy. We got some beat-down bank stocks right now, and I don't know what your opinions are on these. And I also wonder in your 90s if the rumors are true and you're still able to eat McDonald's. I like fast food myself, but I always wonder at 93 he's still able to eat those and enjoy the Coca-Cola. Thanks, Warren.
Okay, well, we've got a Canadian here, so we'll let him answer the first part. And if you watch me, you'll see what I like to eat. I mean, go to it, Greg.
Okay. Yeah, well, we are fortunate to have a number of operations up in Canada. It goes across many of our operating entities, and then as Warren touched on, all the businesses that we have a piece of that we're invested in are up in Canada. So the presence is significant. We're always looking at making incremental investments there because it's an environment we're very comfortable with. Warren touched on understanding the U.S. environment, business environment, and I would put Canada equally in that bucket, that we understand it and would be comfortable. And I would say the economy moves very closely to the U.S. So the results we're seeing out of our various businesses that report both their U.S. and Canadian operations aren't drastically different. And there's a few that we're on the energy side, for example. We make very substantial investments up there in Alberta. But again, it's very consistent with how that economy is growing, and I would see it being very consistent with what we see here. Warren, anything to?
Yeah, no, we Canadian, obviously there aren't as many big companies up there as there are in the United States, but when we get I got one from Canada just the other day that I sent over to Greg too. When we see anything that's suggesting an idea that's of a size that would interest here and meets other requirements, we don't have any hesitancy about putting big money in Canada. And there are things we actually can do fairly well that where Canada could, benefit from Berkshire's participation. We did it some years ago, not that many years ago, but there was a financial institution up there, and they had a problem, and they'd had, as I remember, 30 plus, various other people that were kicking it around, and meanwhile the place was getting close to the edge for not a fundamental problem. And Ted was Weschler from our office went up there. I heard about it on a Monday or something, and Ted Weschler went up there, and we offered a solution in a couple of days to something that was getting close to the brink. So we do not feel uncomfortable in any way, shape, or form putting our money into Canada. In fact, we're actually looking at one thing now, but they still have to meet our standards in terms of what we get for our money. But they don't have we don't have any mental blocks about that country. And of course, there's a lot of countries we don't understand at all. So Canada, it's terrific when you've got a major economy, not the size of the U.S., but a major economy that you absolutely, you feel confident about operating there. Okay, Becky.
Warren, you just said that you'd rather have a JEET running risk assessment at the insurance operations than any other 1,000 insurance adjusters in the world. So I'd like to follow up with a question that came in from Mark Blackley in Tulsa, Oklahoma. He said, Warren, for years you have spoken about the incredible impact a JEET has had on Berkshire. You've often joked, if you and a JEET are in a sinking boat and we can only save one of you, swim to a JEET. While we often discuss plans for the next CEO of Berkshire, little is mentioned on who will one day replace a JEET. How should we think about the future of the Berkshire insurance operations, given how challenging it may be to find another Ajit? And I'd like to hear Ajit's thoughts on this as well.
Well, I would say we won't find another Ajit, but fortunately he's a good bit younger than I am, so I hope you have to worry a little bit about me first before you start worrying about Ajit. We won't find another Ajit, but we have an operation that he has created, and that at least part of it is, there are certain parts of it that are almost impossible for competitors to imitate. And if I was in their shoes, I wouldn't try and imitate them. And so we've institutionalized some of our advantages, but Ajit is, his presence allowed us to do it, and he did it. But now we've created a structure that didn't exist when he came in 1986. Nothing close to it existed with us or with anybody else. And insurance is the most important business at Berkshire. Marketable securities are important, but they're not in the class exactly as our insurance business. And Ajit, we won't have the same business if Ajit isn't running it, but we'll have a very good business. And again, that's thanks to Ajit. You know, I'd been in the business when he came in 1986. You know, I first went to Geico in 1950. We first bought National Indemnity in 1957. And it was something that we'd made quite a bit of money in the stocks of insurance companies. But we needed an Ajit. Unfortunately, he came into the office on a Saturday, and he was tired of working at something where he really didn't. It just didn't challenge his intellect. And I said, well, we got a lot of challenges, so you know, nobody's perfect, so you've never seen an insurance policy or owned an insurance stock, but here are the keys, and that's worked out very well.
Well, thank you very much, Warren. Thank you very much, everyone. But the fact of the matter is, nobody is irreplaceable. And we have Tim Cook here in the audience, I believe, who has proved that and has set an example for a lot of people who follow.
That's a great observation.
Now, having said that, I will also add that our board is conscious of the succession issue, not only at Warren's level, but also at my level. And every year they have me sitting in front of them, answering questions and having me share my ideas with them in terms of what would happen to the operations if I get hit by a truck. We go through the various operations we have. I review with them a short list of people I think ought to be candidates for replacing me. And in addition to that, I go a step further and identify a particular individual as the person I would hand over the keys to if something were to happen to me. Obviously, that could be subject to change, but we take this issue fairly seriously. And I think at the end of the day, as Tim Cook has proved to us, it'll be the biggest non-issue of the day. The Earth will still keep revolving around the axis.
Okay, we know what we know what we will do. We know it's a good answer, but we know it isn't. We won't have another G. Station 5.
Hi, my name is Andrew Nickus, and I'm wondering if you had one more day with Charlie, what would you do with him?
Well, it's kind of interesting because, in effect, I did have one more day. I mean, it wasn't a full day or anything, but we always lived in a way where we were happy with what we were doing every day. I mean, Charlie liked learning. He liked, as I mentioned in the movie, he liked a wide variety of things. So he was much broader than I was, but I didn't have any great desire to be as broad as he was, and he didn't have any great desire to be as narrow as I. But we had a lot of fun doing anything, and we played golf together, we played tennis together, we did everything together, and this you may find kind of interesting. We had as much fun, perhaps even more to some extent, with things that failed, because then we really had to work our way out of them, and in a sense, there's more fun having somebody that's your partner in digging your way out of a foxhole than there is just sitting there and watching an idea that you got 10 years ago just continually produce more and more profit. So it wasn't, he really fooled me, though. He went to 99.9 years. I mean, if you had picked two guys, he publicly said he never did a day of exercise except where it was required when he was in the Army. So he never did a day of voluntary exercise. He never thought about what he ate. We started every day, and Charlie he was interested in more things than I was, but we never had any doubts about the other person, period. And so if I'd had another day with him, we'd probably done the same thing we were doing the earlier days, and we wouldn't have wanted to know that we only had one day. There's a great advantage in not knowing where you're going to, what day you're going to die. And Charlie always said, that just tell me where I'm going to die, so I'll never go there. Well, the truth is, he went everywhere with his mind, and And therefore, he was not only interested in the world at 99, but the world was interested in him. It's remarkable. I told him in the last few years, I'd never seen anybody that was peaking, at 99 and where the world wanted to come and see him. I mean, they actually wanted to go out to 351 North June Street, and whether it was, well, I could name a whole bunch of names, but just I'll start with Elon Musk, but go down the list, and they all wanted to meet Charlie, and Charlie was happy to talk with them. And the only person I could think of otherwise was the Dalai Lama. I don't know that they had a lot else in common, but it was, he lived his life the way he wanted to, and he got to say what he wanted to say. He, like I, loved having a podium, and again, I can't remember any time that he was mad at me or I was mad at him. It just didn't happen. And calling him was fun back when long distance rates were high, and we didn't talk as often as in recent years as we used to be on daily for long periods. And we did keep learning, and we liked learning together. But, we tended to be a little smarter because as the years went by, because we had mistakes and we had other things where we learned something, and the fact that he and I were on the same wavelength in that respect meant that the world was still a very interesting place to us when he got to be 99 and I got to be 93. So I don't have a perfect answer for you there, but I can tell you the ingredients that would go into, sometimes people would say to me or Charlie at one of these meetings, if you could only have lunch with one person that and lived over the last 2,000 or so years, who would you want to have it with? Charlie says, I've already met all of them, because he read all the books. I mean, he eliminated all the trouble of going to restaurants to meet him or anything like that. He just went through a book, and he had met Ben Franklin, and he really, he was remarkable. He said he really had no one else to meet because he'd read all their stuff, and he liked Ben Franklin's stuff better than he liked mine. But with Ben Franklin, he just had to read about it. They didn't have to go have lunch with him or anything of the sort. But it's an interesting question. What you should probably ask yourself is that, who do you feel that you'd want to start spending the last day of your life with, and then figure out a way to start meeting them or tomorrow, and meet them as often as you can. Because why wait till the last day? And don't bother with the others. Okay, Becky.
This question comes from Carol de Gend in Switzerland, in Europe. And this is for both Mr. Buffett and Mr. Jain. As political instability in the world is growing with a rise in the number of armed conflicts and trade tension, there is also increasing risk of cyber attacks. What are your views on cybersecurity insurance? Asking this question in general for retail, small businesses, and large companies, including critical key infrastructure such as power plants, harbors, airports, nuclear plants, etc. Do you see a potential for profit making in cybersecurity insurances, and what are the key challenges?
Okay, let me start. Cyber insurance has become a very fashionable product these days. over these last few years, it is at least a $10 billion market right now globally. And profitability has also been fairly high. I think profitability is at least 20% of the total premium has ended up as profit in the pockets of the insurance bearers. Now, having said that, we at Berkshire tend to be very, very careful when it comes to taking on cyber insurance liabilities. For two reasons. One is it's very difficult to know what is the quantum of losses that can be subject to a single occurrence. And the aggregation potential of cyber losses, especially if some cloud operation comes to a standstill, that aggregation potential can be huge, and not being able to have a worst case cap on it is what scares us. Secondly, it's also very difficult to have some sense of what we call loss cost, or the cost of goods sold, could potentially be. It's not just for a single loss, but for losses across over time. They have been fairly well contained. Out of 100 cents on the dollar of the premium, losses over the last 4 or 5 years, I think, have not been beyond 40 cents on the dollar, leaving a decent profit margin. But having said that, there's not enough data to be able to hang your hat on and say what your true loss cost is. So in our insurance operations, I have told the people running the operations I've discouraged them from writing cyber insurance to the extent they need to write it so as to satisfy certain client needs. I have told them no matter how much you charge, you should tell yourself that each time you write a cyber insurance policy, you're losing money. We can argue about how much money you're losing, but the mindset should be you're not making money on it, you're losing money, and then we should go from there. So it is good. It's projected to be a huge business. My guess is at some point it might become a huge business, but it might be associated with huge losses. And our approach is to sort of stay away from it right now until we can have access to some meaningful data and hang our hat on data.
Well, you've just heard why Ajit is invaluable, because when you insure something, you really want to think of how much can you lose? And the question, I remember the first time it happened, I think in 1968, when there were the riots in various cities, because I think it was the Bobby Kennedy death that set it off, or the Martin Luther King death, I'm not sure which one. But in any event, when you write a policy, you have a limit in that policy. But the question is what is one event? So if somebody is assassinated in some town and that causes losses at thousands of businesses all over the country, if you've written all those thousands of policies, do you have one event? Or do you have 1,000 events? And there's no place where that kind of a dilemma enters into more than cyber. Because if you think about it, let's say you're writing $10 million of limit per risk, and you decide that's fine, and if you lose $10 million, for some event, you can take it. But the problem is if that one event turns out to affect 1,000 policies and somehow they're all linked together in some way, and the courts decide that way, you've written something that in no way we're getting the proper price for, and could break the company. And I will tell you that most people want to be in anything that's fashionable when they write insurance, and cyber's an easy issue. You can write a lot of it, and the agents like it. They're getting a commission on every policy they write, and you've got to have somebody in charge of things that understands that you may get an aggregation of risks that you never dreamt of, and it may be worse than some earthquake happening someplace just because you have a whole bunch of policies with $1 million limit. And I would say that human nature is such that most insurance companies will get very excited, and their agents will get very excited, and it's very fashionable, and it's kind of interesting. And as Charlie would say, it may be rat poison. Okay, with that cheerful view, we'll go to station 6.
Good morning. This question is for Warren Buffett and Greg Abel. My name is Maria Prenes. I am a retiree from Las Vegas, Nevada. I am here today as a member of Chispa Nevada, a group developed Latin leaders for the environment of justices. I am almost here representing many Latin families in Nevada who are struggling to pay their utility bills and want access to affordable, clean electricity. I want to add today, why is NV Energy, which is owned by the Berkshire Hathaway, building new gas plants instead of investing in solar energy, with Nevada one and the sunniest state in the country? Can I expect to see future leadership take dangerous investments in the fossil levels more seriously? Thank you.
And thank you, Maria. Greg, you want to?
Sure. Thank you. So as we touched on with NV Energy even earlier, there's a lot going on there. And when I think of, there's no question solar's a great opportunity for NV Energy, and we'll continue to utilize it as a resource and continue to invest in it, in that utility and the other utility we have in Nevada. We're also in a point where when you think of a transition that's going on within the energy sector, we are transitioning from carbon resources to renewable resources, as was noted, but it will not occur overnight. That transition will take many years, and as we use, be it renewable resources such as solar or wind, they are intermittent. And we do try to combine it with batteries, but at this point in time, we cannot transition completely away from the carbon resources. So if I think of Nevada, in the next 2 years, our last 2 coal units are, well, actually in the next year, our last 2 coal units will retire, but we are replacing them with a new gas unit, which is truly needed to make sure that system remains reliable and available to our customers, and that's done in conjunction with the state representatives and our regulatory agencies to make sure we can serve those customers every day and every minute. We have great examples in Iowa where at times 100% of our energy comes from wind, and we're thrilled with that. And I believe we hit that, for example, on Earth Day. We had enough wind that we could meet the demand of that state. But the next day, if the wind's not blowing, we need our gas resources, our gas plants to fill that gap. And really, that's the situation we still have in Nevada. So we'll continue the transition to renewable resources, be it solar in Nevada and wind in other areas combined with batteries. But for the foreseeable future, we do see gas being a very important resource to help maintain reliability and meet our customer needs, and to meet it in an affordable way is also an important piece of that. So thank you for your comments.
Yeah, in effect, we've got the capital to do whatever makes the most sense in a place like Nevada and Nevada. I don't know. Each state calls their ruling commission something different, but they probably call it the Public Service Commission or something like that. And they're making the decision as to what they think can and should be done in terms of getting from where a vastly complicated utility business moves towards something different without messing things up in the meantime, and having the lights go off. And I think they would probably agree with you very much, Maria, that where they want to get, but they can't do it tomorrow, because of the intermittent problems. And their job is to make sure the lights stay on, and their job is also to move toward better sources. But solar will never be the only source of electricity, because well, Greg may know more about this, but I'm barring some real breakthroughs in storage and that sort of thing.
Right.
Yeah.
Yeah, generally a battery right now, to do it in an economical way, is a 4-hour battery. And when you think of the time without the sun being available, that's a challenge. Now there's a lot of technology advancements, and that's stretching out, and you throw dollars at a lot of things, you can accomplish things. But the reality is there's a careful balance of the reliability, and also balancing, as it was noted, the rates do matter, and how much customers are paying. So delicate balance of both delivering reliability but doing it in an affordable way.
Yeah. My friend Bill Gates, he's working on shortening up that, or lengthening the time the battery works on. And so you've got some very smart people working on it, but it isn't something that you actually do overnight. And I can understand why people want it done overnight, but it is going to take a lot of money. It's going to take a lot of good ideas and smart people like Bill and Greg, not me. I don't understand why the damn lights go on when I even turn a switch, but those fellows really do know. And there's plenty of them working on it, and we got plenty of money to implement it. But there are certain things that just take a certain amount of time. My daughter hates it when I use this example, but it's really true that you can't create a baby in 1 month by getting 9 women pregnant. I mean, you may want a baby, but so there are certain laws of nature that you have to work with. Okay, Becky.
This question comes from Rich McCloskey in Dunedin, Florida. He says, Warren and Ajit, would you let us know what you think about the car and property insurance situation in Florida? As a resident, both seem out of control. Since the Florida market seems to be so mismanaged, is this an opportunity for Berkshire?
Yeah, the Florida market, both for auto insurance and for homeowners insurance, has had a few tough years. The two problems we face in Florida, and all the risk bearers face in Florida, one is the lawyers and the amount of corruption that takes place in the Florida market keeps skyrocketing, making it difficult for us to price the product and make a profit. And secondly, the amount of activity in terms of storms, both the frequency and the severity, is also so severe that the losses in Florida tend to make it very difficult for a risk bearer to make money. Having said that, we fortunately had a very good run at Florida last year. We increased our exposure in Florida, as we talked about last year, and fortunately nothing bad happened. So a lot of our premiums that were in the top line flew straight to the bottom line. Florida is a large market. Florida is a market that's subsidized by the rest of the country. I don't think that's going to stand the test of time. The Florida market, the legislators are trying to improve it. They have passed law that is bringing down the amount of fraud that takes place in Florida. And I hope Florida will be a fairly buoyant insurance market, because at the end of the day, they do believe in the free market more than some of the other states that have an insurance crisis, like California and New York. So yes, Florida has a problem. Prices will go up fairly substantially. But at the end of the day, I think we'll achieve a degree of balance so that the risk bearers can make a decent profit and will be deploying capital out there.
Okay, station 7, please.
Hi, Warren. My name is Christine Hone Garcia, and I'm from Agoura Hills, California. Thank you for being an excellent teacher and imparting your wisdom to us throughout the years. What advice would you like to share today that you believe everyone needs to hear?
Well, too bad you didn't you added that what the rest of us would like to hear. I would say that if I had one piece of advice, I would try to, well, and you're lucky you live in this country, because it's just to start with, because you've got opportunities here that wouldn't exist in much of the world. But I would like you to really sort of use Charlie's advice of thinking how you like your obituary to read, and then start selecting the educational paths, the social paths, whatever may fit your particular situation in terms of associating. And perhaps, certainly in my day, it would have been marrying the person that would best help you do that. Well, Charlie would say you are offering some similar benefit to the partner, and the opportunity in this country is basically limitless. That when you think of going back not that many centuries, if you were going to be a shepherd or something like that, 100 years from now, your grandson was granddaughter was going to be a shepherd. I mean, nothing really happened. And what has happened in the last 200 years with the combination of the Industrial Revolution, and whether it's science or education or health, or you name it, we are so lucky to be born when we were, the people in this room, and many of us were lucky enough to be born in the United States as well. You're entering the best world that's ever existed, and you want to find the people to share it with and the activities to participate in that fit you. And if you get lucky, like Charlie and I did, you find things that interest you young. But if you don't find them right away, you keep looking. And I always tell students to take the job find the job that you would like to have if you didn't need a job. And sometimes you can find that very early, and sometimes you go through various experiences, but don't forget what you actually are trying to do. And there's no place to do it like this country, and find a person that you like to share your life with in many cases. And sometimes you get lucky and do that early. And sometimes you make mistakes. But I would try to, in a very, very general way, I would try to figure out how you'd want to look back on your life and think about yourself, and start today to go on the path that leads to that goal, and expect some difficulties along the way. But if you're thinking that way, you're more likely to get there. Becky?
This question comes from Axel Meyerseek in Hamburg, Germany. What has changed for Berkshire's operating CEOs since Greg Abel and Ajit Jain became vice chairman? For example, can and do the operating CEOs still reach out to Warren Buffett directly?
Well, that's the answer might surprise you, but they overwhelmingly the operating executives, they prefer to talk to Greg or to Ajit, and that's understandable because I don't really do much, and I don't operate at the same level of efficiency that I would have 30 years ago or 40 years ago. I don't know the managers as well as I would have when we were smaller and when I could get more accomplished in a day than I can now. And when you've got somebody like Greg and Ajit, why settle for me? I mean, basically, so it's worked out extremely well. I almost can't imagine anything working better because Greg in a year accomplishes, he sees more of them, understands more about their problems, can give them suggestions. He's got incredible amounts of energy and nobody has more wisdom than Ajit about insurance, and they've got access in insurance to him. Now, they had it before we stuck some of those titles on in insurance, whereas with Greg, he much expanded things when he became the vice chairman in charge of really everything except insurance. So he is, if you polled our managers that fall under his jurisdiction, which would be a lot of them, they would much prefer to, unless, like a few, they weren't paying as much attention to their business, and I wouldn't do anything about it, but Greg would, and they still like it when he does it. He can deliver news very well to people who, there'll be some people, if you have 20 children and you're very rich, you'll have some that will be go-getters anyway, and you'll have some that won't. And we are a very, very rich company, and we don't, we haven't had a history of being very tough on people that coasted, and we've had some that would do that, and Greg will do something about it, and Charlie and I wouldn't have. Not because we didn't know it should be done, but because we were doing so well ourselves. It just wasn't, we wouldn't make the effort. We didn't want to change our lives that way. Plus we slowed down in various ways physically and everything. So I would say that the number of calls I get from managers is essentially awfully close to zero. And Greg is handling those, I don't know quite how he does it, but we've got the right person, I can tell you that. And with the G, he does less physical moving, and the insurance people are more used to working with the G, obviously, over the years. So I wouldn't say that changing the title really changes much there, because he was in charge of insurance anyway. And, so that's, you can go to a business school and they can give you way better answers than I've just given you, but that's the way we do it at Berkshire.
Steve raised his hand.
Yeah, if I can add a comment. From my perspective, the transition has worked out very, very well. But I think the credit really goes to how Warren has handled the situation. And what I mean by that is, after the transition was announced, and a lot of the operating managers they were used to calling Warren directly on some issue or the other. After the transition, when they would continue to do so, Warren would very skillfully, in his manner, handle them, such that he would not answer what they were looking for, but at the same time made them feel good and told them that he sort of enjoyed hearing from them and talking to them. So as a result of which, the transition took place, people got the message, and were very responsive to it, and it's a non-issue as far as today is concerned.
I'd probably add, the only thing I would add is we do have an exceptional set of managers across both the non-insurance and insurance, and yes, Warren made it incredibly easy, but so did they. It was a very easy transition because they cared deeply about Berkshire, they cared deeply about the culture, and they very much wanted it to be a success, and we're fortunate to have those managers in insurance and non-insurance, so thank you.
Yeah, what Greg is talking about is they really wanted more direction in some cases than I gave them. I mean, I just sat there reading the Wall Street Journal or whatever, and Greg is, there, one way or another, there are more than 24 hours in his day, and I just don't know how he covers the ground he does, but he knows more about the people. We got the same feeling in terms of judging the attractiveness of businesses and making capital decisions and that sort of thing. But he's willing to work. I mean, and I couldn't get as much done anyway. What I could do in a couple of hours, may take 8 hours now. I just don't read as fast and everything. But it's working very well, and this place, if anything happened to me, it would be working extremely well the next day. I don't get any phone calls. You could actually, we can rig something up so we got some answering machine that people think I'm still around, or something. In terms of so anyway, that's much less than you'd learn in business school, but that's the way we do it at Berkshire. Okay, station 8.
Dear Warren, Greg, and Ajit, thank you for having us. Your teachings have not only made us better investors, but more importantly, better people. Thank you for that. My name is Rajiv Agarwal, and I am from New Jersey. I run an India-focused fund called Dudarshi India Fund. My question is related to India. Indian economy and Indian equities have done quite well in the last 5, 10, 20 years. It is the 5th largest economy and will be the 3rd largest in the next few years. My question is Berkshire actively looking for opportunities in the Indian equity market, and what will allow you to buy anything meaningful there? Thank you.
Yeah, well, it's a very good question, and obviously India, I'm sure there are loads of opportunities in a place like India, and the question is, do we have any advantage in either insights into those businesses or contacts that will make possible some transaction that might, when the parties in India would particularly want us to participate. I would say that that's something that a more energetic management at Berkshire could pursue, because we do have the reputation now. Berkshire is known, not like it's known in the United States, but it's known around the world, and our Japanese experience has been fascinating in that respect. So there may be an unexplored or unattended to opportunity in that area. I'm not the one to do it, but that may be something that in the future it might be opportunities. There are opportunities. The question is does Berkshire have some kind of advantage in actually pursuing those opportunities particularly against people that are using other people's money where they get paid based on assets managed or something of the sort. I mean, there are plenty of people in the game who buying and running businesses that do not really have our philosophy. I mean, they're going to get rich no matter what happens, and their payment may be based on how much they buy rather than what they buy. So we'll see how the next management plays the game out at Berkshire, and fortunately you don't have too long to wait on that. Generally, I feel fine, but I know a little bit about actuarial tables, and I just I would say this, that I shouldn't be taking on any four-year employment contracts like several people are doing in this world at an age where you can't be quite that sure where you're going to be in 4 years. Okay. But you're absolutely right about if you were energetic, had some way to become a buyer of or a party that people particularly wanted to do business with. Japan was great, and India could be great, but India and Japan aren't the same. I mean, I don't adapt myself terribly well to different cultures, and some people are really good at it, and almost anybody's better than I am, but I stumbled into one or two, but that could happen in Act 2 of Berkshire Hathaway. Becky.
This is a question from Rafael de Pino from Spain. Berkshire has grown tremendously thanks to, and among other things, its architect, Mr. Munger, and you, its general contractor. We're all tremendously thankful to you for taking us along the way. We are aware that both of you and many others have spent an enormous amount of time ensuring Berkshire's culture provides a solid footing on which to grow the building. You also currently have a very talented bench of what we may label as subcontractors in Mr. Abel, Mr. Jane, Mr. Combs, and Mr. Weschler. However, for a long time, you've had the advantage that talented subcontractors have wanted to work with a once-in-a-generation architect and general contractor. How do you envision Berkshire will overcome the loss of said advantage when the contractor bench needs to be renewed again? And what are potential renovation works in this great building that may necessitate a new architect?
Yeah, well, that's a great question, to which Charlie and I obviously talked a lot about over time. And of course, we will not, Berkshire, to the extent it remains the sort of entity that it is, will not need to attract people very often. It would be absolutely crazy for anybody, for our board of directors, to ever pick anybody to run this business that thought you should retire at 65. It may be that they should retire the next day, when you learn what they're really like managing something, or it may turn that you want to keep them around till they they really start being affected by old age, which hits different people at different times, but it hits everybody eventually. And so it's very likely that if the directors, and it's very tough because they will be acting against conventional wisdom, which is always difficult. And but I think we've got the group on that, and they will not have to make a decision very often. If they pick the right CEO, that's 99% of the job of the directors. And if the other 1% is do you have a good method to correct it if you've made a wrong decision? And that's extremely hard to do in our present system. It's not impossible, but it's just not something that happens. It's too good a job to be a director to try and throw over somebody, particularly if you can use the money from directorships and you want to be on other boards and everything. We do not have a perfect system in terms of boards of directors at all, and it doesn't operate at all. Well, I shouldn't say at all, but it doesn't operate as people may think it generally operates. So we will, we've really got the problem solved for the next 20 years unless something untoward happens. And if something untoward happens, then the directors need to find, probably within our own organization, somebody that they've got confidence in to maintain the special advantages we have over another 20 years period. There's various things that are low probabilities, but you still have to think about them. And we are in that position now. Now, if you asked me if something happened to Greg today, everybody says, don't travel in the same plane. The thing to do is not travel in the same auto. Planes don't go down that often. Autos crash all the time. I've seen all these corporate policies on that, which are kind of crazy when you think about the real risk. But in any event, Greg is going to have to tell the directors about if something happened tomorrow, he has to tell the directors about what should be done if anything happens to him. And that's not an easy thing to do. And I don't have, it will be his decision, and then the directors really have to decide whether he's made the right one, but he will make the right one. And what you really have to hope is that you get lucky on how long managers stick around. I mean, you might need 3 in a century, and you might need 6 or 7. But the answer is you need a little luck, and you need some break in the mortality tables. But we've got an entity that if you really aspire to be a certain kind of manager of a really large entity, there's nothing like it in the world. So we've got something to offer the person who we want to have. It's sort of like Charlie said about marrying the best person that will have you. Well, we've got something that the right person would want to marry, basically in terms of Berkshire. And if we get the wrong person, then the directors have to do something about it. And that probably won't happen, but it's always a contingency, or a possibility, I should say. Greg, having been put on the spot like that, you don't have to name anybody now, but I'm sure the crowd would love it and make news.
Well, the only thing I would add, Warren, is, and it's really how the comment started, was around culture. the culture we have at Berkshire, and that being our shareholders being our partners and our managers of our business having that ownership mentality, that's never going to change. And that will attract the right managers at every level. So I think, as Warren said, we have a very special company in Berkshire, but it's that culture that makes it special, and that's not going to change.
Okay. Station 9. I'm never sure where 9 is.
Hi, I'm Sherman Lam, a Berkshire shareholder, and I work for a family office in Kuala Lumpur, Malaysia. Just really happy to see you, Warren, and the team. And where I come from, you're a hero. And both you and Charlie have positively transformed mine and many other Malaysians and Southeast Asians' lives, not only financially, but also in how we navigate our lives and relationships. Thank you very much.
Well, thank you. That makes us feel good.
Question is, what have your team's greatest learnings been on business, capital allocation, stock picking, and portfolio allocation throughout the COVID-19 pandemic period over the last 5 years? And Warren, appreciate it if you can get your views as well as your representations on Ted and Todd, as well as directly from Greg and Ajit too on their respective businesses. Thank you.
Yeah, I don't think I want to give individual appraisals, what you're doing is in terms of capital allocation, which is my job. I don't go out and sell insurance policies or anything of the sort. And you represent a group of shareholders like we do represent. We are totally clear on our mission. And, it may be that other people don't agree with them, but I would say that in a great many places, I just don't agree with their mission. And, I would say that, for example, that anybody that wants to retire at 65 would be disqualified from being CEO of Berkshire. Then they might get retired the next day if they were the wrong person. But there's just certain things we don't want, and we're well fixed now, and that the odds are very good, but far from certainty. That takes care of the next 20 years. Now, but you have to provide for the contingency, and there's several people on the board that know what I would do on that, but it's up to Greg. But if Greg and I go at the same time, then you'll move into making another decision, and there are a few people that know my thoughts on that, but the job of the directors is then to come up with the right CEO, and the right CEO can't make a terrible business great. Tom Murphy, he was the best business manager I've ever known. And Tom Murphy, he said the real key was buying the right business. And now Murph brought a million other attributes to it after that. But, as Charlie, said, what was this? He had a saying on that. But basically, we could have brought in Tom Murphy and told him his job was to run the textile business, and it would have done a little bit better. But it still would have failed. And one of the reasons I stuck with the textile business as long as I did was that I liked Ken Chase so much, and I thought he was a terrific guy, and he was a very good manager. And if he'd been a jerk, we'd have quit the textile business much faster and we'd have been better off. But so the answer was for him to get in the TV business like Murph had done and ad-supported. Murph figured that out early, and he started with a pathetic operation, which was a VHF in Albany, New York, competing against GE and everything, and he was operating out of a home for retired nuns, and he only painted the side that faced the street. He had one car dashing around town, and he called it news truck number 6. But from that, he built an incredible company, and he built it because he was the best manager I've ever met. But beyond that, he was in a good business. And the key will be to find another Tom Murphy and then hand him a bunch of good businesses, and he or she will know what to do with it. Now, that's not as precise as you would get in most companies, but you really can't get more precise than that. I mean, you can have committees and management consultants and everybody, but it wasn't a management consultant that hired Tom Murphy, and I forget whether he was doing, his sales volume was a couple thousand a week at first, and then as soon as he hit, that was his goal, or he got to 2,000, he says, now my goal is 3,000, and he kept doing that, and he surpassed all these people like CBS and ABC that had the world by the tail. And it was just a wonderful lesson in life to get just to be able to view something like that. I learned an awful lot from what he said to me, but I just learned by watching somebody like him operate. I mean, it's like watching a great golfer, a great tennis player, and you ought to learn something about the kind of swing you're trying to develop or something of the sort. So that's not a great answer for you, but it's so far it's worked, and I think it works. I'm very sure it works with Greg, and it's up to people in the future when, I'm underground or wherever they put me, to really make a decision every 20 years or something like that on average. It's the right decision, but correct it if it turns out to be the wrong decision. That's what a board of directors is for, and we've got the people on the board that really understand that responsibility. They take it seriously, but they don't take themselves too seriously. And so therefore they don't necessarily want to do a lot of things just to look busy. And they aren't using us as a stepping stone to get on other boards. But we've got people that really believe in what we're doing, and they're the ones that are going to have to make this place work. And if they got lucky on Greg's mortality, they can do just what Rip Van Winkle did and go to sleep for 20 years or so, and then make another decision. And Berkshire has every tool in the world available to be what it is now and continue to be what it is now. I mean, we've gotten from 20 million of net worth to 570 billion, and there aren't as many things to do, but we can do a few big things better than anybody else can do. And there will be occasional times when we're the only one willing to act. And at those times, we want to be sure that the U.S. government thinks we're an asset to the situation and not a liability. or a supplicant, as the banks were, we'll say in 2008 and 9. They were all tarred with the same brush. But we want to be sure that the brush that determines our future, is not tarred. And I think we're in I don't think anybody's got a better position to do it than Berkshire. Becky?
This question's from Johan Halen, who writes, you're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that, but prefer it. But we only swing at pitches we like, and if anybody tried to swing at every pitch, or felt that because they hadn't swung at a pitch for the last two pitches, they ought to swing at the third one or something like that. There are times, and obviously, but I would say this, I would not like to be running 10 billion now. 10 million, I think Charlie or I could earn high returns on, because I think there are just a few things that happen on a very, very small scale. But if we had 10 billion, I wouldn't basically see many more opportunities than we found. Now, it's true that something like Japan we could have done if the company had a 30 or 40 billion, and we'd have had great returns on equity. But if I saw one of those now, I'd do it for Berkshire. It isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do. Okay, station 10.
Mr. Buffett, this is an incredible meeting that you host every year. My name is Sean Cawley. I am a real estate agent with Berkshire Hathaway Home Services in Arizona and California. My mother, Cindy, my brother, and my two sisters all sell real estate with Berkshire Hathaway Home Services for many years. We love being a part of the Berkshire family, and along with the 70,000 other agents that sell real estate for the company. Mr. Buffett, Home Services of America recently settled our class action lawsuit regarding commissions for $250 million last week. This dollar amount's about $100 million more than Keller Williams, $166.5 million more than Anywhere Real Estate, which is Better Homes and Gardens, and Coldwell Banker. As a realtor with Berkshire Hathaway Home Services in multiple markets, and a shareholder who's been coming to this meeting for 15 straight years, that's one of the reasons I got involved with real estate, is because of this meeting. What are your thoughts on buying and selling a home in light of this recent settlement? And I'd maybe ask the note to Greg and Ajit too. Would you consider a Berkshire agent when buying your next home?
Well, I don't buy them that often, as some people have noted, but I certainly would consider them. But I'd say the probability of that happening is low. And I really appreciate the fact you've joined up with us. But I'm going to, in terms of the settlement, I mean, Greg kept me informed, but I turned it over 100% to him. So, Greg, you want to talk about it?
Sure. So thank you for you and your family for being an agent and working for our company, Berkshire Hathaway Home Services. I think there's a few questions in there. One, there's no question the industry will go through some transitions because of that settlement. Ours and every other major player in the industry settled. The National Association of Realtors settled for more than $400 million. So effectively, everybody was swept up in that settlement. And it did set the grounds for both home services and for the industry to move forward. There's a lot of changes that happen or are being proposed associated with that settlement. But the one thing that I think you hopefully would absolutely agree with, the real estate agent is still an important part of these transactions. It's the one time in our lives where we make these massive investments, and having that counsel and guidance is critical. And that's really what our business and those other businesses rely on. How the commission structures change and how it's negotiated, which is really what the settlement was. It was no longer that a buyer would automatically pay a commission agent to the selling agent. That now has to be negotiated. That'll impact things, but I think the realtors will continue to be a very important part of that, and I think home services in the industry will remain very relevant. And then the only thing I would share with our shareholders on a broader basis is that obligation resides with home services and can be met by home services. And that was an important condition because they were also pursuing Berkshire and Berkshire Hathaway Energy, and we said, you can pursue us separately, but that settlement will reside with home services and be an obligation of that. And they decided the ultimate settlement, and we'll go forward from there. So, Warren, any other comments?
Well, yeah, I've sold 2 houses in the last 93 fraction years, and I've bought one that I still have, but I obviously bought the other 2. And I have not negotiated down the commission, even though the last one sold for $7 million or something like that. People do negotiate down commissions to some extent, but I can tell you, I've looked at the figures, and I think the system has really worked out very well. When I got out of school, they had what they called FSBO, with for sale by owner, and so I've been involved to some degree in watching the whole system operate, and I know what our average agent makes. I know how long they work on things sometimes that don't materialize. I mean, I don't think we'll end up with a better system, and but it's up to Greg and the people at Home Services how we work it through here. But I like our agency group, and we've got a very large number of real estate agents, and I've encouraged the expansion we've done in the real estate brokerage business. It was just 1 or 2 operations when we bought Berkshire Hathaway Energy, and we really built up quite a company, and I think it's a very fundamental business. You need help. 90% of the people need help, in buying a home or selling one, and I've watched it operate all my life and been involved with lots of people who have been in the business. But there was a decision in court, and I told Greg to handle it whatever way seemed best to him, and I'm perfectly happy with the way we've handled it. I think I'm surprised at the decision, but we get surprised in decisions in the insurance business lots of times. I mean, just think of the various things we faced, and when 9/11 came along, we never thought something like that could happen, but it happened, and then we didn't know what was one event or more events. I mean, if they closed down the New York Stock Exchange and a bunch of brokers, well, all kinds of people lose their jobs or lose their income for a while. Is that one event or multiple events? Well, there's all kinds of things come up in business, and we just we play the ball wherever we find it, and I was surprised by the decision. Was it in Missouri?
Missouri, yes.
Yeah, but we've gotten surprised by some other decisions, and we'll keep doing sensible things as we move forward. Greg, do you want to?
No, I think the only thing I would add, back maybe to how the model has changed, and he asked, one, yes, we'll always, I can't speak for Ajit, but we'll always use home services agents, but it's interesting, I have bought a home abroad, because I lived over in the United Kingdom, in Newcastle, running our utility over there, and it is a completely different experience to buy a home outside of the U.S. Our agents take great responsibility for the whole transaction in the U.S. They put, as Warren said, time and capital at risk to ensure the transaction closes, and when you do close it, they make sure what you bought, what you thought you were purchasing, you end up with. And that's not the way it is always around the world. And there are more affordable models, but it's the old saying, you get what you pay for. So I think our real estate agents still provide incredible value within our business. And as Warren touched on it'll survive. The form may be a little bit different, but there's no question it'll continue to thrive.
Yeah, we still will want to buy real estate brokerages at the right price, and I hope we're bigger in the industry 10 years from now and 20 years from now than we are currently. And I did sell a house for $7 million. And I did not negotiate the 6% down, and I feel I got my money's worth and then some. And I'm cheap by nature, so it isn't I'm careless about it. I got my money's worth. And so let's move on to Becky.
This question's for Warren and Ajit. It's from Jeff Oyster. As a Berkshire and Tesla shareholder, I would like to hear your thoughts on the potential financial effects to Geico, assuming Elon Musk delivers on his fully autonomous driving goal. On Tesla's most recent earnings call, Elon said, if you've got at scale a statistically significant amount of data that shows conclusively that the autonomous car has, let's say, half the accident rate of a human-driven car, I think that's difficult to ignore. Assuming Elon succeeds in reducing accidents by 50% versus human drivers, wouldn't auto insurance rates fall to reflect the reduced underwriting risk, thereby adversely impacting Geico's revenues and float and perhaps margins too?
Well, yeah, well, let's just take the extreme example. Let's say there are only going to be 3 accidents in the United States next year for some crazy reason that anything that reduces accidents is going to reduce costs, but that's been harder to do than people have done before. But obviously, if it really happens, the figures will show it, and our data will show it, and the prices will come down. There have been a lot of people talk about doing that in the past. I mean, General Motors used to be very big in the insurance business, and when Uber first started, they used some firm which now is, I think Ajit will confirm, they're close to bankruptcy now, aren't they, because of taking things on at the wrong prices? Is that true? Yeah. Insurance always looks easier than it is, and it's so much fun because you get the money at the start, and then you find out whether you've done something stupid later on. But it's a very tempting business when somebody hands you money and you hand them a little piece of paper. But really knowing whether if accidents get reduced 50%, it's going to be good for society, and it's going to be bad for insurance companies' volume, but you know, good for society is what we're looking for. So far, this you might find kind of interesting. I mean, the number of people killed per 100 million passenger miles driven. I think it actually when I was young, it was like 15, but even post-World War II, it only fell to like 7 or thereabouts, and Ralph Nader probably has done more for the American consumer than just about anybody in history, because that 7 or 6 has now come down to under 2, and I don't think it would have come down that way without him. There have been some kind of fluke figures of what people did during the pandemic, which are quite interesting, because they didn't drive immediately. They didn't drive as many miles, but they drove more dangerously, didn't they?
Yeah.
Is that right, Ajit?
Yep. Yeah. So the point I want to make in terms of Tesla and the fact that they feel that because of their technology, the number of accidents do come down, and that is certainly provable. But I think what needs to be factored in as well is the repair cost of each one of these accidents has skyrocketed. So if you multiply the number of accidents times the cost of each accident, I'm not sure that total number has come down as much as Tesla would like us to believe. Tesla has been toying with the idea of writing insurance directly or indirectly, and so far it hasn't really sort of been much of a success. Time will tell, but I think automation just shifts a lot of the expense from the operator to the equipment provider.
Okay, we're getting close to noon when we're going to break for lunch. I just want to tell everybody that I would appreciate it very much if they will get in their seats and be ready at 1 o'clock when we reconvene, because we will have another very short little movie, and we'll just have a little explanation of something that I think will be of interest, certainly of interest to me, but so I would like to, we will break promptly at 12, and I would like everybody to really make an attempt to be in their seat and quiet at 1 o'clock. And if you can't do that, if you'll wait a few minutes and watch in the halls, all that, but we do not want to be seating people and have people milling here at 1 o'clock. And just like a play in New York or something, it'll take a few minutes, and only a few minutes to cover what we're going to at 1 o'clock. But we don't want to be seating people during that period. But now we'll go on till 12 o'clock, and then we'll have a break until 1 o'clock, and we will go to Station 11.
My name is Humphrey Liu, and I am from Charlottesville, Virginia. I asked a question last year and wish to pose it again. It can be considered a follow-up. There is something to be said for traditions. It is the same question, but it is a changing and different world we are in. Looking at global trends, it increasingly does seem that zero-emission vehicles may have finally reached the cusp of massive adoption. Do you see any opportunities in this space, either in specific vehicle manufacturers or in related technologies? As an addendum, I will note that Berkshire has very relevant interests in energy, Pilot Flying J, and BYD. Thank you.
Yeah, well, we will. I hope you're right. And massive adoption has been sort of a moving target so far, but I hope we get there. But Berkshire would not be, I don't think that we bring any special talent to that field. You've got vehicle manufacturers, and I would certainly not know how to pick the winners in an industry like that. But I'll be delighted if there are some winners. But don't count on us foreseeing who the winners will be, and don't count on us for predicting when something will happen. It obviously has been a moving target so far, and it is an incredible problem that society faces, and it may be that governments are not very good at solving it for a while. All of climate change it's got a terrible problem just in the fact that, that the United States particularly has been the one that's caused the problem the most, and then we're asking poorer societies to say, well, you've got to change the way you live because we lived the way we did. And that really hasn't been settled yet. It's a fascinating problem to me, but I don't have anything to add to how you really slice through the world. When I was born in 1930, there were just essentially 2 billion people in the world. Population statistic. Now there's 8 billion. Now, if you'd asked anybody in 1930, if you take the 50 smartest people in the world and you said, what's the optimum population for the world? And when you're 93 years old, they would have not said 8 billion. There wouldn't be anybody who would have been close to it. But we did it. Now, we're reaping some of the consequences of having done that. And we got the benefits in the United States. I'm exaggerating here to some extent, but the developed world basically got it, and then we're telling a whole bunch of other people that we want them to change the way they live because of the way they lived. We lived the way they lived. So we will see what happens with it, but that's a problem that is very, very, very hard to solve among a couple hundred countries, and I really don't have anything to contribute on it. And now I've got instructions from the thing, the monitor in front of me. I would like to introduce one person here that has, you all know because she's been here so many times, but my friend Carol Loomis, who is now, well, she's going to be 95 on June 25th. You can send presents care of our office. And Carol has edited the Berkshire annual report. Since 1977, there we are. And there are 2 points I'd like to mention. Every year, I give Carol a little item for a bracelet that is a replica of the front page of the report that year, and they're different colors and all of that sort of thing. And so she now has, since 1977, 47 of them, and I think she's put 10 on each one, but I've always wondered, if she put them all on one arm, whether one arm would now be 4 or 5 inches longer than the other. But I'm sure she foresaw that. But I want to reveal one other. I want to ask one more question while Carol was here, because I'm sure most everybody in this audience grew up like I did, knowing that Ty Cobb's lifetime batting average was 367. I mean, he's the leader among everyone. And it may be that record is never broken. And Ty Cobb, 367's immortal. But Carol has a distinction that probably most of you don't know, but she dated Ty Cobb. And Carol was officed at 6th Avenue and 50th Street in the Time Life building. And NBC was right across the street in Rockefeller Center. And the quiz shows became the hit of TV. And Carol, being the kind of person she is, walked across the street at lunchtime and went on the quiz show of the late 1950s. And they gave her the questions regarding baseball. And Carol answered them all correctly. Of course, she was encyclopedic on all kinds of things, but so she knew all the answers. And she proceeded, and she was single at the time, and she proceeded back to her office at Fortune, and at some point she got a phone call from, sounded like a fairly young man in Georgia, and he said, "My uncle is Ty Cobb, and he would like to take you to lunch at 21. And so Carol went to lunch with Ty Cobb at 21, and I think he subsequently had one more lunch, and then she decided to call it off. But those of you who follow baseball may have noticed that in the 1990s, they found that the statistics had been faulty when Ty Cobb played, and that he actually only batted 366. That there were a couple of at-bats they didn't count. So the real question I want to know from Carol, and I think she should maybe tell us, is that would she have dated Ty Cobb if she not? I mean, I know she wouldn't have. I know she wouldn't have dated Ty Cobb if his batting average had been 300 or something like that. But where was the cutoff point at which she would have told Ty Cobb to stay in Atlanta and forget about coming up to New York? And if Carol would, if anybody has a microphone, Carol would care to express herself on that question. It's the unanswered question that I've had and all inquiring minds have had, and only she knows the answer. And she's with her daughter. She married a wonderful guy, John Lewis, and Barbara's with her. I'm sure Barbara's been always wanting to ask this question, but it's kind of tough when you're in the family. But I'm sort of a non-obnoxious guy who'll do it in front of a lot of people. Carol?
0.
Or we can have Barbara's guess. Either one will.
She would have been happy to go either way, right? She would have gone. So, thank you.
Carol. Carol is the best business writer. She comes from a town of Colcamp, Missouri. You know, I don't know the population is around 1,000 probably. She never took an accounting course, and she ended up becoming the best business writer in the United States. And she didn't want to be an editor, actually. I mean, she could have done other things at Fortune, but she just plain liked writing business stories. And like I say, nobody came close to her, and she started from scratch. But in 1977, I asked her to edit my report. And she turned out to be just as good an editor as she was a writer. And all the way through this year, including this year, Carol has edited the Berkshire report. And to the extent that anybody enjoys reading them, let's give a hand to Carol. Okay, and I've been told to show a video right before you go to lunch because it's only 30-some seconds, and then we'll talk a little bit more about it when we come. So if we'll dim the lights, we're showing what a Berkshire shareholder did when she sold us $1 billion worth of stock the other day, and you'll meet somebody that I know she is the prototype. She may have more zeros, but she's the prototype of a good many Berkshire Hathaway shareholders, and it'll be the first thing we talk about when we come back. But some of you may have noticed, whenever it was, a few weeks back, when Ruth Gottesman gave $1 billion to Albert Einstein to take care of all the, and Ruth doesn't like a lot of attention drawn to herself, but here's how they felt at Albert Einstein when they announced that Ruth Gottesman had just made a decision to take care of all of the costs of education at Albert Einstein, and it's going to be in perpetuity. So let's just show the film.
I'm happy to share with you that starting in August this year, the Albert Einstein College of Medicine will be tuition-free.
And that's why Charlie and I have had such fun running Berkshire. She transferred $1 billion to other people. She happened to do it with Berkshire stock. And they offered to rename the school after her and everything like that. But she said, Albert Einstein, that's a pretty good name to start with. So there's no ego involved, nothing. She just decided that she'd rather have 100 plus, closer to 150 eventually, students be able to start out debt-free and proceed in life. And she did it happily. And she did it without somebody asking, name it, put my name on all four sides of neon lights. And I salute her. So let's all have lunch and we'll come back and talk a little bit more about that. Thanks.
Welcome back to CNBC's special coverage of the Berkshire Hathaway shareholder meeting. I'm Mike Santoli live in Omaha, Nebraska. After taking questions for almost 3 hours, Warren Buffett has called a lunch break, promising to be back on stage in 1 hour. We have a big hour for you right here. Becky Quick is heading back over to join us, and we will also speak live with Berkshire board member Ron Olson, Hummer Winblad co-founder and managing partner Ann Winblad, Benjamin Moore chief Dan Calkins, and Graham Holdings CEO Tim O'Shaughnessy. You'll also hear from other Berkshire managers and a special guest, Warren Buffett's sister, Bertie. In the morning session, Buffett, along with Vice Chairs Greg Abel and Ajit Jain, covered lots and lots of topics, from the rationale for the company's recent sale of Apple shares to how high the cash pile at Berkshire will likely rise, to the need for more analytics at Geico, and Warren's 2 cents on AI thrown in there as well. He also admitted that he's starting to slow down just a touch. He said, quote, he doesn't get any phone calls anymore, and maybe it is not the time for him to take on any 4-year employment contracts or other agreements. Let's start with Apple and what sounded like a rationale for why Berkshire sold a chunk of its shares: taxes. Buffett said selling shares this year, Berkshire paid a rate of 21% on the capital gains. He sounded as if he expects taxes are going to go up because the government, of course, is not going to stop spending, but will need more money to tackle rising deficits.
One thing that may surprise you, but almost everybody I know pays a lot more attention to not paying taxes than I think they should. We don't mind paying taxes at Berkshire, and we are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And the government owns, the federal government owns a part of the earnings of the business we make. They don't own the assets, but they own a percentage of the earnings. And they can change that percentage any year. And the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give. And I think that higher taxes are quite likely, and the government wants to take a greater share of your income or mine or Berkshire's, they can do it.
And just to put some numbers on that Apple sale, it was about 13% of Berkshire's holdings, something like 120 million shares, 115 million shares. So the gain, the total proceeds, let's call it $20 billion, would have paid, $5 billion-ish in 21% tax rate on that. So it seemed as if he was kind of softening perhaps the reasoning behind the Apple sale, saying there's no real fundamental change in his view of the company. He said he fully expects it to continue to be Berkshire's largest holding. He also said he didn't mind building some cash right here, and of course there is a lot of it that had piled up, about $183 billion total at the end of the first quarter. He basically projected that it would likely get to $200 billion or so by the end of the current quarter. That's probably just, as cash comes in, and he's not redeploying it very quickly, and they're earning obviously very handsome yields on that, 5%.
That's what I thought was one of the weirdest things was. That's what I actually thought one of the strangest things was. He said that he did this because he didn't mind building up the cash hoard at this point because of the environment that's taking place. I guess the economic environment, the stock outlook. I mean, I tried to pull a little more out of him later with another question, and he didn't bite on it. But what are you going to do with all that cash? Why do you need all that cash? He says he can't find good places to put it, and that makes you wonder if he thinks the entire market's overvalued.
Yeah, that's the obvious inference, although I guess you have to think of it as, what would he put new money into that gets over that hurdle of 5% T-bills?
5.4%, yeah.
And also maybe that is big enough for him to feel as if it's interesting or material to the company.
Although he also said that he'd keep it in those T-bills even if it was 1%. Don't tell the Federal Reserve. Yeah. But the hurdle is, you got to get more than 5% that you can earn in treasuries in a very safe environment. But I still don't have a great sense of whether he thinks the market is just overvalued or whether it's hard to do things when you're that big and you have that much cash.
Yeah, he clearly doesn't mind to have the financial cushion building up. Has never minded that. I also feel as if, and he doesn't pay attention to just exactly where the stock is trading or anything, but it's not as if the market is penalizing Berkshire Hathaway for having $200 billion in cash.
Right.
I mean,
right.
it's gotta, it's trading at a good premium to book value. The value seems to be recognized at the underlying businesses. There's nothing really impelling him to do much more. The other piece on the Apple side of it is, the American Express and Coca-Cola holdings are all profit. It's all on paper gain.
Yeah.
So you could, if you were selling something because you think taxes are
You'd have
going
a big
up, you'd
tax
only
bill.
sell something you think you might eventually sell
Right.
and pay higher taxes on, which,
Right.
Apple, again, the position got very big and the stock was up 40+% last year.
I'm just looking at the market. Again, we'll try and get something else out of this because the shareholders don't mind to have a big cushion of cash. It's great if you can be opportunistic if there are bad things coming or opportunities that pop up down the road. But there are a lot of questions about dividends, too, and I think we'll get into that in the second part of things. It's a question that we get every single year here. Why don't you pay a dividend? I'm retired. I don't love having to sell my shares to do some of these things.
Yeah.
Is there the possibility for either a regular dividend or a special dividend at some point down the road?
Yeah, it's definitely a question that's going to get louder. Obviously, people are looking toward whatever policies might change. Of course, so much of the conversation is what happens after Warren is no longer in the role. And in fact, I'm interested in your impressions of several times he's sort of gesturing toward he's kind of slowing down a little bit. The managers seem to call Greg and Ajit more than they do him directly.
Although I thought Ajit's answer was brilliant in that he said, it's because Warren would talk to them and say nice things to them, but he wouldn't let them basically do a runaround.
Right.
Which I can think of a lot of managers that would be good news
But he also said, I'm no longer as efficient as I used to be. And when he had the question about, investments potentially in India, he said, I'm sure there's great things to do there. Maybe a more energetic management would find them. So he's being self-deprecating, of course. But I do think that that's something that is building in the conversation.
Yeah. Okay, Berkshire's insurance portfolio took up a lot of the time in the morning session, and Ajit Jain, Berkshire's vice chair of insurance operations, did spend some time addressing one of Geico's issues. That would be data analytics.
This has been a disadvantage at Geico for a few years now. We are trying to still play catch up. Technology is something that is unfortunately a bottleneck, but there again, we are making progress. And equally importantly, we have hired people who are much better than what they inherited in terms of data analytics and pricing and slicing data. So, yes, I recognize we're still behind. We're taking steps to bridge the gap, and hopefully, certainly by the end of 25, we should be able to be along with the best of players when it comes to data analytics.
Hi, guys.
Right now, we want to bring in Berkshire Hathaway board member Ron Olson. He is seated with us right now and ready to take some questions coming straight out of this. Ron, look, this was a pretty Berkshire-intense series of questions that shareholders sent in, just really getting to the heart of how Berkshire operates. And I think in a post-Charlie world, and eventually post-Warren, I think there were very pointed questions that came from shareholders on those questions. You're on the board, you discuss this all the time. What were you thinking?
I was thinking how smart our shareholders are. The questions were right on. I mean, these are the questions, I guess I would say that the board has asked and want to ask. And they've sharpened every year, the commitment of these shareholders, their ownership, adds to the value of the company. And I thought that's what came out of today's discussion. And Warren and Greg and Ajit's answers have been sensational. Do we miss Charlie? Absolutely. Nobody's going to have quips like that like the movie reviewed. But the substance was, I think, better than ever. It was just great.
And just actually, we haven't mentioned it here yet, just about the way that Warren kind of characterized this as the company that Charlie designed. He being the architect, first of all, incredibly generous for somebody in Warren's position to essentially give that kind of credit. But I guess it also suggests, because of all the questions are about what are you going to do to make sure this place stays the same as it is, it shows you that it's not like there's any big problems or challenges that the next person seems to have except for preserving it.
Well, I think yes, stay the same as it is in the fundamental culture.
Structure, yeah.
But he also has underscored that Greg, Ajit, the next group of leaders of this company are going to be their own people, and they're going to make judgments that they have been empowered to make. And will they be different than Warren and Charlie? Perhaps, but they will all, in the end, have a base of the fundamental culture that this is a company owned by people who have an ownership interest. It's a company that wants to be around forever. And we want to have the opportunity to take advantage of the special advantages we have, such as $180 billion of cash. I could go on and on about the culture, but these, Ajit, Greg, they own the culture as much as Warren has.
Hey, Ron, one of the advantages that Berkshire has is the ability to move very quickly in times of opportunity, times of uncertainty, market displacement. And that's in large part because Warren Buffett has been able to make decisions the average CEO would not be able to make. He can choose to spend $30 billion and check with the board kind of as an afterthought. Will Greg have that ability to move so quickly in times of chaos or in times of opportunity?
The board is as much aware of what Warren's ability to move quickly has made, how it's made the company unique and better. We're not going to slow that down. Decision making, and let me say about Greg, I recently had an opportunity to work very closely with him in the very disappointing pilot dispute that we had. This is a person who is strategic, who has the ability to make quick and solid judgments. And the board wants him to make those. You know, the unique deference the board's had to Warren is special, no doubt. And will there be changes? I don't know. You know, we will take it a step at a time. But getting in the way of quick decisions, And, you know, from my perspective, we want quick lawyering. We had that last deal with Allegheny put together in 10 days. And that's the way Berkshire operates. It's not complicated. It's simple.
You mentioned, the deference that the board does pay to Warren. Implicitly, the investors, the shareholders, defer to Warren on capital allocation, and we were talking about the dividend situation. And of course, he's always said, we're going to create more returns, more wealth by me allocating that capital internally than just distributing it out as cash. Do you think that will be the case under the next regime?
Let me say this. I think it's been the case, and I think it's been the right way to go because, frankly, as a shareholder, I'm a lot richer from that, in effect, forced savings. Going forward, will there be an opportunity to deploy the capital in a way that will continue? That'll be a judgment that Greg will make. And will there be the possibility of dividends? I don't think anybody's, ruled that out. Sure. Frankly, I learned something today. I had forgotten that there was one dividend payment made early on.
The 10 cents. When Warren said he went to the bathroom.
Right. He wouldn't have made it today, I guarantee you. No. But, I think we will have opportunities. But as Warren and Charlie have demonstrated, patience is an incredible asset. And they have had it, and I think Greg will have it. He's not going to go out and willy-nilly throw that money.
Very quickly, Ron, the biggest issue probably facing Berkshire at this point, outside of any of those, is the legal liabilities associated with Berkshire Hathaway Energy. You're a lawyer. You know this stuff inside out, the legal liabilities that exist with that. And Warren really pointed it back to Pacificorp and what might happen in a state like California or Oregon.
with regulatory overreach potentially, or oversight, and legislative changes. What do you do on that front?
It's a very real risk. There are multiple causes for the great losses that are being experienced in the fires in the West and elsewhere around the world. And there's no way under the current system of allocating those damages basically 100% to the utilities that can survive. These are issues that have to be recognized by the regulators, or there will not be investor-owned utilities. And I think that is something that I was pleased to hear a little bit more about Utah today, how they've recognized it. You know, the United States government recognized it when nuclear power first came into being, and they created a special insurance for excess losses. Will that be done nationally or perhaps state by state? You know, that's yet to be determined. But I hope we have leaders, governmental leaders, who recognize this is a serious issue if we want to keep the power, dependability, reliability that I think the private investor-owned entities have had. And frankly, as Warren said, I believe investor-owned utilities can be more efficient than government-owned utilities. But somebody's going to have to carry it, and it can't, for long, be just the utilities.
Ron Olson, Berkshire board member. Thank you, Ron.
Thank you.
Great to see you.
Good to see you.
In his 2024 annual letter, Warren Buffett described his younger sister, Bertie, as his perfect mental model when he is writing these letters. She's the reader that he pictures when he's writing to shareholders. I got a chance to sit down and speak with Bertie Buffett Elliott right here in Omaha about her big brother.
He's been with me my whole life and still is. And there are not many of us in our generation left now, so that even makes it more special. But even without that, you know, he's the one that has always been there, and in a way, he's my big brother, and he's protected me or always helped me if I needed. And he's, for length of time, you know, my biggest ever, and still is, emotional support.
Warren pointed out in the annual letter that you are a really smart, savvy investor, that you're somebody who reads many newspapers every day, you have an opinion about financial issues, but you're also somebody who is a very smart investor in her own right, that you, something like 45 years ago, you kind of decided to take all of the other things that you were trading, and what happened? You put everything into Berkshire for the most part.
Well, I figured out that Warren was better at it than I was. That was easy. I mean, it sounds so simple, but you know, that's just what happened. And I thought, this is ridiculous. You know, he is so good. And it was a little, the hardest thing for me, and I think it's hard for a lot of investors, is that Berkshire Hathaway doesn't pay dividends. And I was at a place in my life where I wanted some dividends, you know, and Warren said, well, you just sell stock, you know. It's like, sell stock, you know, no, you can't sell principal, you know, whatever. I didn't say that to him, you know, because I just listen and do what he tells me to do. So anyway, but once I got over that hump and realized, well, that's wonderful. You know, I can decide when I declare a dividend. I can declare one for myself, you know, in its essence, by selling some stock. And, you know, once that didn't stop me from doing it, but I had to get used to that emotionally, but I did pretty fast.
And he said, then you made that change and then you did nothing. Like, the patience.
And there were a lot of times along the way, because I had a brokerage account, and people, you know, who were brokers or this or that, or wanted money to start something or whatever, you know, approached me about that. But luckily, I didn't even have to think about it much. I mean, I knew I was all in with Warren, and still am, and all the way.
So you and Warren have always had this wonderful relationship. He says you all have never had a fight, but he does say that there are some competitive streaks.
Oh, yes.
What comes to mind when you think about competitive games or issues with Warren?
Well, when we played Monopoly, and I was really little, of course, and he was a little bit older, but I remember this so distinctly, but I was so happy because I had this money and I was saving up the money in little piles in front of me. But as I noticed as the game went on, I was landing on more and more properties, and then they had houses and hotels. Pretty soon all my money was gone. And I realized too late that it was a better strategy to buy property than hoard the money. But my joke with him about that is, and we laugh about it because it is actually a joke, but that I trained him to be a winner, because since he was winning all the time playing against me, that he owes his great success to the fact that I trained him to win. And he loved it so much he just kept going. But that's a joke.
It's good work, Bertie. Thank you so much for taking the time to talk with us.
Yeah, well, it's a pleasure. And I just want to say one thing, because many people ask me about Warren, when they find out about him and stuff. And to me, he's always been my big brother. He's my big brother. I know he's this tycoon and stuff, and I sort of know that in my head, but that has nothing to do with my reality. He's my big brother, and he's always been a wonderful big brother, and I love him, and I feel so lucky that he's my big brother.
Again, that was Bertie just talking a little bit yesterday. She's his younger sister. She's 90 years old, and she went back and talked about how they were always very competitive. She lost nearly every single time, but she's got another great story that maybe we'll talk about later or on the podcast, where she finally beat him in bridge.
In bridge.
A few years ago, back in the 90s. Not just a few years ago, but back in the 1990s. And she has a very funny story about how he handled that. We'll try and get into that at some point, too. But she's the type of investor he thinks of because she moved everything 45 years ago or so into Berkshire and sat and has done nothing since. And it's that patience that you hear preached about again and again here, the willingness to do nothing and sit with what makes most investors uncomfortable and uneasy, to not be moving and not be running around. It saves you money from the tax perspective rather than jumping in and out of stocks. And that patience has been what's paid off, certainly for long-term shareholders.
And the fact that that's the ideal reader he has in mind when he writes his letters explains why he's mostly just using that to reinforce the message that people presumably have absorbed over the years. So I'm going to guess maybe Buffett doesn't like to lose, Warren? Is that going to be
He did not, and
the punchline?
he didn't behave very well, you're right.
Okay. Excellent. Well, the Monopoly stuff was great, too. Well, we are now joined by noted tech investor Ann Winblad. She's the co-founder of Hummer Winblad Venture Partners. Good to see you, Ann.
Good to see you, too.
So, we were, I guess, just remarking the morning seemed to go nice and smoothly. Warren seemed to be on his game. What were your impressions?
The energy was really high in the room, and in an event where you thought it might start out softer, but Warren was on his game for sure.
He again was asked about AI and basically said, don't really know how it works, not an expert. Seems like it might have some dangers. Maybe it's going to foster a new golden age of scamming. I guess he was introduced to an AI version of himself. How are you thinking about it, though, just in terms of the way the investment flows have been so massive, but mostly on the hardware side, at least initially, and how are you thinking about exploiting it?
Well, the investments have been pretty high on the software side as well. I mean, we have at least 3 to 4 large platform vendors that on their earnings calls, with the exception of Apple, talked about AI quite substantially and how this wave is really important to their future products and their future customers. So we really are seeing that as part of the digital economy. This meeting is interesting because it sort of ignores the digital economy, with the exception of Apple, which is presented to everybody as a consumer brand.
That's why you're such a unique character, and you've been coming to this meeting for a very long time. You're a VC investor. You look at growth stocks. You are interested in what's happening in the lands of technology, and yet you're here in this value investing bubble. And I just wonder, having a foot in each camp, what you take out of this weekend and what you kind of think from the Valley perspective at the same time.
Well, I'm originally from the Midwest, born and raised in Minnesota, so I am a Midwesterner. So at my heart, I probably am a value investor. The message to take away here is that we're all playing the long game. And that's really important to consider right now in technology. When you get to Silicon Valley, you get excited about the short game. What do we do today, tomorrow, what's right in front of me? Warren talked about a couple things where the deal flow he has is enormous, and he mostly says no. We're in the business of saying no as well. Our job is to audition the future, and at the same time, our job is to build products that serve customers. And many of our U.S. customers and global customers are right here at this conference. So it really gives you a feel of the customer to be here, as well as this concept that is more than a concept. It's really a core strategy that we're all playing a long game.
So your job, you feel like, is to say no most of the time, too. I think that's interesting because a lot of people look at what's happening in Silicon Valley and they say, oh, it's just buying a bunch of lottery tickets and figuring one of them will hit. You sound like you do things very differently.
I think true venture capitalists really are in the long game. They really are looking for technology change. They can sit on the sidelines and not do deals. They build investors in their funds who really understand that we're really looking to build substantial companies, not to flip companies or sell them, but we're really there to build value and long-term value. And we're really part of an industry. We're a focused investor. We are only software, although software is almost a $600 billion industry in the U.S. alone, about half the size of our largest industry, banking. So there's a lot going on at all times, but very few choices that will turn into large companies.
If the, I don't know, couple dozen companies that are represented here as Berkshire subsidiaries, if they were each a public company, and most of them could be, they would all have an AI strategy, or they would be talking about an AI strategy. They're talking about how they're going to basically be able to take advantage of it. How are you viewing that in terms of the application? Because when I said before that it's mostly on the hardware side, you know, Amazon, Microsoft, Meta, Google, they are absolutely more software players, but they're building data centers and they're acquiring a lot of hardware to do what they want to do.
Yeah, this wave of technology, AI, is more capital intensive than the cloud, which was more capital intensive than software before it.
True.
So it seems that each wave is requiring more integration into hardware and semiconductor technology, NVIDIA being the benefactor first here. But it really is the software that makes it magic, and the software and the chips, and the software in the data center, and the software on those platforms. Back to what these companies are doing, it was interesting, the discussion of Geico just catching up on the analytics wave. It's going to be very, very challenging for companies that are behind on the previous waves to catch up here, because this wave eclipses data analytics. It's not AI, it's generative AI. So we really do see fast-moving innovation here, which is an opportunity for those who can be extremely agile, have technical skills embedded in their company, really know how to integrate this into value for their company, whether it's productivity gains or new products, will end up ahead of the game.
I think we're going to actually hear what Warren had to say about AI when he was asked about it.
If I was interested in investing in scamming, it's going to be the growth industry of all time, and it's enabled in a way. Now, maybe, you know, obviously AI has potential for good things too, but I don't know how you, based on the one I saw recently, I practically would send money to myself over in some crazy country. I do think, as someone who doesn't understand a damn thing about it, that it has enormous potential for good and enormous potential for harm, and I just don't know how that plays out.
So clearly that's the case. Enormous potential for good and harm. Do you feel as if there's any kind of consensus gathering about how we might manage the risks here?
I think that's starting to gather. It's really not going to be through regulation because that's too slow, and this is moving way too fast. But I do think we'll see more industry coherence in this case, on this particular wave of technology, of how to limit the bad actors. Because this is a powerful tool for good, as Warren said, and Bad actors have caught on to digital technology some time ago, and the better tools we provide ourselves, the better tools we provide the bad actors.
Even if you can control it and have industry consensus within the United States and maybe even some of the Western countries, it's a different story when you know places like China are digging into this and maybe they have a different viewpoint of some of those things, or some of the bad actors to be able to pick up on that. How do you stay ahead of it?
You can't. So this is why we also invest in security companies. So what happens in the investment strategy here is you see the platforms first. You then see probably a couple application companies emerge like Salesforce did in the cloud. But around it, we build the picks and shovels of security. Those are great investment opportunities for us. And we really start getting ahead of it, even at the coding level. What's embedded as companies are coding. These are the first set of companies that are being invested in that help the software that's being developed not have malicious stuff embedded in it. But that's the only way to do it, is to use innovation to combat innovation.
And great to see you. Thanks a lot.
Thank you.
We were here on the floor of the convention hall yesterday, and it wasn't just Warren Buffett who was touring through the booths of the Berkshire companies on Shareholder Shopping Day. We caught up not only with Warren, but also with the actor and shareholder Bill Murray, who had a surprise role in an annual Berkshire Hathaway tradition.
Every year, when March Madness comes around, we have everybody at Berkshire can enter a tournament to pick out, fill out their bracket. Right. And the winner this year got $250,000. And it's limited to people that are on our payroll on our March 1st of the year. But this year, I invited 2 more people to participate in this affair. And today, I want to report the results. We
got some results. We got some results. Here we go.
Let's go to the scorecard.
Yeah, you open that up. I'll hold your jersey. You hold your jersey.
And we go to the scorecard, and there were approximately 64,000 employees of Berkshire that entered the contest, and the winner got $250,000. And Becky, I am happy to report, she finished 29,488. Wow. So she was slightly above average. Wow. But Mr. Murray, who has a son that is dynamite in UConn and knows basketball and all that sort of thing, but he came in 54,399.
Wow.
So,
wait,
not only was
talk where you came in.
I came in about where Becky
No,
did.
he beat us both.
Well, I didn't want to be beaten by a girl, frankly. But I knew I wouldn't be beaten by Murray.
They went on to talk a little bit about it. He was referencing Bill Murray's son,
Yes.
Luke Murray, who's the assistant coach at UConn, which has now won the national title 2 years running. And they went back and forth about that, but Warren had some very nice things to say
I
about
hope
Luke Murray,
Bill
too.
at least picked UConn to win, even
He
though
did.
he didn't do well otherwise.
No, he explained it. He actually had his bracket folded up in his pocket. He's been carrying it around. It was completely creased. He explained that the reason he did so poorly is he basically didn't put in any team he didn't like. So it was the teams he wanted to win, not the ones he thought would win.
So
But he
UConn
did
got
pick
the path to the
Yeah.
final, but everything else
kind of
doing
fell by
with
the
his heart.
wayside.
Yeah, well, I have a brother who's a UConn alum who was very thrilled with all that and with Luke Murray. All right, if you've watched the Berkshire meeting before, our next guest may be a familiar face. She's been attending this meeting since she was 7 years old and asked a question here when she was just 8.
And why specifically have you invested Burlington Northern instead of buying a capital-efficient company like American Express?
You're killing me, Daphne.
I'm certainly glad she's not 9 years old.
Yeah.
She's taken the mic a few times since then. CNBC producer Katie Kramer is live on the showroom floor with Daphne and her dad. Katie.
Thanks, Mike. Yes, Daphne Kalir-Starr is here. She has been a Berkshire Hathaway shareholder for more than half of her life at this point. Daphne, tell me about your plan this morning. What time did you get here in line today?
Well, we got here later than usual.
our goal is usually around like 12:30, but we slept in. We got here at 3
a.m.
Yeah, and it was a mad dash. And so I think we camped out. The doors opened at 7. It was like 3.5 hours. It was intense.
And what happens when the doors open? You went straight to a mic position?
Yeah, it's a stampede. I left my backpack with my dad, and I sprinted to get seats. And then I saw the mic directly above me, and I was like, okay, this is it.
And how'd you do this year in the lottery? Where's your position?
You know, I got fifth speaker, and so it doesn't look like it's going to happen this year.
But you've not only asked a question when you were 8 years old in 2018, but you've asked how many times? 4?
4. I've been really lucky.
What's your process about how to come up with a great question?
Well, I don't know about great, but I usually sift through current events. My first year, I had a question beforehand because I had read The Snowball, and then my dad gave me some investing lessons. But every year since, I've tried to do something topical. So this year, I wanted to do something about the national debt because it's become a really big issue now. So,
do you help Daphne at all writing the questions?
I don't help in the writing. At the end when she's done, like she's written it out, I invite her if she wants to practice it once before she actually does it, because we discovered, she learned the first year that like there's an echo with the mic, and so it's just helpful for her to have.
It really threw me off, the echo.
Yeah, it's helpful for her to have practiced it once if she knows she's going to say it. So that's my role.
Yeah, you're a really scary audience too. You're like, your hands are crossed and everything.
So it's a tough job to be a shareholder. It's a tough job to do something like this when you're so young. But you're going to come back next year, right? You'll be out there in line again.
I really hope so. Yeah.
Sarah, great. Well, guys, thank you so much, Daphne and Erez. And we're at the Squishmallows booth here, which has been the other crazy line in addition to the shareholder line outside this morning. But lots of stuff to do here on the floor during lunchtime, and we'll cross our fingers for Daphne. She's at position number 5 for Mike 3. Maybe we'll see you next year, though.
Yeah, thank you.
Thanks, guys. I'll send it back to you.
Katie, thank you. And you can tell Daphne not to worry. I have seen a lot of other questions that kind of came into that same idea. She's not the only one who's thought that this is a really rich area, just the U.S. debt and deficit. So you might get that question asked whether or not she gets to be the one who reads it. Again, it's amazing to see Daphne here after so many years, and to be that lucky, because it's not easy to get a position at the mic.
No, well, they're here at 3 a.m. instead of 12:30.
Yeah.
So that might be why.
Well, the other thing I'll say is there was a guy who the very first question I asked was written by a shareholder who later made his way to one of the microphones and asked it. And that's the first time I've ever seen somebody able to get 2 questions in at once. I was like, what? When I heard the guy say his name, I'm like, I know that name.
Crack the code.
Yeah. All right. Joining us right now is Tim O'Shaughnessy. He's the CEO of Graham Holdings, whose operations include educational services, television broadcasting, auto dealerships, and hospitality companies. And Tim, it's great to see you today.
Wonderful to be here.
I know you've been coming for over a decade. I think it's even longer than that. It's been a very long time that you've been a regular visitor here. And you're somebody who is thinking of Graham Holdings as you're trying to model it as a baby Berkshire. You like to find interesting companies that maybe other people haven't found yet. I know you take all kinds of trips to out off the beaten path places to find those companies. What did you hear today as somebody who's been here for a long time and as somebody who is trying to take that same sort of investing approach?
Well, I thought there was a lot of focus on cash and the importance of making sure that the cash balance at Berkshire continues to be strong. I thought that being part of the reason for selling down some of Apple was pretty fascinating. 21% tax rate versus 35% working into that. And if you look at the opportunities from the equity markets and what else is happening in the world, wanting to be more comfortable with a cash balance, I mean, that was something that stuck in pretty hard when it's already at 180 billion and going to 200 billion. You know, that's not necessarily where you would think to start.
And we were having a conversation about that right at the beginning of this this half hour or whatever we're doing, this hour right now. To me, I thought, holy cow, does he see a really big potential problem coming where he can be opportunistic, or does he think stocks are overvalued here? I was kind of running through those scenarios in my head. What were you thinking?
Those were the same scenarios that were going through my head. It really seemed like there was an emphasis on, you know, it's not really attractive right now, and there's a lot going on in the world that could be kind of problematic, and the opportunities that could change in a hurry, and I want to have a lot of cash to do it.
A perennial theme, of course, of his remarks and before that of Charlie's remarks is sort of like knowing where your competence lies and staying within it. And multiple times he sort of lets things go by and says the whole parts of the world maybe are not a place where Berkshire has a particular advantage. Talked about India in particular, why Japan was an exception to that, why China maybe isn't a place that's that fruitful right now. But just more broadly, in terms of that idea of like having some kind of a narrow expertise and then, kind of parlaying that into what comes next, how does that apply to what you do in your various verticals?
Yeah, it's Warren has this idea of a too hard box, and that's one that I steal as well. There's a lot of things that just don't make any sense, and there are many people much smarter than the people like me that work at Graham Holdings, and so we put a lot in the too hard box. But you look at Warren's framework of insurance is narrow as a vertical, but you have to understand a lot about the world. And that building up that framework that can exist, so when you do see something that comes across and it makes sense because it goes into your pre-existing framework, one of our businesses is the largest producer of fire retardant wood in the United States.
Of what wood?
Fire retardant wood.
Okay.
It's called Hoover Treated Wood Products. It's one of those companies that's off the beaten path that you never would have thought of, but it's really important societally, and you kind of realize, well, the world isn't going to want buildings to be more combustible in the future. So that wasn't a real hard one to figure out if you could understand the business dynamics pretty well.
All right, tell us about another big fat pitch, something that you felt was really in your field of expertise.
Yeah, well, we've really gone and built some large businesses in in-home healthcare. And once again, you really had to think about, well, what does society want? Hospitals want to have post-acute care occur at home. People would rather recover at home. Yeah. Payers would rather have lower cost treatments happen at home. So if you think about those, what are those societal trends, and then how can you go build off of it? So we have a company at this point in time that is all about providing in-home healthcare services, whether it's with nurses, physicians, assistants, et cetera. And that's the type of thing that you can see, well, that trend probably isn't going to change. And you don't have to be, you have to be a genius to figure out that that's something that the world is going to want more of 10 years from now than today.
What's the company, and do you own it outright?
Yeah, so it's called Graham Healthcare Group, and it's in home health, hospitality, infusion services, actually even things like in-home Botox, esthetician services. And there's a lot of things people will be willing to do at home at this point in time.
And at this point, I mean, the big opportunities are usually also, though, not a secret, right? So everyone knows kind of the demographics and, even the employment trends. You look at the jobs report every single time. It's, healthcare, a big hiring area. So how do you kind of, I guess, play an advantage, or maybe it's just scale?
Well, I think it's thinking a little bit about the things that aren't going to change as well. Healthcare is 17-18% of U.S. GDP. It's probably going to remain that for a while. And so really just kind of figuring out where are the niches that you can understand within those big sectors is something that I think can be pretty important overall.
Tim O'Shaughnessy. Tim, thank you for being with us again.
It's good to be with you.
From Graham Holdings. Great to see you. Right here on the convention center floor, shareholders can shop from all of these Berkshire businesses that are here, that have set up camp. We've shown you a lot of booths over the last couple of days. And at the start of the morning's Q&A session, Buffett mentioned some pretty eye-popping numbers. See's Candies brought along a record 6 tons of candy. I mean, that's what he said, but I'm pretty sure the See's CEO said it was even more candy than that. I think they got those numbers wrong. I think it's quite a bit more than that they brought along. They do expect to sell out. The bookstore, by the way, the bookstore that's here and usually sells 20 to 25 different business books that are related to Berkshire Hathaway. It's only selling one book. That's Poor Charlie's Almanac, the 4th edition. Hundreds and hundreds of copies sold yesterday. They brought 5,000, and I bet they sell out of those books, too. And Dairy Queen is expected to sell over 20,000 treats. We're talking dilly bars, I think, is most of it. We've seen dilly bars and maybe, what else do they have down there? Maybe that's the
there was somebody hawking,
creamsicle?
Is it called a Buster Bar or something?
Yeah.
I don't know them.
We're not the
But
ones
I
who
hear
have
about
eaten
it.
as much of them, but we've been seeing them because they're right next door. I spoke with the heads of some of those companies, and we got the chance to talk through some of those numbers also. Here's what they had to say.
In our categories, it's been challenging, and the industries that we face flooring, furniture, appliance, electronics, they definitely have had their challenges, and you can read all the public reports. It's just consumers having a challenge, inflation, housing's down, and so we just have to figure out a way to grow and to figure out a way to take share.
Yeah, and I guess that's a big part of it too. With mortgage rates so high, people don't want to move out of their homes. They want to hold on to their 3% mortgage rate, and that means that people aren't moving, which would spur more buying too.
Exactly right. Exactly. There's just traffic in general is down, and but there's always a silver lining like this weekend at Berkshire, because it gives us the opportunity to really do great things and give the customers great values, and it's like Christmas time and Black Friday, so this is a great week for us.
What are the bright spots just in terms of categories that customers might be more willing to buy right now? Things they maybe aren't as tapped out on.
Appliances is doing fairly well, but again, it's driven by a replacement cycle now versus new construction. And there's certain furniture categories that are doing, mattresses are still doing very well. But I would say in general terms, there's not any of the industries that we're in that are positive as an industry.
Overall, I think the consumer is feeling healthy, but that doesn't tell the whole picture. There are certainly areas where the consumer is kind of tapped out. What are you seeing right now?
I mean, I think the consumer is definitely showing some resilience. I think consumer confidence has remained high despite all the indicators in the economy that might say otherwise. But there are beginning, I think, to be some pressures on consumers. I think the inflationary environment is taking a little toll, especially at the lower income levels. Across our customer base, I think we see some price pressure, very price sensitive, discount sensitive, especially in the lower income groupings. So we are seeing a little bit pressure on average ticket. So we're seeing healthy shopping trends. Fortunately, jewelry resonates even in tough times. People still get engaged and still have big milestones in their lives. So I would say it's kind of mixed. I mean, we're a little bit cautious as we look to the balance of the year with so much uncertainty in the global environment.
Sure.
And in the U.S. with the election year, who knows what will happen. So we're being a little cautious as we look forward, but overall our business is doing pretty well and the consumer is kind of hanging in there.
When the consumer feels some of those pricing pressures, do they trade down? And do they trade down for things like engagement rings, or do they just trade down for the other gifts that they're buying?
We're seeing trading down kind of across the board. We're not seeing that so much, I would say, at our higher income customers, but at lower income for sure. It's kind of interesting in our business, there is some deflationary pressure right now in the engagement space because of the market dynamics with lab-grown diamonds.
Oh, yeah.
So that's a contributor a little bit, I think, to the downward trend, but people are definitely buying down kind of across the board.
Where do things stand right now just in terms of commodity prices, what you see? Have prices come back down? Is it a lot easier to manage through this stuff now?
We've seen prices absolutely moderate, since the COVID peaks. And we look to bring value every single day to our customers. So our products are typically a very small component in that final finished, bottle that you would buy. So we just look to bring value to our customers every day.
What were you guys prepared for when you showed up with us? How much did you bring?
We brought 11.5 tons, and we also brought a little more merch this year. So we've got a candle, we've got t-shirts, we've got a couple of other things that people have been asking for the last few years. And so we want to take care of our customers, and we brought a lot more product this year.
You anticipate you'll sell out?
We do, yeah.
11.5 tons.
We do. And anything that's left over, we're actually going to reach out to a food bank here and donate what's left instead of trucking it back to California.
Wow.
Yeah.
Okay, that's a lot. What's the most popular thing that you sell?
It's always the peanut brittle and the staples. And particularly this year because we put a sleeve on the peanut brittle with a wonderful quote from Charlie. And so, yeah, that's going incredibly well. And the Berkshire box that has a picture of Warren and Mary on it as well. So those are flying like crazy.
Yeah, because peanut brittle, that was Charlie's favorite. He ate it through the entire meeting.
Yeah, so we have an animation of Charlie on the front of it leaning on some peanut brittle, and kind of had to give him the tip of the cap.
Okay, this is your home crowd when you're here.
Yeah. Fans all over the place. Yeah. I mean, our shops are always filled with people who love the brand, but this is different. These are our owners.
The most important driver in our business is new home sales. And so, with interest rates being high, inventory levels being low, and affordability of housing being upwardly moving, it's been a slower time over the last 12 to 14 months, I would say. And so it's a big driver because think about it, when somebody goes to sell their home, they usually fix it up, do a little bit of painting. They sell the home, somebody buys it, they go in, they repaint what they didn't like about the old owner's taste. So it's really 2 paint projects every time an existing home sale happens. And so as that slows, driven by interest rates, it definitely impacts our business.
Well, the afternoon Q&A session just moments away. Let's bring in CNBC.com markets reporter Yoon Lee for more on the day's events so far. Yoon, great to see you.
Thanks. Great to see you, too.
We've gone through this continued selling down of the Apple position by Berkshire Hathaway. He gave a nod in the direction of maybe there were some tax considerations. Any clues in what you heard from Warren about whether he's looking to redeploy some of this cash?
Yeah, so I think he seemed a little bit more in the mood to deploy more cash. And we heard him talking about this, the fact that he's looking at one thing in Canada. And, you know, he was very vague about it. We don't know if it's private or public, but just the fact that he's looking and overseas is very interesting. Now, he's invested in Canada before, a couple years ago, buying a mortgage underwriter just a few years ago. And as things get more expensive in the U.S., he started to look more overseas. And we know he's been very successful with his Japan bet that paid off very, very well.
And of course, there's also this undisclosed position that seems to have been building.
Yeah, there's a lot of speculation as to this secret holding that he's been buying, or it could be one of his managers. Berkshire has been buying for the past 3 quarters straight. And we know it's something in the bank, insurance, or finance sector, and it is in it's in a couple $1 billion, so it is very significant bet. And that we don't know that yet. I hope somebody asks that question in the afternoon.
Yeah, exactly. I mean, pretty hard to think he would actually name it, but who knows? You never know. What else in terms of, obviously a lot of attention on succession questions, both for Warren and even for Ajit Jain. It was a very specific question about, you know, what happens to leadership in the insurance division after that.
Yeah, and also about the equity portfolio, because I've been talking to shareholders here on the ground, and they asked me, you know, what's going to happen to Berkshire's top holdings like Coca-Cola, American Express, and Warren said, you know, firstly, Apple will extremely likely to continue to be the largest position, and when Greg takes over, they will still have Coca-Cola, all the long-time holdings that Berkshire's had.
Sure. I think we do have a little bit of what Warren might have said, some of these indications that maybe things are sort of slowing down on his side for now.
One way or another, there are more than 24 hours in his day, you know, and I just don't know how he covers the ground he does. He's willing to work. I mean, and I couldn't get as much done anyway. You know, what I could do in a couple of hours, you know, may take 8 hours now. I just don't read as fast and different things. But it's working very well, and this place, if anything happened to me, it would be working extremely well the next day. I don't get any phone calls. You could actually, we can rig something up so we have some answering machine that people think I'm still around, you know, or something in terms of.
Yeah, and then, you know, as we were saying before, he even was saying in reference to the idea of there being opportunities in India, he sort of said, well, maybe some other management team might have the energy to look into that stuff.
Yeah, it's something that, because he said Berkshire has built this reputation as this prominent deal maker and investor, but something in India he might not have the energy to do anymore, different cultures and so forth. But in terms of Japan, it worked out very well, and he's apparently looking at Canada.
Yes, in response to a question, he did point to that a couple of times. Also really a little skeptical about potentially doing more in China at this point as well. And, you know, I guess just to circle back to the Apple thing quickly, he seemed to take pains both by talking about taxes and also saying it's an even better business than Coca-Cola and American Express, to suggest that he hasn't necessarily reassessed the business in terms of its long-term value.
Right, and he said one of the bigger motives is tax reasons, but at the same time, when you look at Apple, the stock was getting very expensive, right? Last time I checked, it was trading 27 times forward earnings, and it rallied almost 50% in 2023, and now it slowed down a little bit. There was also lot of concerns about China demand, also antitrust issue. I don't think it gets talked about enough. So a lot of issues. We didn't hear that from Warren himself, but it's interesting that he did reveal the tax reasons.
Yeah, well, Tim Cook was in the audience.
I know.
It seems like he didn't
It's a
want to
little bit
say
tricky.
a whole lot more about that. He also said he would love to buy back more Berkshire stock, but it doesn't trade enough. Maybe it's
Right.
also a little bit expensive.
Yeah, they bought back about $2.6 billion in the first quarter, a little bit more than Q4, but in line, yeah.
Yeah. All right. Yoon Lee, great to see you. Thanks so much. We have been talking about the first morning Q&A session of the Berkshire Hathaway annual meeting. We are now going to start and go to the other afternoon session Q&A. Warren Buffett is going to be taking questions again, those that have been vetted by Becky from shareholders as well as directly from shareholders who have come from all around the world. We heard that in the morning. We also did close the morning session with kind of a moving tribute to Ruth Gottesman, who has used $1 billion in an appreciated Berkshire Hathaway stock to make a donation to Albert Einstein Medical College, of course, as we all know. Q&A now getting underway.
More chance we'll have to talk about various questions you may have. I'd just like to follow on, however, with that film we showed just before we left for lunch, because it says something about Berkshire. There are all kinds of public companies and wealthy public companies and throughout America. And there are certainly cases where in one family somebody has made a very large amount of money and is devoting it to philanthropy, or much of it to philanthropy, such as the Walton family would be the number one thing in Walmart. And certainly Bill did the same thing Bill Gates did the same thing at Microsoft. But what is unusual about Berkshire is that a very significant number of Berkshire shareholders located all over the United States, not just in Omaha, but the number of different Berkshire holders who have contributed $100 million or more to their local charities, usually with people not knowing about it, I think is many multiples of any other public company in the country. It's not more multiples than Bill's put a whole lot into philanthropy and I don't know the details of the family, but clearly there's a huge sum of money that the Walmart family, I'm sure, has done all kinds of things philanthropic and will continue to do it. But I don't think you'll find any company where a group of shareholders who aren't related to each other, so many of them have done something along the lines of what Ruth did a few weeks ago, just to exchange a little piece of paper that they've held for 5 decades, and they've lived well themselves. They haven't denied their family anything, but they don't feel that they have to create a dynasty or anything, and they give it back to society. And a great many do it anonymously. They do it in many states. To some extent, we see some concentration of it in Nebraska, because they generally, when you're giving away a lot of money, they call it, in the philanthropic world, they call it absorption capacity. And the truth is, it's very hard to give away $1 billion $10 at a time to people who are needy or something of the sort. And so large institutions have this absorption capacity, which tend to be universities or colleges or that sort of thing. And some philanthropies are much more imaginative than others. But the one thing most of them want to do it anonymously, so I can't tell their specific stories. But I have to say, one thing that was astounding is that the same day we bought $1 billion worth of Berkshire Class A stock from Ruth, so that, and I guess we were actually buying it from the school at that point, because he's just given them and then so the transaction was with them. But Mark Millard in our office bought $1 billion from them, but he also bought $500 million worth of stock from somebody else that nobody will ever have heard of, and in a different state, and I won't elaborate beyond that. But we have had a very significant number of people, and there's more to come. And obviously they had to be people that came in early, or their parents did, or their grandparents did. But they've all lived good lives. They haven't denied themselves anything. I mean, they have second homes, but they generally, well, in fact, I would say almost universally, people knew them in the community and everything, but they've used what they accomplished, what they saved. They denied themselves consumption themselves. That's what savings are, is consumption deferred. They've financed everything all over the country, and usually they like to do it anonymously. I outed my sister when I wrote about her in the annual report, but Bertie's here today, and I told her she should wear a T-shirt or something that said "No solicitors allowed" or something. But they just do it, and it's really both Charlie and I felt it's really fun to work for a group of people like that, rather than for index funds or for hedge funds or whatever it may be. I mean, you're just seeing what people actually, it sort of restores your faith in humanity, that people defer their own consumption within a family for decades and decades, and then they could do something like enable I think it may end up being 150 people to pursue different lives, and talented people and diverse people to become a dream of being a doctor and not have to incur incredible debt to do it, or whatever may be the case. There's a million different examples, and I want you to know that you're a unique, actually, group of shareholders among public companies, as far as I know, in terms of the way you've deferred your own consumption while living fine to help other people, and it takes a lot of years, but it can really amount to something very substantial. And what Ruth did was, at roughly my age, she looked at a little piece of paper which actually was a claim check on the output of others in the future, and she said, instead of the output being for her, that the output would be for a continuing stream of people for decades and decades and decades to come, that were having a different life in the pursuit of becoming doctors than they otherwise would have. And Berkshire has been, of course, her husband Sandy contributed substantially to Berkshire's record. Sandy was a wonderful partner to have, so there was both input by him, and then there was deferred consumption by his family, and then there was ultimately this final gift to Albert Einstein, and like I say, the same day, there was only $500 million. It'll go to him in a different way, but it's happening all over, and I don't think any companies like that. So I just want to tell you that it's inspiring to work for a group of shareholders. And Becky, go to it.
All right, the next question comes from Slavin Vukobrot. As CEO, will Mr. Abel be in charge of the portfolio of common stocks that Mr. Buffett has been managing, or will this function be exercised by Mr. Combs and Mr. Weschler?
Yeah.
As investing could be defined as the discipline of relative selection, can major capital allocation decisions such as large acquisitions be separated from the common stock selection process?
Yeah, I would say that decision actually will be made when I'm not around, and I may try and come back and haunt them if they do it differently. But I'm not sure the Ouija board, I think, will get that job done. So that job, I'll never know the answer on whether it get covered, but I feel very comfortable about the fact that it will be made by a board that they've got loads of brain power, they've got a dedication to an unusual institution, and they will figure things out. But I would say that if I were on that board and were making the decision, I would probably, knowing Greg, I would just leave. I would leave the capital allocation to Greg, and he understands businesses extremely well. And if you understand businesses, you understand common stocks. I mean, if you really know how business works, you are an investment manager. How much you manage, maybe just your own funds or maybe other people. And if you really are primarily interested in getting assets under management, which is where the money is, you don't really have to understand that sort of thing. But that's not the case with Ted or Todd, obviously. But I think the responsibility ought to be entirely with Greg. The responsibility has been with me, and I farmed out some of it, and I used to think differently about how that would be handled, but I think the responsibility should be that of the CEO, and whatever that CEO decides may be helpful in effectuating that responsibility. That's up to him or her to decide at the time they're running the money. But so I would say that my thinking on that has developed to some extent as the sums have grown so large at Berkshire. And we do not want to try and have 200 people around that are managing $1 billion each. It just doesn't work. I think that when you're handling the sums that we will have, you've got to think very strategically about how to do very big things. And I think Greg is capable of doing that. I think I've missed a lot of stuff in the past, so I'm actually wiser about doing that now. But I would do it better this time around than 2008 and 2009 if something akin to that happened. But it won't be exactly like 2008 or 9. You can be sure of that. But you also can say that there will be times when having huge sums available extremely quickly, maybe it'll be once every 5 years, maybe it'll probably be more like once every 10 years or something. But as the world gets more sophisticated, complicated, and intertwined, more can go wrong. And there's no sense going through here and exploring the possibilities of the different things that could happen. But you do want to be able to act when it happens, and I think the chief executive should be somebody that can weigh buying businesses, buying stocks, doing all kinds of things that might come up at a time when nobody else is willing to move. It wasn't that people didn't have money in 2008. It's that they were paralyzed, and we did have the advantage of having some capital and a willingness to, an eagerness even to act, and a government that in effect looked at us as an asset instead of a liability. And I think that all of those qualities will be even more important as our capital pile grows. And so I think Greg may have even more fun than I had in a period when extraordinary things were happening, and we were the logical place to go. You never know whether it'll be next week, next year, next decade, but it won't be a century from now, that is for sure. The more intertwined and sophisticated the world financial situation gets, the more vulnerable it gets in a certain sense. It solves a lot of small problems, but it leaves it more vulnerable to large problems. Greg, does that bother you at all or not?
Without directly answering the question, I think there's one important thing is I think as we go through any transition, it's important to know that the capital allocation principles that Berkshire lives by today will continue to survive, Warren. And I think that's what the thing I'd want to communicate, that we have our operating businesses, insurance, non-insurance. We'll provide them the capital necessary to be successful and grow if it's appropriate. Yep. At the same time, we're expecting a return of capital from them when they have excess cash. And then, as we've discussed, or you've touched on, always looking at potentially new businesses as a whole or in a piece. And as you've always highlighted, and I fully agree, we'll always look at equities as we're investing in a business, either 1% or 100%. But we're looking at the business, we're looking at the economic prospects of that business and how sustainable it is and what it will look like 10 years from now, and is the capital we originally put in at exponential risk, or where's that risk sit, that profile? And then, of course, and then we'll obviously have our continue to always put excess cash in the safest investment there is in U.S. Treasuries, knowing we want to maintain that fortress of a balance sheet for two reasons. One, to act, but also to always protect our shareholders. If we want to maintain the position Berkshire is in now, realistically, to ensure it endures.
Well, when he says that, it makes me wish I'd stayed around to be number 2 instead of number 1 in this process over the years. It doesn't get more fun than what we're doing, and we're better positioned than ever before. We're not positioned, though, however, to earn extraordinary returns versus what American business generally earns. I would hope we could be slightly better, but nobody's going to be dramatically better over the next century. It gets very hard to it gets very hard to predict who the winner will be. And if you look back, as we did a few meetings ago, as to the top 20 companies in the world at 10-year intervals, you realize the game isn't quite as easy as it looks. But getting a decent result actually should be reasonably easy if you just don't get talked out of doing what hasn't worked in the past, and don't get carried away with fads, and don't listen to people who have different interests in mind than the interests of our shareholders. Okay, we'll go to station number 1.
Hello, Mr. Buffett. My name is Tomo Dröge. I'm from Düsseldorf, Germany. This is my first time out here in Omaha, so thank you for having us here today. So my question is directed to you, Mr. Buffett and Mr. Abel. In 2019, you reportedly made a bid for the IT distribution business, Tech Data, and commented that you understand its role as a middleman. I wonder if you could kindly elaborate on the criteria you look at when evaluating IT distribution businesses like Tech Data and their competitive position. Thank you.
Well, we had some experience with distribution businesses, and we know their potential to a degree and their limitations. And Greg, you were involved in that more than I was. So that was a case where there'd been a bid made, and there was a go shop provision, and I think the management probably would have preferred that we buy it. And when we went in with a better bid, the original party raised their bid, and we never make the same offer twice. So, Greg, tell them about it.
Yeah, so absolutely. In 2019, we saw Tech Data as a unique opportunity when we saw the other bid and the underlying value of that distribution business. We did, Warren and I were talking, and others made the conclusion we should talk to management. We talked to the team. They were very interested in Berkshire being their long-term owner. And we still saw good value in the opportunity. And we had a good understanding of distribution businesses. We have TTI. It's not exactly identical to Tech Data in that they're very specific to who their customers are and who they serve and supply and who they purchase from. Because on the distribution side, it's important to have that input coming in from folks you want their product and you know it's needed on the other side, that there's demand for it. And they had an excellent model. If you think of TTI, for example, Warren's talked about Paul many times and the person who founded this business, but it's a unique business in that our revenues on that business is approximately $10 billion. The average part they sell is a little over 9 cents. 95 billion parts go through their warehouse every year. But it's a model that if you have the right people on both sides of the equation and you understand that well, there's a unique opportunity there. And that is something we saw in Tech Data. And as Warren highlighted, we made our bid. Unfortunately, it was then topped by the original bidder, and we moved on. But we thought very highly of it.
Yeah, we've probably seen at least 5 of them in aggregate that over the last 3 or 4 or 5 years. It's not a business that you can dream about because it's a decent business, but for example, many of the items that the manufacturer they don't want to tie up their capital. You tie up, if you have, 1 million plus SKUs, as they call stock keeping units, it's like selling jelly beans or something like that. And you're serving a purpose to a degree, but you don't really, it isn't your product in effect of it. I mean, you're just a good system for the producer of the equipment to get it to the end user without tying up a lot of capital and being in a business they don't want to be in. And so we understand. But there's no magic to it. There was with TTI, you had a marvelous man running things, and he's when you get a marvelous person running something, to some extent, that selects for better people underneath. And Greg and I went to Paul Andrews' funeral a few years ago, and there were 300 people or so there, and there wasn't one person that had to say something particularly nice, but stretched a little bit about the deceased. I mean, everybody. Paul Andrews was the real McCoy, and he was an amazing man, and he behaved wonderfully with Berkshire. I mean, he wanted to do more for Berkshire than Berkshire would do for him. I mean, it was very simple. And you run into those people, and as I say, you run into people that bend over backwards for us, and then some bend over forwards. But that's just the way it is in this world. And we've had quite a few that have been over backwards for us. And the distribution business is not a wonderful business, but it is a business, and it's a business that if it's big enough, it's one we would look at and we would buy additional. And TTI makes some small acquisitions on its own all the time. I don't even hear about them until I read the quarterly reports. And so we want to build up. We want to build our businesses in every area that we operate, and we've got unlimited capital to do it. So we're willing to have small acquisitions take place if they fit in with something we already have. But we're not in the business of going out after small acquisitions. And if we did, we would. We just don't have the people for it, and it wouldn't move the needle anyway at Berkshire. So. We would have been happy doing the deal that the questioner asked about, but if we don't do it, it just doesn't make that much difference. We want to do it. If we do it, we'll do it well. We'll do it right. They'll have made the right decision. If they don't, we will find something else to do with the money in the end. And we can always buy a little more of TTI for you, the shareholders, by just buying in our stock, too.
Mm-hmm. Exactly.
Yeah. Okay. Let's see, we need Becky next, don't we? Yeah, Becky?
All right, Warren, earlier you talked about selling some of the Apple shares in order to build up your cash supply, and I think it's had a lot of people wondering where you see opportunities or what might be coming or market valuation. So I'll ask this question from Foster Taylor. At the 1999 annual meeting, you mentioned that if you owned all of America's 500 businesses, you would be making $334 billion while paying $10.5 trillion. You emphasized that this was not a good return on investment. Today, by my math, the S&P 500 has a market capitalization of around $44 trillion with profits of around $1.45 trillion. This is a very similar return on investment to the 1999 levels. Do you see similarities in the market today and the 1999 levels?
Well, one thing's changed dramatically from 1990. I misunderstood on the 1999, but there have been times in my life that I've been awash in so many opportunities that I could have invested everything by nightfall. And then there's other times when the year goes, well, not in the early days, but now, we haven't seen anything that makes sense that moves the needle. Now, we've made small acquisitions during the year. Our companies have made acquisitions, and we, Greg and I may talk about something that involves a $300 million purchase or something like that, and if it fits well enough, we do it. But and if our managers see things that fit them, we want to look at them because our managers do not have necessarily the same equations in mind that we do. But there's some managers which we would hand them, just say, whatever you decide to do, and then there's other managers that would not know how to allocate capital particularly, and that they don't have to be able to be great capital allocators if they happen to be great at serving customers and understand their own industry and all of that. They can be great managers. And a good many of them aren't capital allocators, and others are. But this is not a time when the phone is going to be ringing often, but there are times from that, and Greg will know how to handle them as well or better than I have over time. And Charlie and I would, we missed a lot of things, and what we really regretted was missing something that turned out to be very big. We never worried about missing something that we didn't understand. I mean, why should we be able to, predict the future of every business any more than we can predict, what wheat yields are likely to be in Illinois next year? Well, not wheat in Illinois, wheat in Kansas, but corn in Illinois. I don't really think of whether it's similar to 1999 because I'm not that good on chronology anyway, unless something really dramatic happened at the time. I mean, I remember things from 2008 and 9 much better than I remember whether something happened in 2015 or 1987 1987 I remember because of October 19th. But I just don't think that way. I just look at what I can do every day. Greg?
I'm going to have to use it. Nothing to add.
Okay, well, we'll go to station 2. It's nice to know what lines you can get an applause for. Station 2.
Hello. My name is Stefan Uhrenbacher. I am a shareholder from Hamburg, Germany. I've been coming to Omaha since 2007. And I'm deeply grateful for all the things I could learn here, both about investing and about life, in particular creating circumstances that will enable me to lead a productive life during my entire healthy lifespan. So thank you for that. My question to Warren, your favorite holding period is forever. Holding American Express or Coca-Cola for decades. Berkshire recently went in and out of Markel, and you, I believe, sold and later bought Oxy, which I think happens to everyone all the time. But can you maybe to us give examples of your thought process when you exit positions? Thank you.
Well, there are various reasons for exiting positions. One is if you need the money, but that doesn't happen very often with us. But it used to happen on every decision I made when I started, when I was 20 years old, which I consider the post-Graham period, although I actually started in 1942, if you just talk about buying stocks. But in any event, the decision process is really quite interesting in a certain way, because Charlie and I made decisions extremely fast, but in effect, after years of thinking about the parameters that would enable us to make the quick decision when it presented itself. And people have speculated on how I've decided to really put a lot of money into Apple. And for a reason, I can't. One thing that Charlie and I both learned a lot about was consumer behavior. That didn't mean we thought we could run a furniture store or anything else, but we did learn a lot when we bought a furniture chain in Baltimore, and we quickly really realized that it was a mistake. But having made that mistake made us smarter about actually thinking through what the capital allocation process would be and how people were likely to behave in the future with department stores and all kinds of things that we wouldn't have really focused on. So we learned something about consumer behavior from that. We didn't learn how to run a department store. Now, the next one was See's Candy, and See's Candy was also a study of consumer behavior. We didn't know how to make candy. There were all kinds of things we didn't know. But we've learned more about consumer behavior as we go along. And that sort of background, in a very general way, led up to the study of consumer behavior in terms of Apple's products. And in that case, while I watched what was happening at the Furniture Mart in terms of people leaving the store, even though we were selling Apple at a price where we weren't even making any money, but it was just so popular that if we didn't have it, people left the store and went to Best Buy or someplace. And if you know the Blumkins, they can't stand anybody leaving the store, so they behave accordingly. But then you learned that had to interest you in the brand. And then you had a million different inputs. But I think the psychologists call this apperceptive mass, but there is something that comes along that takes a whole bunch of observations that you've made and knowledge you have, and then crystallizes your thinking into action, big action in the case of Apple. And there actually is something which I don't mean to be mysterious, but I really can't talk about. But it was perfectly legal and everything, I'm sure of that. But it just happened to be something that entered the picture that took all the other observations, and I guess my mind reached what they call apperceptive mass, which I really don't know anything about. But I know the phenomenon when I experience it, and that is. We saw something that I felt was, well, enormously underpriced. Maybe I've used this example before, but if you talk to most people, if they have an iPhone and they have a second car, the second car costs them $30,000 or $35,000, and they were told that they never could have the iPhone again, or they could never have the second car again. They would give up the second car, but the second car cost them 20 times what the iPhone did. So now people don't think about their purchases that way, but I think about their behavior. And so we just decide without knowing, I don't know, there may be some little guy inside the iPhone or something. I have no idea how it works, but I also know I know what it means to people. And I know how they use it, and I think I know enough about consumer behavior to know that it's one of the great products, maybe the greatest product of all time, and the value it offers is incredible. And I think it has, in Tim Cook, I think it has somebody that, in his own way, is the equivalent of a partner with Steve Jobs that could do one thing extraordinarily well, and more than one application, but one thing, and Tim was the perfect partner to serve sequentially with him. So it's you sort of know it when you see it. I actually saw it with Geico when I I went there in 1950. I didn't know exactly what I was seeing, but Lorimer Davidson on a Saturday in 4 hours taught me enough about what I understood what auto insurance was, and I knew what a car was, and I knew what people went through people's minds. You know, I knew they didn't like to buy it, but I knew they couldn't drive without it. So that was pretty interesting. And then, but he filled in all the blanks in my mind as I sat there on that Saturday afternoon. And you know, every now and then it happens. You know, why do you have this? The person you met, you know, there are all these different potential spouses in the room, and then something happens that you decide that this is the one for you. You know, I think was it Rogers and Hammerstein that Some Enchanted Evening wrote about that. Well, our idea of an enchanted evening is to come up with a business, Charlie and me, and there is an aspect of knowing a whole lot and having a whole lot of experiences, and then seeing something that turns on the light bulb, and that will continue to happen, and I hope it happens a few times to you, but you can't make it happen tomorrow, but you can prepare yourself for it happening tomorrow, and it will happen sometimes.
Hey, Warren, he mentioned Oxy, which I think is a great example, where you made the original decision basically on a weekend with some thought, but as the more you learned about Oxy and the asset position they had, their ability to operate in an exceptional manner, and then a strong CEO around capital allocation. I think your confidence in which was reflected in continuing to acquire more shares is sort of that type of process.
It's exactly to the point. I mean, I just learned more as I went along. I learned enough. You know, I'd heard of Occidental Petroleum. Occidental Petroleum happens to been a descendant, not a descendant, but it's a continuation of City Service, which was the first stock I bought. And of course, I knew a lot about the oil and gas business, but I didn't know anything about geology. And so I knew the economics of it. I had a lot of various things stored in my mind about the business, but I never heard of Vicky until I guess it was a Friday or a Saturday, and we met on Sunday morning and we made a deal. But that was one sort of deal. And then as time passed, all the kinds of different events happened, and you know, Icon came in. I mean, there are a million things you couldn't predict at the start, and I formed certain opinions as I went along. But then I learned more as I went along, and then at a point when I heard an investor call that Vicky was on, it put things together for me in a way. It didn't mean I knew I had a sure thing or anything like that. I don't know what the price of oil was going to be next year, but I knew that it was something to act on, and so we did. And we're very happy we did, and we still don't know what the price of oil is going to be next year, and nobody does. But I think the odds are very good that it was, but not a cinch, that it was a good decision. And you know, we've got options to buy more stock, and you know, when we get through with it, it could be a worthwhile investment for Berkshire, and we're in it, and we're in it for keeps. And there are other things that we own that we aren't in for keeps. Incidentally, I should just throw this out there since there's been speculation on it. We've sold. I was 100% responsible for the Paramount decision. I read speculation that one of either Ted or Todd had some involvement in that. No, it was 100% my decision, and we sold it all, and we lost quite a bit of money, and that happens in this business too. But actually owning Paramount made me think even further. I like to think deeper, but I certainly thought harder even about the whole question of what people do with their leisure time and what the governing principles are of running an entertainment business of any sort, whether it's sports or movies or whatever it might be. And I think I'm smarter now than I was a couple years ago, but I also think I'm poorer because I acquired the knowledge in the manner I did. But I just want to be very clear that A, we lost money on Paramount, and B, I did it all by myself, folks. I don't know whether I've anticipated one of Becky's questions now, but we will find out. Let's see. Now, you're next, Becky.
Yep.
Yes, you did anticipate one of the questions. Let's go to another one. This question comes from Vincent James in Munich, Germany. In the chairman's letter, Warren points out that the profit margins for BNSF have slipped relative to all 5 other railroads. However, Warren comments in the letter, BNSF carries more freight and spends more on capital expenditures than any of the other 5 major railroads and has a vast service territory second to none. Given the comments from Warren about the clear strengths of BNSF, what explains the decline in revenue and profit, and in particular, the profit margins relative to the other 5 railroads? What are the issues relative to the other railroads, and what is being done to address them? Please be specific.
Okay, and I will, how specific we get depends on what Greg wants to say, but it's Greg's responsibility. It's my responsibility for the purchase and for the operation up till Greg took over, but I think I'll let Greg answer that. And
sure. Yeah, Warren touched on it, and the comments from as reflected there are very accurate. If you look at this quarter's results or our last year's results, they were both, they're disappointing as shareholders and disappointing in the relative to the other Class 1 railroads. And as highlighted in the question, there's 5 other Class 1 railroads. So it's pretty easy to understand how you're performing versus the others. And there's a lot of other variables, but there's some very simple things to look at. When we look at where we've been on associated with Burlington, I would just back up a little bit because if you go back to 2021, the Burlington team and management team and the group, we're making excellent progress on a lot of fronts when it comes to our operating and both being efficient and effective in how we're operating the railroad. And I remember very specific comments from myself in 2022 where I commented that that was the year there was all the supply chain issues, a lot going on the West Coast ports. Our trains were backed up in a variety of places, and we called that a reset year. And I think we did need a reset year on the operational side. But as we moved into 23, the business cost level, cost structure, we didn't reset it to the underlying demand we were seeing. We anticipated more demand, and we did not reset our cost structure. And the team's working very hard as we speak to both reset the cost structure and allocate the cost resources where they need to be. And when you go through something like that, what we've recognized as an organization, yes, the demand of the rail will drive a certain amount of the cost, but the reality is that the rail industry, if you go back many, many years, it's flat. There's not a lot of growth in the industry. There's opportunities to become more efficient and effective, and our margins can go up. But the reality is the demand's going to be flat, but it does move within different sectors of the rail. It can be in the consumer products, it can be in industrial, it can be an ag. But overall, it's generally going to be relatively flat. So we need to get our cost structure right, and we need to get it right both for the coming year, but for the long term. And that means it's going to be a continuous exercise. We can't stop. We can't say we've gotten far enough, because our competitors, and we compete with the other rails, but we also do compete with the truck industry. We have to have a cost structure that allows us to compete both within our rail industry and within the transportation sector as a whole. So the team at Burlington's working very hard to address the cost structure. Just like we have in the past. I think one thing we do recognize, when the other railroads have implemented precision scheduled railroading, there's other metrics that we have to continue to pay attention to and challenge ourselves. If we're not at their level, what are the things that are driving it? So we're gonna, when they ask for specifics, I'll give you a few. We have to look at our rail yards and understand how we're managing that. We have to look at our locomotive fleet, both the size and how we're utilizing that, and challenge ourselves. And we have to then go back to how we're using our employee resources and allocating them across the business. So there's a lot to be done there. Our team's 100% committed to driving to the right cost structure that's consistent with the underlying demand in the business. And then we can't stop there is the answer. So a lot to be done, but we have a team that's absolutely engaged and committed to it, and we're gonna make good progress in this current year.
At Berkshire, we want everybody to have the idea that there's a lot to be done with every business. You know, it is. Only Peaky would build a remarkable company in Omaha, building company, really remarkable. And there's a question after everything they did, something that was done particularly well, you know, digging a tunnel under the East River or something when it said it couldn't be done. Yeah. He would say he was pleased but not satisfied. And that is exactly the way we want the attitude to be at Berkshire forever. Omaha is a railroad town. If President Lincoln in 1862, I think it was, had decided to pick St. Joe or Plattsmouth or any place else to build the Transcontinental Railroad, Omaha would probably be a little town of 20,000 or something on the banks of the Missouri. But making, with Lincoln's desire to make this the Eastern connection and make a transcontinental railroad, Omaha just took off. So it's been railroading at its base. And anybody that was interested in financial matters had to think about railroads. Plus, they had a certain glamour to them anyway. But the interesting thing is that UP, which is our main competitor, themselves fell way behind 20 or 25 years ago before Jim Young came in. And in 2000, whatever it was, 8 or so, I started buying 3 railroad stocks, and Union Pacific, BNSF, and Norfolk Western, I believe. I don't know why I wasn't buying CNO, but in any event, Jim Young had done a marvelous job with Union Pacific, so we owned all 3 stocks. But what we did in 2009 is we were able, well, we already owned 22% of it, but overall it was $35 million, $1 billion, which was a significant part of our capital. We were able to put it to work in a business we liked, and there's certain tax advantages that come in terms of making money in something that's more than 80% owned, we call it 100% owned in this case, versus making it through stocks. So it has a net benefit to us from making the same amount of money owning one of the other railroads by owning all of the railroads, and we got $35 billion out during a recessionary period. I think that was the worst quarter, the third quarter of 2009, maybe the rails had had it for a long time. So it's worked out. Actually, it's worked out very well, but it's because we were putting out capital in 2008 and 2009, and if we put money in anything, we'd have made a lot of money. But it's more satisfying, and it's actually better in certain ways, tax-wise, to make it from something that's 100% owned and all bunch of 5% or 10% owned businesses. We're, as I mentioned in the annual report, railroads are absolutely essential to the country. That doesn't mean they're on the cutting edge of everything. They're just essential to the country, and that's why the government, I think they took them over one time, and they negotiate what our labor settlements will be and everything. And if you shut down the railroads of the country, it would be incredible, the effects. And it would be impossible to construct now. I mean, look at what's happening in California when they're trying to build a line. I mean, everybody's worried about the environmental effect of every mile, and what will happen to the various species of birds. Can you imagine the rail system of the United States being built? It would take decades unless a war was on and the government took over things and just ordered them. You can't create it. So we love owning a business like that. It's going to be around 100 years from now. Won't be the best growth business in the world at all during that period, but it'll be essential. And what it earns in its relation to its replacement value is a pittance. But we'll do fine in terms of what we paid for it, and we'll distribute substantial amounts in relation to what we paid to Berkshire in a very tax-efficient way. And so when the question is what are the issues relative to the other railroads, it wouldn't have been the end of the world if we bought the Union Pacific and Jim Young had stayed alive to run it for us. That would have been great too, but we had the opportunity to buy BNSF, and it's been good for them, and it's been good for us, and we think it's a very important asset to the country. And I just hope we can find something in other industries where it makes as much sense as that, where we can put a whole bunch of money to work at an advantageous time. So let's go on to Station 3. Is that correct or not?
Yeah.
Okay.
Good afternoon, Mr. Buffett, Mr. Abel. My name is Sirapop Wu, a resident of New Zealand, but originally from Thailand. This is my first time in America and the first time attending the meeting. The journey was quite rough, but it was all worth it though, because I can now personally thank you, Mr. Buffett, and the late Charlie Munger, well, he's still with us, for organizing such a wonderful event, and most importantly, for being such an exceptional role models and sharing your wisdom with us all these years. So thank you.
Well, thank you for coming.
So here's my question for you, Mr. Buffett. Towards the end of 2018, you mentioned that you guarantee you could make a 50% annual return if you had to start again with under $1 million. The question is, if tomorrow you woke up in the body of
your body,
20-year-old American.
Your body. But that's fine.
And your name was now Warren a la carte. And you had some money to invest on a full-time basis. What method or methods would you use to achieve that return? Would it involve flipping through 20,000 pages of Moody's manual or similar publications?
Yep.
or finding, to find cigarettes? Or would it be hunting for great companies at a fair price as Mr. Munger would? Or would it be a combination of both, with opportunity cost serving as the final arbiter of which method to use, given that your investing opportunity has now broadened significantly? Thank you. ขอบคุณครับ
Good question. I'm glad you came. And the answer would be, in my particular case, it would be going through the 20,000 pages. And since we were talking about railroads, I went through the Moody's Transportation Manual a couple of times. That was 1,500 or 2,000 pages, or probably 1,500 pages. And I found all kinds of interesting things when I was 50 or when I was 20 or 21. And I don't imagine there's anybody here that knows about the Green Bay and Western Railroad Company, but there were hundreds and hundreds of railroad companies, and I like to read about every one of them. The Green Bay and Western, in those days, everybody had a nickname for railroads. I mean, that was just what Northern Pacific was, the Nipper, and Phoebe Snow was one of them in the east that used to go up to Cornell, and the Green Bay and Western was known as grab baggage and walk, and GB&W, and they had a bond that was actually the common stock, and they had a common stock that was actually a bond, and that could lead to unusual things, but they wouldn't lead to unusual things that would work for you with many millions of dollars. But if you collected a whole bunch of those, which I set out to do, and actually that's what impressed Charlie when I first met him, because I knew all the details of all these little companies on the West Coast that he thought I would never have heard of. But I knew about the Los Angeles Athletic Club or whatever it might be, and he thought he was the only one that knew about that, and that became an instant point of connection. So to answer your question, I don't know what the equivalent of Moody's manuals or anything would be now, but I would try and know everything about everything small, and I would find something. And with $1 million, you could earn 50% a year. But you have to be in love with the subject. You can't just be in love with the money. You really got to just find it like essentially like, people find other things in other fields because they just love looking for it. A biologist looks for something because they want to find something. And that's built into. I don't know how the human brain works that much, and I don't think anybody understands too well how the human brain works. But there's different people that just find it exciting to expand their knowledge in a given area. I know great bridge players. I know great chess players. Actually, Kasparov came to Omaha and met Mrs. B. I've had the luck of meeting a lot of people that are unbelievably smart in their own arena and do some unbelievably dumb things in other areas. So all I know is the human brain is complicated, but it does its best when you find out what your brain is really suited for, and then you just pound the hell out from that point. And that's what I would be doing if I had a small amount of money and I wanted to make 50% a year. But I also wanted to just play the game, and you can't do it if you don't find the game of interest, whether it's bridge or whatever it may be, chess, or in this case, finding securities that are undervalued. But it sounds to me like you're on the right track. I mean, anybody that'll come all the way to this annual meeting has got something in their mind other than bridge or chess. So I'm glad you came, and come again next year. And now we move. Now we move to Becky.
This question comes from Denny Poland, a shareholder from Pittsburgh. When describing the principal agent problem, Mr. Munger said that capitalism often works best when the people managing the property also own the property. In recent years, agents of pension funds and asset management firms who do not have significant personal ownership stakes in Berkshire have forwarded proposals that were not in the economic interest of shareholders. What can be done to limit the negative influence of these agents in the decades after you're no longer able to cast significant votes against them?
Well, that's a very perceptive question, and it's been answered in a temporary manner, but who knows how the situation will develop in the future. All I know is that you have a wonderful hand at Berkshire Hathaway, but you have to be able to think your way. I mean, obviously, you have to think your way through political realities, or you have to think your way for what will cause you want to be regarded as an asset to the country, because you'll find more solutions if you are an asset you owe to the country anyway. But beyond that, you'll find more solutions than if you're regarded as evil or something, and worse yet, if you deserve it. So it's something that's constantly in our mind, and it needs to be in the mind of the directors, and they need to think for themselves on this rather than bow to conventional wisdom, which in a sense, you don't want to become a cynic about life, but almost everybody that approaches you, if you have tons of resources, has got some interest in figuring out how to use your resources to their advantage. And that's true whether they're in politics or whether they're in investment banking or whether they're selling you, well, whatever it may be that they're selling. I don't want to do any injury to anybody, but life insurance agents see the advantage of buying life insurance, and investment managers who get paid based on assets managed to get interested in selling you their services. Imagine if everybody in this room were following the investment advice of somebody that said, for 1% a year, I'll tell you how to invest your money. And in 1950, when we started in 1965, they would have said, well, buy Berkshire Hathaway, and if they were around now and they still had their 1% deal, they'd be collecting $8 billion a year from people who aren't getting any dividends from us. So they would have a different interest in the kind of contract they worked out with you than you would have. And the best thing to do is just pay them a commission one time and own the stock. But you have to be alert to what human nature does to both other people and to you. And then if you think it through well, and you actually listen to what Charlie has told you, you'll have a big head start on most people. Charlie, there's one thing that I should mention that really is terribly interesting about Charlie. Charlie knew the importance of psychology and human behavior and incentives and all of that. He figured that out very early, and of course he gave some talks even on 25 or so ways, whatever it happened to be. I don't remember the exact number, but the different ways that one person could take advantage of another by understanding how humans behave. And then, after doing a magnificent job of explaining it, he believed in understanding what others would do, but he thought it was beneath him and to actually use those methods to manipulate people. It's a really interesting human being that thinks through the psychology of human behavior and figures out, how you become a great insurance salesman or manager on Wall Street or accumulative assets under management or whatever it may be, and you get very rich by understanding the weaknesses of others to some extent, and then decide that it's very important for you to recognize these when they occur. It's very important for you to know them better than the person that actually is using them, but you don't have to stoop to using them yourself. And Charlie told me that in his lifetime, after he figured this out, there were a couple of times when he used them. He wasn't proud of it, but he also never lied to me. So he explained to me that, there were a couple of times when he used some of these techniques, but he didn't plan on using them anymore, but he also wanted me to know that if I ever did something like that, I wasn't really behaving terribly, that he allowed for the fact that humans may misbehave. So I'm sure that I behaved somewhat better before my marriage than I did afterwards in my enthusiasm for different activities like dancing or something. And he said, "That's, we all do it, but don't do it again." And so that's part of acquiring human wisdom. And speaking of human wisdom, we've just got that one book out there by Charlie. Poor Charlie's Almanac, and that's worth reading 3 or 4 times. I think I read Ben Graham's book about 5 or 6 times, and each time I read it, I realized that I just needed to think a little more deeply about certain things. They weren't complicated or anything, but it's better to, if you've got some great instruction like you get with Charlie, it's better to read it several times than to just figure you'll just read every book once and it's in the library. Okay, let's go to section 4.
Jeff Robelier from Tulsa, Oklahoma, and I'm thinking of Dr. Graham, Mr. Munger, your father, and my question is for all of us, but it's probably especially for the younger people in the room, the importance of picking the right heroes in life, choosing friends wisely, and maybe tell us a story, if you could, about each of those folks. Thank you, sir.
Well, there's no question you're 100% right in terms of having the right heroes. And, you're lucky if you get them. I mean, Charlie had them, I had them. And the interesting thing, my sister is here today. My younger sister with the 2 survivors. And we both experienced having the same hero, even though as we grew older, we saw that we didn't agree with plenty of his ideas, but we did agree with his values and motivation. And that's a better lesson than having somebody that's reading to you from a catechism that has got a lot of rules in it, which are pretty good rules, but there's a special place for somebody that is going to continue loving you, even if you break some of the rules. And that's what Charlie had in his life, was what Bernie and I had in our life. So I would just repeat what you said. I don't need to give you a bunch of, when I ran away from home, I'll give you a specific example with me. When I ran away from home and we hitchhiked up to Hershey, Pennsylvania, and got picked up by the state police and everything, and I talked these other 2 guys into it. And we lied like crazy to the state police, saying we had our parents' permission. Some kid at the place where we stayed had tipped them off that we'd run away from home, and we started, like I said, when the state police picked us up, we decided that two things, we decided to tell them a bunch of lies about the fact we had our parents' permission, and we decided we better get out of Hershey because these cops were going to find out sooner or later. And so anyway, we ended up back in Washington after a couple of days. And when I walked in the door, one of the boys' mother, and this other kid was the Congressman Roger Bell, and his mother was in the hospital over this whole thing. He'd taken out his cash in his savings bonds, and so she was sick, and Judge Bell, her husband, was all concerned and everything. And I walked in the door in Washington, and my mother said, "How come you came back so soon?" And my father said, he said, I know you can do better. And I just paid more attention to my father than my mother. And so you want to have the right heroes, and you don't have to have them. It's not the heroes based on what they've accomplished, and it's the people that you want to be yourself. And if you copy the right people, you're off to a great start. And I don't mean a great start about making money. I mean a great start about living your life. So you can check with my sister Bertie, who's here, and see if I've told the story correctly. She ran away from home too, incidentally, but she didn't get as far as I got. But she was running away to go over to my grandfather's house, which was about 2 miles away. But I don't want to denigrate her runaway abilities, because she was much more accomplished than I am in all kinds of other things. But when it comes to running away, I definitely outclassed her. Okay, let's go to Becky.
This question comes from Vedant Sharma in India. Warren, you and Charlie have often said that you were able to identify the people you want to go into business with and have had an exceptional record in that. However, in the case of Pilot, we noticed that the final stake purchase ended up in a dispute and had a sense of smart accounting, to put it one way, to squeeze a little more out from the deal than was deserved by the seller. Knowing well that this has been settled out of court and needs due confidentiality, I would like your views on some of the lessons learned that may be beneficial for future deals to watch for and for coming leadership to look out for as well.
Well, I'll make two comments on that. That a couple of the directors had their doubts about going in, and in any event, Pilot is working out well for us. And as my friend Sam Butler one time said to me, and he was talking in general about certain kinds of situations, but he said, "Well, Warren," he said, "all's well that ends." And that's where we are. So we'll go to station 5. Well, while we're getting to station 5, I'll tell you a little bit more about the fellow that is now running Pilot, and who you may have met here, that Greg had known for a long, long time. And he grew up in Omaha and came from a poor family and was raised by his mother.
Right.
And I went to the same high school, public high school, that my wife went to, North High, went to University of Omaha, set an all-time record in rushing yardage, playing there. He was a bouncer.
Yes.
Drafted by the New York Giants, as I remember. But,
exactly.
Yeah, and but then injured, actually in spring training, as I remember, in some way. And so he ended up being an intern. Not an intern, but a trainee, you might say, for Mid-American before I was there. And now here he is, still relatively young, and he's running a huge company, and we've got incredible confidence in what he will do, and we like very, very, very much the business that was created by Big Jim Haslam, and it really is almost an only in an American type story, but it does show you what somebody with some real stuff and with a mother that believes in them, and with bad breaks along the way. I mean, imagine how you'd feel if you were drafted by the New York Giants and then you suffered some injury in spring training or something. I mean, you spend your life, it hurts. But it's not an experience I would have ever had. It's another, I mean, I was the last guy chosen. But to see that, he's running a company, depends on the price of the deal, but it's a huge company. And what does he have, 25,000 or
right.
so? Yeah, employees.
25,000.
Yeah, and he's got many, many, many years to go. So I couldn't be more pleased about not only the acquisition of Pilot, but just what it tells you about America. You can catch what do you have to look up to read about him in Google or an interview with Adam?
I try and think if it's a podcast.
Yeah, he's got a podcast that will just blow you away. And if you don't think this is a great country, it has a lot of great people in it, all you got to do is read that podcast. So,
but we do have a great set of assets there.
Oh yeah.
If you look at Pilot, we have more than 800 travel centers, and just so everybody knows, I mean, the beauty of that, and there's a question regarding this morning around fuel choices at Pilot, and the exciting thing is, in the end, Pilot's going to serve whatever fuel our customers need. It can be electric, it can be renewable diesel, it can be diesel, or any of the various sustainable fuels, but the point is it has exceptional locations that are on the interstate highways. And
hundreds of them.
And we bought an incredible franchise, and now we have a great leadership team in both Adam and his team that's around him. So we're pleased where that opportunity will go.
Yeah, we've got probably the average one might be 10 or 12 acres or something like that, zone commercial on interstates throughout the whole United States. I mean, who knows, but what was created there is amazing too. You had a fellow that played at University of Tennessee, and undefeated, and came away from this football team, and you'd think, well, another football player, maybe he goes out and there may be some intermediate parts in the story, but a little bit, but he buys a gas station and he turns it into something that is huge. So we're really delighted with it, and it's another kind of only in America story. And how many of us can become an all-American, number one ranked team, let alone start a business that goes on to these sort of heights. So we feel very good about it. Becky?
No, I think they're ready for 5 now.
Oh,
I think he's up there now. He's ready to go.
Okay, go to it.
Hello, Mr. Buffett. My name is Zhang Yabo. I came from micro city, Hainan, China. So I want to express my sincere gratitude for you, for the extraordinary value you generated for shareholders, and the positive influences you've had on younger generation of investors like us. And my question relates to the concept of maximizing the duration of compounding. As individuals age, the quality of compounding inevitably diminishes. What are your secrets in maintaining your sharp mind, extraordinary judgment, and great physical condition? We wish you well. Thank you.
Well, you don't know me well, but that's, I like, just keep talking. I mean, well, you have to be just plain lucky. I mean, there's no question about it that there's 100 or 1,000, multiply a number of times that some drunk could have pulled out a car and broadsided me, or just all the bad luck that you can have in life. And you can say that my great skill has been avoiding bad luck, but that isn't a skill, that's luck. Or bad activities. And then to get to be, I would not have been if you'd taken my high school class and you say, a couple of you are going to live to be 90, men are going to live to be 93, I would not have been a heavy favorite, I can tell you that. And I wouldn't have bet on myself. You just, now you should make the most of your luck when you get it. And sometimes I've done that, and sometimes I haven't. It is absolutely true that if I had it to do over again, there'd be a lot of different choices I would make. Whether they would have ended up working out as well as things have worked out, it's hard to imagine how they could have worked out any better. But it is interesting how many mistakes you can make if you just keep going. And Charlie, when we used to talk about that you just soldier through, you just keep going. But you still need luck. You don't want to. Anybody that says I did it all myself is just kidding. I mean, they're delusional. And actually live in a country where the life expectancy is pretty darn good. So that alone is a huge plus. I was born. If I'd been born, my sister's here, and she was born female, and she's just as smart as I was and everything. But even my own family, who really did, particularly my dad, love us all equally, and in a terrific manner. But he still told me that this is 10 or, I was born 10 years after the 19th Amendment was passed, but he basically told my sisters, that marry young while you still have your looks, and he told me that the world, that power in you is new in nature, and that you really could do anything. Well, I found there were a lot of things I couldn't do, but the message given to females and males was incredibly different by the most well-meaning and loving of parents. Like I say, in 1930, it had been that way for millions of years. It changed quite dramatically, but obviously not completely. But during my lifetime, but it's been during the latter half of my lifetime. If you take my sisters, if they'd been born even 5 or 10 years later, they still would have been, getting instructions when they went away to college to be sure and get married, or get arranged so that you're going to be married, while you're in school, because after you get out, all the good ones are taken. Bertie was telling me that was a message that basically had been imparted to a lot of the women she'd met, obviously. And so it's extraordinary how much progress we've made, but it's unbelievable how long it took to get it made. It really does make you wonder about, we've got all these heroes from American history and all the wonderful things they did, but how could they say all men are created equal and then write a constitution that women, allowed women not to be able to own property, and then depending on the state, just terrible conditions. But anyway, that's how you learn about what the humans can do. And I feel, and you've got to feel better about the future for your kids than you would have felt 100 years ago, no matter what the situation is. Anyway, we'll move to Becky.
This question comes from Linda Frazier in Westport, Connecticut. Dear Mr. Buffett, in the past you've specified that 90% of your wife's inheritance be invested in a low-cost S&P 500 index fund and 10% in short-term government bonds. But the market cap of the Magnificent Seven tech stocks now represents more than 1/4 of the market cap-weighted S&P 500 index, which seems like a big bet on the tech sector. I was wondering if you would now recommend investing some portion of the funds in a low-cost, equal-weight S&P 500 index fund rather than having all of the equities exposure in a tech-heavy market cap-weighted fund?
Well, that's an interesting question, and I will tell you that I revise my will about every 3 years or so, and I get little thoughts from time to time, and then you don't change it every time you do it. You get a tiny thing, but the one section I haven't changed is that with my wife, that she got left a huge amount of money by practically anybody's measurement except pittance compared to what I've accumulated in total. And it won't make one bit of difference to her in life, whether she beats the S&P or anything else. All I want to leave is plenty of money to take care of way beyond anything she'll ever spend, and at the same time give her as much peace of mind as possible, and really make it so that the trustee who administers it doesn't have to worry about whether it just doesn't make any difference whether she beats the S&P or not. And the main thing is that she feels that she's in a financial position, which of course she will be, that she doesn't even need to think about it, and the trustee doesn't have to worry about getting sued or anything else. So it's simply not an economic condition now. Obviously, with 99% plus of what I have going to philanthropy, and I've got my 3 children. The one good thing is that they've, at the age of 70, 69, and 65, they have matured remarkably, probably more than their father, and but at the same time, they've got less time to work with the money than they would if they were 50 or something like that. So you do the best in accomplishing your objectives in your will, and in the end, you don't know what's going to happen after you die, but you make sure that to the extent that you have a lot of money to leave, you want to say thanks to a lot of people, and quite a few people in terms of specific requests. You want to take care of your family, but in my case, that requires practically no money, and a fair amount for taxes, but I have, and my children are in charge of what happens to the funds that are left. But like I say, the problem is when you live as long as I have, and your kids get older, who knows what happens with mortality tables, and they're the ones that I really want to see handle the distributions, and they will, and they'll be very good about it. And but if we're all alive 3 years from now, they'll be 3 years older, and so everything, you can't solve everything in life. You do the best you can with it, and people do interesting things. I've been around probably as many rich people as almost anybody, and a fair number of them I know what they're doing or have done with their funds. And the idea that you can have a huge amount of money and leave everybody very rich and have people liking each other less when it all happens. Humans are really, they are interesting to watch. Some of them handle it beautifully, and others are terrible. The one thing lawyers will always tell you is don't use codicils. In other words, when you change your mind on a will, just write a new one, but tear up the old one. Don't do it by just adding codicils. But I believe I'm correct. Certainly read it, that Paul Getty, who was the richest man in the world, presumably, at one point in the 1950s or 60s, and it's a very interesting guy to read about. And he had five wives, and he's the one whose grandson was kidnapped, and they sent Paul Getty an ear of the child and everything. I mean, it's not a happy life when you get through it. But the one thing he did that was kind of interesting, he actually liked to use codicils because I think he had like 25 of them, and it was kind of his way of writing, well, I'm taking you out of the will because, and so he sort of delighted in explaining through his will how he felt about all these people. I mean, you really get some strange things revealed in a will. I just read about a will of a fellow that made a whole lot of money and was leaving it to his, I don't know whether his children, grandchildren, whatever it may have been, but in any event, his opening line in his will is, and this was done some years ago, but I know something about the family. His opening line, in effect, said, I'm writing this will while I'm riding in the economy section of Eastern Airlines number such and such. I mean, he believed in getting right to the point of what the people who were recipients, how they should live, and how he was going to be judging them. And it's just so damned interesting to watch people's wills. But one guy left a lot of money to his wife on the condition that she remarries so that at least one man would mourn his passing. Well, I'm not giving legal advice here, as they always say, but I feel very, very, very good about how things have turned out, and I wish I could figure out ways better to use, the really vast resources I've got in some of the really important questions of the world, but I haven't been able to do that. I mean, I had a few goals when I was 30 or 40 and may have written them into wills then in terms of what the world needed done and how the money could be used, and unfortunately I decided that they weren't feasible to accomplish. And of course I was setting out to accomplish things that were important, but nobody had solved yet. So you got to expect that. Why should I be able to solve them? But nevertheless, it's an interesting. And the one thing about it is everybody here, I don't know about the ones who've come from other countries, but you should have a will. Because if you don't have a will, you still have a will. And it'll be whatever the state says. And it's amazing. 4 American presidents died intestate without wills. 4. We've only had 45. And imagine becoming president of the United States and not having a will. But you can look up somebody recent. I think Lincoln. I'm certain Lincoln was one of the 4. And here's a man. I mean, I don't know whether you can always say, well, he didn't get around to it, but that's hard to imagine why Abraham Lincoln would have died intestate. I'm sure we've got some Lincoln scholars out there that will write me after this and explain why, and I'll be interested to receive their letters. But human beings are human beings, and we all have weaknesses and peculiarities and everything else, and don't be too hard on yourself because you have some of those, but don't be totally forgiving either. You can change the future. You can't change the past, but you can change the future. Okay, station 6.
Good afternoon. My name is Caroline, and I'm a lawyer in San Diego. But please don't hold that against me. Remember, Mr. Munger was once an attorney too.
Right.
First, I'd like to sincerely thank you, Mr. Buffett, for your business integrity, tireless leadership, and generous contribution to philanthropy. My question for the distinguished panel of two is, now that the AI genie is out of the bottle, as someone astutely put it earlier today, what business in Berkshire Hathaway may be most at risk with AI?
Well, that's a wonderful question. The problem is I really don't know anything about AI, but obviously, anything that's labor intensive and that it can create an enormous amount of leisure time. Now, what the world does with leisure time is another question. Whether more leisure time, I know an awful lot of people think when they go to work at first that what they want is leisure time, and what I like is actually having more problems to solve. But AI is profound, and I mean, that's what makes it a genie. Is what can happen. I could tell a few genie jokes, but I better not.
I guess, Warren, we probably...
I don't know what, in terms of our businesses, they'll figure things out. I mean, we've got smart people, and it's obviously, if it's used in a pro-social way, it's got terrific benefits to society, but I don't know how you make sure that that's what happens any more than I know how to be sure that when you use two atomic bombs in World War II, that you knew that you hadn't created something that could destroy the world later on.
Yeah, I think when we think of AI at a lot of the business units, I mean, we're truly, Warren, trying to think, how does it make us more efficient, more effective? I mean, it results in more idle time, and we're probably not thinking of the iterative AI where we're looking at very specific processes where our people can implement it, and either at times it displaces the labor, but then hopefully there's other opportunities for them within the business. But I think, when you think of all our businesses, I mean, we do have a heavy labor workforce in a lot of them, but I think at the stage we're at as a company, and maybe where it's at right now, it's really around how do we do things more effective, more efficiently, more safely if it involves dangerous processes. So we're early innings.
John Maynard Keynes was just wonderful to read, and incredible mind. But in around the time I was born, he wrote a book about what could happen. I don't know whether it was in the next 100 years or whatever, and he predicted correctly that output per capita would grow at this incredible rate that it has. But in terms of speculating as what people would do with that, I mean, this guy was unbelievably smart. But it hasn't developed exactly the way he predicted. He was right about what was going to go into the equation, but he didn't have it figured out exactly what would be the result. So it is really, well, we didn't know when we were developing the bomb bomb, that there would probably be, as very soon, 9 countries, 3 of whom we should worry about plenty, that will have what they have, but we didn't really have any choice. And you could have had all kinds of papers written on it and everything else, but we were going to do it anyway. We needed to do it. And if you haven't read it, it's fascinating to go to Google and read the letter by Leo Szilard and Albert Einstein to President Roosevelt, written about a month before, almost exactly a month before Germany or Hitler moved into Poland. And it laid out, well, Leo Szilard knew what was going to happen, or had a good hunch of what was going to happen in terms of nuclear bomb development, and he couldn't get through to Roosevelt, but he knew that a letter signed by Albert Einstein would. So it's probably the most important letter ever written, and you can read it, which it's just fascinating to me. But that started the Manhattan Project. That started, it just, everything flowed out of it. And like, I'll bet anything that Roosevelt didn't understand it, but he understood that Albert Einstein just sent a letter, and he probably knew what he was talking about, and he better start the Manhattan Project. It's just unbelievable what happens in this world. Anyway, let's move on to Becky, I guess, is next, right?
Yep. Randy Jeffs from Irvine, California. The March 25th, 2024 Wall Street Journal reported that the Treasury market is about 6-fold larger than before the 2008-2009 crisis. Do you think that at some point in time, the world market will no longer be able to absorb all of the U.S. debt being offered?
Well, I would say, the answer, of course, I don't know, but my best speculation is that U.S. debt will be acceptable, but for a very long time, because there's not much alternative. But it won't be the quantity. The national debt was nothing to speak of, for a long, long time, and then. It won't be the quantity, it'll be whether in any way inflation would get let loose in a way that really threatened the whole world economic situation, and there really isn't any alternative to the dollar as a reserve currency. And you get a lot of people who give you a lot of speeches on that, but that really is the answer. And Paul Volcker worried about that back in before 1980, but he had threats on his life, and I happened to have a little contact with him at that time, and he was an amazing, amazing fellow that in effect decided that he had to act, or the financial system would fall apart in some way that he couldn't predict, and he did it, and had people threatening his life and do all kinds of things, but he was the man for that crisis. But it wasn't the quantity of U.S. debt that was being offered that threatened the system then. It was the fact that inflation and the future value of the dollar, the cash is trash type thinking that was setting up something that could really affect the future of the world in terms of its economic system. And Paul Volcker took it on, and he was gutty as could be. And if you haven't read a book or two about him, or the one he last wrote, you really ought to take a look at it. But it is I don't worry about the quantity. I worry about the fiscal deficit, but I'm not a worrier just generally. I mean, I think about it, but I don't sit and get up, work myself into a stew about it in the least, but I can't help thinking about it, and we've got a great attention. It's interesting. I think the media enters into this, and the focuses on the Fed, and they just love it because things are always happening, and economists are always saying what's going to happen with the Fed and everything else. But the fiscal deficit is what should be focused on, and Jay Powell is not only a great human being, but he's a very, very wise man. But he doesn't control fiscal policy, and every now and then he sends out a kind of a disguised plea for please pay attention to this, because that's where the trouble will be if we have it. Yeah. As one of the comics used to say, there was a stand-up comic who used to say, "Who have I forgotten to offend?" After his talk, and I always feel like that after these meetings. But we've got time for at least one question and maybe two. But let's go to station 7.
Hello, my name is Dennis from Gifhorn, Germany. I'm my first time here. I'm here with my friend who would, by the way, love to invite you to dinner. You talked about the importance of heroes, and we are very happy and thankful that we have you as our hero with great values, and thank you for that, first of all. My question is, it is clear that you achieved great success in life. Earlier you talked about every investment having opportunity cost. From what I've learned in life, that does not only apply to investing your money, but also to investing your time. Right. And every hour you spend in your office is an hour you cannot spend with your spouse or children. With the life experience you have now, if you had the possibility to start all over again, would you set your priorities any different? If yes, how and why? And what's the best way to invite you to dinner?
Well, that definitely won't be one of my priorities if I figure out how to do that. But that doesn't, don't take it personally, because when you can figure out at the maximum how long a period I've got, and I don't think. I can figure out all kinds of things that should have been done differently, but so what? I'm not perfect. I don't believe in lots of self-criticism or being unrealistic about either what you are or what you've accomplished or what you'd like to do. You do a lot of things, and who knows whether somewhat different trade-offs you just can't, you don't know what the paths would have led. I don't think there's any room in beating up yourself over what's happened in the past. It's happened, and you get to live the rest of the life, and you don't know how long it's going to be, and you keep trying to do the things that are important to you, and if I was a doctor, or if I was all kinds of different professions, I might do different things, but I really enjoy managing money for people who trust me. I don't have any reason to do it for financial reasons. I'm not running a hedge fund or getting an override on or anything, but I just like the feeling of being trusted. Charlie felt the same way. That's a good way to feel in life, and it continues to be a good feeling. So I'm not really looking to change much. If I'm very lucky, I get to play it out for 6 or 7 years and it could end tomorrow. But that's true of everybody, although the equation isn't exactly the same. But I don't believe in beating yourself up, though, over anything you've done in the past. And I don't believe in, well, I believe in trying to find, what you're good at, what you enjoy, and then I think the one thing that you can aspire to be, and because this can be done by anybody, and it's amazing, doesn't have anything to do with money, but you can be kind. You can be kind if you're, and the world's better off. I'm not sure that the world will be better off if I'm richer, but there's no question that, and kind people, and in the end, aspire to be more, or I'm sure many of you are yourself, but just aspire to be more so. And I guess we can take one more question from Becky, and then we wind up.
This question comes from Devin Spurgeon. On March 4th, Charlie's will was filed with the County of Los Angeles. The first codicil contained an unusual provision. It reads, "Averaged out, my long life has been a favored one, made better by duty imposed by family tradition, requiring righteousness and service. Therefore, I follow an old practice that I wish was more common now, inserting an ethical bequest that gives priority not to property, but to transmission of duty." If you were to make an ethical bequest to Berkshire shareholders, what duties would you impose and why?
I'd probably say read Charlie. He's expressed it well, and I would say that if they're not financially well off, if you're being kind, you're doing something that most of the rich people don't do even when they give away money. But that's not a question of whether you're rich or poor, and I would say if you're lucky in life, make sure a bunch of other people are lucky too. Okay. Just in case you know what my advice to myself has been during this period. So we only got 3 questions or whatever it is. But thank you very, very much for coming. And I not only hope that you come next year, but I hope I come next year. Thank you. Thank you. Thank you. Thank you very much. Again, thanks for coming, and if you haven't already read, pick up a copy of Poor Charlie's Almanac on the way out, and you'll get a lot out of it. And again, thanks for coming, and I'll see you next year. Thank you.
I'll bring this around.
There you have it, another Berkshire Hathaway annual meeting in the books. As usual, we learned so much about Berkshire's portfolio, from the trimming of Berkshire's Apple shares to the sale of the company's stake in Paramount, to Buffett's expectations that the corporate cash pile is going to keep getting bigger. And as the afternoon session started, Buffett dropped a bit of news when he was asked who should handle the sprawling Berkshire portfolio when he's no longer in the job.
I would say that if I were on that board and were making the decision, I would probably, knowing Greg, I would just leave. I would leave the capital allocation to Greg, and he understands businesses extremely well. And if you understand businesses, you understand common stocks. I mean, if you really know how business works, you are an investment manager. How much you manage, maybe just your own funds or maybe other people. And if you really are primarily interested in getting assets under management, which is where the money is, you don't really have to understand that sort of thing. But that's not the case with Ted or Todd, obviously. But I think the responsibility ought to be entirely with Greg. The responsibility has been with me.
As we go through any transition, it's important to know that the capital allocation principles that Berkshire lives by today will continue to survive, Warren.
Yeah, there's been some ambiguity around this question of whether, in fact, the CEO, which is known to be Greg Abel, eventually would also oversee the investment portfolio in addition to the operating businesses. And Warren essentially said it would be his choice to have him, in fact, do that, and saying it actually reflects the way they believe that investing in stocks is consistent with deciding what businesses to acquire. But it seems like perhaps his own thinking had evolved. Ultimately, it does become the board's decision. Now, to Paramount, with all the talk about the company and its potential sale to either Skydance or possibly new bidders in Sony and Apollo, Buffett decided to tell the crowd about how and why he sold his stake in the entertainment company.
Oh, incidentally, I should just throw this out there since there's been speculation on it. We've sold. I was 100% responsible for the Paramount decision. I read speculation that one of either Ted or Todd had some involvement in that. No, it was 100% my decision, and we sold it all, and we lost quite a bit of money, and that happens in this business too. But actually owning Paramount made me think even further. I like to think deeper, but I certainly thought harder even about the whole question of what people do with their leisure time and what the governing principles are of running an entertainment business of any sort, whether it's sports or movies or whatever it might be. And I think I'm smarter now than I was a couple years ago, but I also think I'm poorer because I acquired the knowledge in the manner I did. But I just want to be very clear that A, we lost money on Paramount, and B, I did it all by myself, folks.
Well, joining me now to talk more about some of the headlines from today's meeting is Dan Hansen, Senior Portfolio Manager at Neuberger Berman. And Dan, I know you're a veteran of these meetings, a couple dozen of them, I guess. First of all, before we get to those specific items, what's your leading takeaway from the day's Q&A and Warren's comments?
Yeah, Mike, thanks. After 25 of these, I do tend to think, let's settle through what really resonates. For me, there's one quote, and it's Ajit Jain who stole the show with his quote, Tim Cook proved that nobody's irreplaceable.
Mm-hmm. Yeah, and that was interesting. He made a point to interject that about this idea that he himself wouldn't be irreplaceable as head of the insurance businesses. And so what does that say to you as it relates to what we look ahead to for Berkshire Hathaway?
So I think a lot of the message and the objective of the 6 hours was communicating you've got a sound hand in terms of the management and leadership that Greg Abel's going to provide, that he's been providing, his unique operating focus, which is a different approach than Buffett as a capital allocator. And so that message resonated a number of times. Ajit, in having more airtime, conveying the importance of the insurance business. But then additionally, Buffett later commented that Tim Cook made a perfect sequential partner to Jobs. So, and likewise, I think the message being communicated, Greg Abel and the Berkshire enterprise, a perfect sequential partner for Buffett.
And that point that we just hit on there about, Buffett expressing his desire, perhaps, that Abel also oversee the investment side. First of all, is that truly news to you, or do you think that was sort of settling an open question? And what do you think about that in terms of the future of Berkshire as an investment?
I think it was news, not just for me, but even Buffett shared for himself. His thinking had evolved. So shortly after Susie, abruptly passed away, almost 20 years ago now, Buffett announced, hey, I'm going to bring a couple of investors in-house. Lou Simpson had retired, and so Ted and Todd were brought in the fold. But I think that over time, his view, and then he shared with us, has evolved in terms of passing the baton. So I thought it was a quite forceful and notable message around the buck's going to stop with Greg Abel in terms of capital allocation. And let me actually square that to some other comments over the course of today's meeting and a broader view on Buffett. He believes in singular leadership. He certainly believes in sounding board, getting advice, having a board, but he does believe in singular leadership. And a few things that I would pull together in terms of the message around his feeling confidence about Greg providing that leadership, pointing to the analogies of the 08-09 credit crisis environment. Other market players had the capital put to work, but they didn't have the ability to make decisions. So clearly Buffett wants Berkshire as an institution to make those decisions. That can't be done by committee. One of Brett Buffett's favorite expressions, like a committee, I look in the mirror and that's the committee.
And are you, as a Berkshire investor, also equally confident about the company under Abel as Buffett is?
Absolutely, and that's what we heard this year, and we got greater showcasing. So this is not the first year to have on the day as Greg Abel and Ajit Jain, but there's more airtime, more substance to it, and increasingly it was, hey, let Ajit lead with the answer to the insurance businesses. Let Greg really take center stage to convey that mastery. We know that that's there, but there was greater and very deliberately greater clarity to that, I think.
What do you make, if anything, really, about the portfolio shuffling? I mean, he went out of his way to express that, Paramount's now out of the portfolio, and it was his decision on both ends of it. And then also the trimming of Apple.
Yeah, so the Paramount, interesting, he took full accountability just to get rid of speculation and the constant sort of inference of what that means for the deputies, Ted and Todd. And that I put in the spirit his humility of, hey, you don't get them all right.
Yeah.
But he's made the expression, look, you don't want to be the cat that never sits on the stove again. As a capital allocator, it's their job to take risk, reasoned risk. But that's my perspective on that. In terms of the Apple sale, that was intriguing, fairly meaningful trim. In the past, when he trimmed, he'd said Charlie had urged him against that in so many words, and that maybe it wasn't the right thing to have trimmed. So that was intriguing, and squared with his comments about, in general, cautiousness about putting capital to work. So so the war chest going to 182 and upwards of 200 billion is in part that you're getting in a good overnight rate with no risk.
Absolutely. Dan, really appreciate your thoughts to break down the meeting. Thank you.
Thank you.
Becky has now made it back and joined me here. So what about the afternoon session?
I missed
what really
the top
stood
of
out
what
to you?
Well, I missed the top of what you guys were talking about, but I think the thing that struck me the most was what he said just in terms of capital allocation.
Yeah, absolutely.
What happens with Greg beyond that Greg as the CEO would be responsible for capital allocation, and that is going to mean purchases and acquisitions, but also directing stock investments too. Obviously, Greg can try and figure out what he would like to do. Greg and the board, I think, was also made clear. Warren says, here's what I would do, but that's going to be up to this board of directors who has known what's going on for a very long time. Warren said it was a shift in his thinking.
Yeah.
And I think that's what was so significant about it, what caught a lot of people's attention. But the idea that, sure, Greg may very well need some help with managing that, but it would be up to Greg and the board to figure out how that's going to work.
Yeah, it's certainly going to be interesting as people speculate around it. He said you don't want to have, 100 managers managing $200 billion or something like that, as if that were the alternative. But just this idea that it may not be, Greg necessarily pulling the trigger on all of these things, name by name, but maybe it will.
Yeah. I mean, it's hard to imagine that you could possibly have the capacity to be operating at such a tight, to be so focused on operations and to be allocating the capital. But it is hard to divorce capital allocation from what the CEO is going to be doing and thinking strategically about where you do bolt-on acquisitions, where you do major acquisitions when possible, when you can pick up the phone and say, okay, I'm answering the call because there's a dislocation in the market, there's an economic crash or a market crash, and here's where we need to be available for them. So maybe it's just a recognition of that fact.
But that's where the ultimate authority and final say is going to sit.
Yeah, and we spoke with Ron Olson, board member, just before the afternoon session started, and his point was that the CEO would need to have some flexibility and that the board recognizes that, the ability to move quickly on some of these things, maybe not the same leeway that Warren Buffett was given as the founder and massive owner in terms of the vote. But that you don't want to change something that has been a super big advantage for Berkshire Hathaway over the years.
And I was also mentioning earlier that it's just very consistent with their general approach to say, okay, we have $182 billion in cash right now. If we look at opportunities to deploy it, they're agnostic perhaps as to whether it would be a full company that they would buy, that you would actually allocate it to a whole business, or a part of a business in the form of publicly traded shares. So, I guess there's some coherence there to that idea that you want to have the same set of eyes and the same decision maker.
Yeah, I mean, it would be weird to silo it off. But it's also a really big job. And part of what he talked about, Buffett in the afternoon, is this idea that they are constantly going to be looking to get better and better, that you're satisfied but not... or that you're pleased but not satisfied, I think is the wording for it, right? Just this idea that you're going to keep getting better on some of these things. It's hard to do that and be a better operational manager if then you are then turning around and trying to figure out what to do with $200 billion.
Exactly.
So you might need a few other brains around to manage that.
Sure.
Yeah.
Of course, very amusing that he finished by saying, I hope you're here next year and I hope I am too. So it's not as if this is, it's necessarily imminent, but we'll see. Yeah.
The other big thing that stuck away, that kind of stuck with me as a takeaway, was trying to get him to comment more on market valuations. It used to be pretty easy to get him to comment on the economy, get him to comment on where he thinks market valuations are. He intentionally did not answer, even when pushed sort of directly on some of these issues.
With his own words from the past served up to him, saying, I don't really remember 1999 very well.
Okay.
But you're right. That exactly was the impression. He just doesn't want to be seen as having, an actual urge to talk down the market or to declare that it's unattractive.
Right. Which I guess is a good thing, because his words do have weight.
And even on the Treasury market question that you kind of finished up with there, he said, well, the real problem is the deficit, not the quantity of Treasuries.
Right. It's true. I had a pile of debt to deficit questions. That was the most pointed. A lot of them were pretty long. And I don't think you want to get into a seriously long conversation or seriously long wind up in a question about the U.S. debt or deficit. My hope was that the Treasury question would spur him to talk about that directly. But there were several questions that came in about this. The debt levels are much higher than he has advocated for in the past. Does he have concern? At the same time, Berkshire's a massive purchaser of U.S. Treasury bonds.
Exactly. And as he said, there's really no viable alternative. And, he didn't say it, but, the U.S. owes most of it to ourselves. In a sense. And so it's a relatively privileged spot to occupy if you're going to have $30 trillion in debt and climbing. So.
Obviously, the official meeting part's going to take place in a little bit of the actual shareholders meeting where they vote on a few things. In the meantime, you've got shareholders who have come back out. And I know they gave out more passes than ever before. They got more requests. More than 127,000 people requested a pass this year. That's up. Not that all of those people will use them, because you can use your shareholder pass to go get discounts at Nebraska Furniture Mart and other things. But it's up 10% from last year. And I just think, looking around on the floor, this is the most crowded I've ever seen.
No doubt.
I've been here 19
more crowded
years.
than last year.
And
Certainly was more crowded the year before.
I've never seen a crowd this big. They're all back, and they are milling around, checking things out here on the floor. There's a lot to see here, and it's harder to see when you've got a big group like this. I will say I got to take a tour of a model of a Clayton Homes house right here on the convention center floor yesterday. Clayton's new Encore collection focuses on attainable luxury as home affordability, is what they say. It's staying at a record low while mortgage prices stay high. And here's what CEO Jay Clayton told me yesterday.
Well, the affordable housing crisis in the country, this is a big part of that solution. So this house, 1,860 square feet at only $236,000, $127 a foot, and the utility costs are only $155 a month on average. So the zero energy ready is saving them about $90 a month. So it's the zoning people and everybody are waking up that this is an important part of that solution.
Yeah. There's opposition, though, every place, obviously, because they don't like the fact that you now can build these kind of houses. It is really, it's fascinating.
Yeah, and so now we call this luxury attainable.
Yeah.
So this home has every high-end feature you can imagine a traditional site-built home: tiles, backsplash, showers, quartz countertops. So I can't wait to show it to you, and you'll be amazed that you can get that. You know, in Omaha, the average site-built home's $443,000. This, including land set up on your land, would be less than $300,000.
Oh, wow! I've got the $300,000. I just haven't got. I'm ready to buy, but and Austin's ready to buy, but I'm not sure that the neighbors would be great if I would turn out my present house. But just the transformation in the industry in the 21 years,
it's been amazing.
It's been astounding.
All right, right now it's time to bring in Morningstar's Gregory Warren to react to everything that we've heard here today. Gregory's been covering this for a very long time, has asked questions on stage, follows Berkshire intensely closely. Gregory, there were a lot of things on your list that you wanted to hear today. What did you think of some of those questions that were asked, and how you feel about the company afterwards?
Yeah, I came back a little bit better, with some of the answers that were coming. I mean, in particular, the wildfire issue. That was kind of a spook earlier this week when there was this announcement of $30 billion in liability as opposed to $8 billion that they were forecasting. Yeah. So it was nice to sort of hear them, talk through and say it's a long-term process. We're going to have to work it through, figure it out. But it's still, the issue remains for Berkshire and all the utilities is how much indemnity are they being given for situations like this? And, if it's a situation where it could bankrupt a utility, doesn't it make more sense for the state and the utilities to work together to solve the problem as opposed to having that happen? So I was happy about that. And then just looking at earnings, as I was doing that while we were going through the meeting, Geico was really good. Good earned premium growth, fantastic profitability. Combined ratio was really, really good. Interesting for Majid that, it's going to be the end of 2025 before they have their systems problems. You remember last year he said, we got 500 different legacy systems, operating basically in 50 states. Yeah, right. So it was kind of interesting from that perspective. But, the way I looked at it, last year was as long as they pursue profitable growth, which means lower in premium growth, make sure it's profitable.
Don't worry about losing subs along the way.
Yeah, we don't worry about it. Yeah, and get to the point where you've got the telematics in place and you can start doing a better job. Because ideally, they should be in a really good position, much like Progressive. If you have better data, you can make better underwriting, decisions, and that should help them in the long run.
On the wildfires question, I mean, I was surprised to hear them call Utah the gold standard for what should be happening. I thought it was a worse scenario there than it was. I thought they were pretty rational in terms of laying out, look, you can turn out the electricity. We can turn off the electricity if you want us to. We'll do that, but we haven't in the past because we were trying to keep the hospitals up and running. If that's your call, fine, tell us on these things. It was more rational than I had realized.
Well, I think the thing to remember too is each each of these utilities is regulated on a state-by-state basis.
Right.
The key thing for any utility is to make sure you're in a good relationship with your regulators. So the last thing you want to do is be, pissing them off and starting a fight with them.
They were pretty tough about California and Oregon. They pulled
well,
that's
because they've been really sort of detrimental to them on the other side. I mean, the whole P&G situation, when that went down, that was a disaster, and that was really the wrong way for a state to handle a situation. And I think the other thing too is we've talked to our utilities guys this past couple weeks, and it's like everybody knows what the right solution is for California and Oregon, and that's putting everything underground. The problem is it's so expensive. Yeah. And it can't just be the utilities themselves footing the bill for that. The states have to be partners in that, and they have to come up with that contribution and explain to their people that we're going to have to tax you in order to sort of do this, because it's and again, it all trickles down. I mean, because of the wildfire situation, you have terrible insurance rates, or you have insurers that are walking away from the state.
Sure.
And it becomes a cost of living issue for so many people that it's something needs to be done. And we're sort of at that point now where the decisions have to be made.
Gregory, thanks for joining us today. Great to see you.
Thanks for having me.
All right, this was the first year where Warren Buffett was missing his longtime partner, Charlie Munger. While Warren said he clearly missed Charlie, throughout the day, Warren delivered plenty of memorable moments on his own.
AI has potential for good things, too. But I don't know how based on the one I saw recently, I practically would send money to myself over in some crazy country. We missed a lot of things, and what we really regretted was missing something that turned out to be very big. We never worried about missing something that we didn't understand. Oh, incidentally, I should just throw this out there since there's been speculation on it. We've sold. I was 100% responsible for the Paramount decision. I read speculation that one of either Ted or Todd had some involvement in that. No, it was 100% my decision, and we sold it all, and we lost quite a bit of money. I think I'm smarter now than I was a couple years ago, but I also think I'm poorer because I acquired the knowledge in the manner I did. But I just want to be very clear that A, we lost money on Paramount, and B, I did it all by myself, folks. So the real question I want to know from Carol, and I think she should maybe tell us, is that would she have dated Ty Cobb if she not? I mean, I know she wouldn't have dated Ty Cobb if his batting average had been 300 or something like that. Unless something really extraordinary happens. We will own Apple and American Express and Coca-Cola when Greg takes over this place. We'll see how the next management plays the game out at Berkshire, and fortunately you don't have too long to wait on that. Generally, I feel fine, but I know a little bit about actuarial tables, and I just. Well, I would say this, that I shouldn't be taking on any four-year employment contracts like several people are doing in this world at an age where you can't be quite that sure where you're going to be in 4 years. In terms of managing money, there wasn't anybody better in the world to talk to for many, many decades than Charlie. And that doesn't mean I didn't talk to other people. But if I didn't think I could do it myself, I wouldn't have done it. I mean, to some extent, I talk to myself on investments. And I simply cannot think of a conversation I ever had with Charlie that in the least he misled me or shaped it his way or anything of the sort. So when you get that in your life, you cherish those people and you sort of forget about the rest. Well, I would say that if they're not financially well off, if you're being kind, you're doing something that most of the rich people don't do even when they give away money. But that's not a question of whether you're rich or poor. And I would say if you're lucky in life, make sure a bunch of other people are lucky too.
Yeah, I have to say, Mike, this meeting was really poignant and really on point with a lot of news issues of the day, too, though. So,
no doubt about it.
yeah.
Very, very reflective, but also really gone out of his way to sort of set the scene and reassure everybody that there's a plan in place. You can be comfortable with how this place is going to operate for a long time to come.
Yeah. Again, the level of excitement didn't die down at all this year. It's packed floors. I'm still looking out across tons and tons of people throughout the entire way. But this has been a unique and memorable Berkshire Hathaway annual shareholders meeting, and I think you're right. Warren said it best himself. Wants to see everybody back here and wants to be here himself.
Absolutely. Well, if you want even more Buffett delivered directly to your inbox, sign up for the Buffett Watch newsletter at buffettnewsletter.com.
That concludes our coverage from Omaha at the Berkshire Hathaway annual meeting. Thank you, everybody, for joining us. Charlie Munger, Berkshire Hathaway's vice chairman, Warren Buffett's best friend, confidant, and business partner for 6.5 decades. But Munger was also a giant in his own right, a scold of corporate excess and greed who preached to a large flock of devout followers about how to get along in investing and in life. A Renaissance man, Munger modeled himself after none other than Benjamin Franklin. He studied mathematics, physics, meteorology, and engineering, all before attending Harvard Law School. He trained himself in subjects as diverse as psychology and architecture. Munger passed away at the age of 99, just 1 month shy of his 100th birthday, and 2 weeks after our last interview with him. Tonight, we bring you a look back at the wit and wisdom of Charlie Munger.
Certainly a peculiar example of one life. It's interesting that a man who started out to be a lawyer ended up with an identity that's more like a guru's than a lawyer's.
I called you a lawyer once, and I think that was the most irritated you've ever been with me, because that was how you started things, but you really have studied every field out there and tried to to take things from different studies and different models in life. Did you go about doing that intentionally?
Of course. I could see the power of it.
When did you figure it out?
Well, it came naturally to me. And I was what I would call naturally arrogant. And it wasn't that good a mind. You know, I was in the top 1%, but no prodigy. So I never would have succeeded in a field that required a mind to be that of a prodigy. But it was a much better mind than ordinary people had. And I recognized that quite early, and I just played the hand I was dealt in order to get as much advantage as I could.
When did you recognize that? Were you a child
Very young.
Yeah.
When I was taking courses in grade school, I was often revising the textbook and the course in my head to make it more correct because I realized the professor was doing it wrong.
What kind of things would you recognize that they were doing wrong?
They had some crazy idea. For instance, my Latin teacher was a maladjusted woman who was a devout follower of Sigmund Freud. And I recognized that Sigmund Freud was a horse's ass when I still first read him when I was in high school. And, of course, it was an odd little boy whose Latin teacher is teaching him Freud. But she was peculiar, and so was I. And, of course, when I bought the complete writings of Sigmund Freud from the American Library. It was one big book, and I went through it very laboriously, and I realized he was a goddamn lunatic. And so I decided I wasn't going to learn that from my Latin teacher. I had some very unusual teachers. The best teacher I had in my life was Lon Fuller, but he was the best contracts teacher in any law school. And contracts is the best subject in every law school. At least I think it is, because it integrates so beautifully with the new doctrine of economics that came along with Adam Smith and all those people.
You had this idea of mental models before you got to him, though.
Yes, and I just naturally came to it. But it was very much a Lon Fuller-esque thing. I was just awestruck by Lon Fuller. I have never been awestruck by any other teacher in my whole life, including some gifted mathematicians and physicists who did some remarkable things. But Fuller really he really changed my life. He almost made me a law professor. I considered being a law professor. But then I knew I'd be pretty good at it.
Let's talk about Benjamin Franklin.
Yeah.
He's one of the framers of our nation. He very famously gave out
And he was a prodigy.
And he was a prodigy, and he trained himself in lots of different disciplines.
Well, and he self-trained himself with like 2 years of grade school education. This is a very remarkable thing. And when he found late in life that he needed something like algebra, he went back and pulled down the textbook and taught himself algebra.
How old were you?
He was a very much a self-educated man. And that was a very much an interesting story for that reason. How could a man who taught himself everything, how could a man like that go into so many different fields and be the top guy in the whole country? And weren't we lucky to have him?
Yes.
Yeah.
And that's when you started modeling yourself after some of the
I
things
don't know when I started modeling myself after Franklin, but I certainly tried to model myself a little. I like the mixture of financial life and regular life.
Mm-hmm. You started out in college at the University of Michigan.
Yes.
You were young when you went there because you had skipped some time in grade school, and you went for mathematics. Why'd you choose mathematics?
Because I could get an A in it without doing any work. That's why I took mathematics.
You did that for a couple of years.
Yes.
And then World War II interrupted
Yes.
things. You were 17 still when
Then
Pearl
I
Harbor
decided
happened.
that geology was not the proper science to handle any war. And that obviously I had to start with physics. So I took physics.
And then you focused on...
No, I didn't have to take it very much, because as soon as I'd mastered the first part of physics, I actually entered the Air Corps as a private.
Right.
And marched around in some field in the middle of winter and slept in a tent.
So, Charlie, you were born on the first day of 1924. You have seen a century of history. And I wonder, do you ever stop?
Not only that, I lived in the aftermath of a previous century of history. In fact, you could argue that about 90% of the progress of man has happened in civilization has occurred in the last 2 centuries. And that I lived in the immediate aftermath of one. In that century, we figured out so very, very much that was quite important as a start. If you stop to think about the technical revolution, it happened in that century. That's when they opened all these coal mines and created all these steam engines. And of course, that's what brought the economic system up. So man had enough leisure, had enough time to think when he wasn't just getting enough food to eat. So it was an amazing time to be born. And to be born in the place in that century where all the growth was going to occur.
And then you come along, and 1924...
I'm immediate after that. My father grew up in a world where if you wanted to go around Lincoln, Nebraska, he had to use a horse and buggy. There was no car. There was no broadcasting. It was a very different world.
And what's happened over the last 100 years has been pretty remarkable, too.
Yes, then the 100 years I've lived has been even more remarkable. That's pretty much all of modern biology, modern medicine, and modern industrial civilization, modern chemistry. Just imagine what the world would be like. We had photographs for 100 years before we had modern chemistry. And But no, it was done by a guy who was a natural, very good chemist. And he created a mighty company, a great growth stock and so forth. And it finally wiped out the shareholders in bankruptcy.
Eastman Kodak.
Yes, Eastman Kodak, which is an amazing story that could happen. And of course, it helped me because if somebody is brilliant as old Eastman, and somebody who hired as many brilliant people as old Eastman did, could take the company into bankruptcy, I figured that lesser people could easily take big companies into bankruptcy eventually, in spite of their best efforts.
What's the lesson you took out?
Well, it was going to be very difficult to be excellent enough at anything to make any money. That's the lesson I took out of it.
Part of the advice that you give people in life is pretty basic stuff, but if you follow it, it's really excellent advice. I think your first one is have low expectations. The second one is have a good sense of humor. And the third one is surround yourself with love of friends and family, obviously.
Yeah, sure.
I have a hard time thinking of a time when you set your expectations low, though.
Yeah, well, I did.
How so?
Well, let me give you an example. Here I am, little boy growing up in Omaha, and my father, one of my father's best friends, is living 2 blocks away, and he has 2 sons, and I'm right in the middle of the age of his 2 sons. And Eddie Davis Jr. is sort of a mechanical genius. He can take anything apart quickly and put it right together and perfectly. And he also reads books all the time, and that's probably all he ever does is sit around reading books. He's a very bookish little genius with vast mechanical ability. And Eddie Davis Sr., his father, was the son of the leading mathematics professor at the University of Nebraska. And he didn't have any money. In those days, he had a huge family. He could do anything. He saw things in 3 dimensions. And it was quite obvious that anything that required mechanical ability, I would not be as good as the 2 Davises. You know, I just, no amount of effort or work was ever going to do it, make me into a fly caster like Dr. Davis was or anything else. I just didn't have that kind of ability. And so I decided to stay the hell out of businesses where I would compete with people like Eddie Davis Jr. and Eddie Davis Sr. in their strong suit.
Knowing your competencies.
Knowing your circle of competency, right? Yeah. And that kept me away from those businesses, totally. But I'm not all that pleased. I could have done a lot better if I'd been a little smarter, a little quicker.
What are you talking about? You've had success in everything you've done in life. What would you like to do differently?
I might have had multiple trillions instead of multiple billions.
Do you sit around thinking about this? What would you have done differently?
Yes, I do think about it. Yes, I think a lot about what I nearly missed by being just not quite smart enough or hardworking enough.
Coming up.
Avoid crazy at all costs. Crazy is way more common than you think.
Invest with an advantage.
I mean, that's a lot of your life. A lot of your life and advice is
avoiding traps.
Invert, and try and figure out where you don't want to be.
Yes, and then avoid it. Yes, of course. That's what everybody's life is with any sense. All the people I know, and my intimate friends now, they never would have become alcoholics. It was too dangerous. They don't get near it if it takes that many fine people into deep trouble. And I noticed as I got older and older that all the people that had very early heart trouble, the males that had very early heart trouble, had one thing in common. They all smoked a lot of cigarettes. So I could see that coming fairly early. And it's rather interesting. I tried to learn to smoke so I could be a cool kid like the other kids in high school. I tried to ruin my life, but it nauseated me. And so I said, the hell with this. People have lured me into a goddamn thing. You gotta get nauseated by learning to do it. And I said, I'm not interested enough in going through a lot of nausea that I want to smoke, so I just didn't smoke.
Now, you did drink from time to time, right?
Yeah, sure, but I didn't. Again, I was And I even drank to excess a few times. But I was always, there were enough alcoholics and near alcoholics in my own family to make me worry about liquor. And so I was always very cautious about drinking liquor. Now, I did occasionally get drunk and throw up. That gave me the nausea, which enabled me to give up liquor.
Everybody wants to know what's the secret. What is the secret for you? What did you conscientiously
I don't
go
know the secret. I avoided the standard ways of failing because my game in life was always to avoid all standard ways of failing. You teach me the wrong way to play poker and I will avoid it. You teach me the wrong way to do something else, I will avoid it. And of course I have avoided a lot because I'm so cautious.
But you do things you like you'll eat peanut brittle or
yes, doesn't matter that much.
Okay.
I drink Diet Coke.
Yeah.
I'm sure Diet Coke shortens my life a little. But I don't give a damn if the last week of lying there unconscious goes away. It's only the good part of life I want anyway. And Diet Coke may be helping me skip who knows, it's helping me skip the last month, not the first month.
If other people want to know what the best way to live is, you would just tell them, avoid the crazy things, avoid the things that take you down.
Yes. Avoid crazy at all costs. Crazy is way more common than you think. It's easy to slip into crazy. Just avoid it, avoid it, avoid it.
I think another thing you've said is whatever you are, wealth and age will make you more so.
Yeah, sure.
Up next.
I did not anticipate when Warren and I were starting with our little piddly start that we'd ever get to 100 billion, much less several hundred billion.
Invest with an advantage with CNBC Pro from Omaha to Wall Street.
Exclusive access to help you identify
your marbles, but agates were the most valuable marble. And I never wanted to lose my good, valuable collection. You know, some guy was more coordinated than I was at shooting marbles. So I would never play for stakes unless I could play better than the other boy.
That's kind of been a habit you've made throughout life. You don't play poker with someone you're going to lose with.
Exactly.
Right.
I didn't always arrange the circumstances. I just fell into them very frequently. But I got to play with competitors who were dumbcoffs.
People who weren't assessing the odds quite the same way?
No. They weren't assessing the odds the way it was easy to assess the odds. If you learned, you just paid attention when the teacher was teaching you permutations and combinations.
A lot of what you do, though, also is picking your shots. I mean, I think you call it sit on your ass investing.
Yeah,
where you wait for the big fat pitches to come in. You don't do a lot over time.
That's correct.
So you think it's harder to make money now?
Well, that's a very interesting question, and it's a very important question. And of course it's harder. It's so much harder you can't believe it. The people that have found it harder are the people that made Warren so rich. Ben Graham and his colleague Dodd in a damned adjunct course at Columbia. What Ben Graham did that was so interesting is that he taught that you should find a few good things and stay with them for a very long time. But a long time to him was a few years. It wasn't a few decades. And he did that for like 40 or 50 years in a little investment partnership with incentives and so on. And his investors, who are by and large not very rich, did very well with him. After he got his share, they got a good cut that was higher than what other people got after fees. So he delivered a valuable product. It could be a lousy business, but if they were cheap enough, they're still all right if they had enough assets per share. Right. So you're getting at least twice as many assets as you were paying for. Yeah. And he just floated around for the best available stuff among companies, good and bad.
Yeah.
That was his system. And he had worked for 50 years. His clients had good returns. Well, after he became so famous, partly with the help of Warren Buffett and Warren Buffett's success, everybody tried to do the same thing. And of course, as everybody crowded in, trying to be a little Ben Graham, it got more and more competitive. And that's what's happened now. And the low-hanging fruit that Ben Graham had a lot of because of the Great Depression has gone away. And if you just try and float from one undervalued bad business into another and pay all the costs and so forth, it just doesn't work well enough for the people that actually put up the money to be worth bothering with. That's the way it works now. But in Graham's time, it was the best way there was.
Well, your upgrade on that was to just look for good businesses.
I saw immediately that Graham was wrong.
Right, and you look for...
The real money was in the really great companies.
Right.
Which carried you up and up and up and up and up. Just so many hundreds of billions in Berkshire. I did not anticipate when Warren and I were starting with our little piddly start that we'd ever get to 100 billion, much less several hundred billion. It was an amazing occurrence.
What happened that you didn't anticipate? What led to that success?
Well, we got a little less crazy than most people, and a little less stupid than most people, and that really helped us. Then in addition, we were given as much longer time to run than most people because something kept us alive into our 90s. And it gave us a long track from our little piddling start all the way to the 90s. Those are the two things that really happened. And of course, we wised up over time. We got into better and better companies, and we understood more and more of the bad things that could happen to you and how easy they could creep in. And we avoided them even more assiduously when we were old than we did when we were young. And it all worked.
I think back in 2015, for the 50th anniversary of Berkshire, you wrote in the shareholders letter, you had a $60 billion pile of cash at that point. You thought that that pile of cash would decline over time because you'd be able to buy more and more things. Now you've got almost $160 billion in cash. Is there an opportunity for a really big purchase with that? And do you think you'll see one?
Well, of course, there's an opportunity for a purchase a lot bigger that people can make who don't have 160. We have $160 billion in cash, plus a great credit rating we deserve. And who in the hell has that? Not very many. But what it's going to be, I can't tell you, because it doesn't matter how good it is. We're of a size now, or too small just doesn't move the needle very much. So we need something big to come along and use up all our cash and some borrowing. But who's more likely to find something than a guy who has $160 billion in cash, plus a long history of buying bargains? I don't think it's hopeless. It may have to be done by some different people. You know that the next time we may not be able just to squeeze a little more lemon juice out of the old lemons. We may be able to, we may have to squeeze some new lemons, meaning new people may have to make the decisions. But who can make them better than somebody that has watched the early process all through all those years and seen how well it works, and who starts with a little legacy of $160 billion of cash?
So you're talking about Greg Abel, Ajit Jain.
Yes,
Ted and Todd.
Or somebody not yet identified. Yeah. The main trick that Berkshire shows is the power of what I call the Wooden effect. And Wooden was the most famous basketball coach of the whole era. And you figure out what the hell he really did, which of course somebody like Warren and me, we just automatically do it. He concentrated about 90% of the playing time in 7 players, and everybody else was just a sparring partner for the people. And that turned out a great system for winning at basketball, because you identified your best player and concentrated so much of the playing time on your best player, and more playing creates better. So he concentrated all his playing time on his best players. Simple idea. That's what Berkshire did.
You talked about some of the joy you found with some of the investments Berkshire's made along the way. I think Washington Post was a great one.
Who doesn't like to happily enjoy extreme success accumulated with people who are extremely admirable? That's what Warren and I have gotten to do. Well, of course, that's a lot of fun. What was interesting about Berkshire's history is what turned the first $300 million of Berkshire net worth into the first $3 billion of Berkshire net worth.
What was it?
And well, it was blue chip, stamps, and See's Candy, and the Buffalo News newspaper, and the early insurance operations under Ajit Jain when he came to us. And so it just, everything worked at once. And we made these unholy profits out of these fiddling businesses that weren't that good. And it was a very remarkable thing. And there was some luck involved.
Warren has said that his worst trade ever was buying Berkshire Hathaway itself, the mills.
Yeah, sure.
What was your worst trade?
Well, I think my worst trade was buying a block for the Munger family in Alibaba, which is a pretty good company, but I think it got overhyped. And Jack Ma made mistakes in dealing with the Chinese government. I had some everybody has some bad ones.
Yeah.
You have an off day. The greatest tennis player goes out there someday to the center court and has a bad day. It happens.
I think people learn more from their mistakes sometimes than
and their bad days even.
Yeah.
Yes.
Yeah.
But what really is knowing you can have a very bad day. Do not live your life in such a fashion that a bad day can kill you.
Mm-hmm. Which means what when it comes to investing? Making sure you don't use leverage?
Well, they aim for the fences. It's like a hitter at baseball who tries to hit a home run on every pitch. The great home hitters do not remotely swing at every pitch. They wait for one that they can really handle. And that's what great stock pickers do too.
Still ahead.
You're only going to get 3 or 4 of these invitations to the pie counter. And when you get your invitation, for God's sakes, don't take a small helping.
Invest with an advantage with CNBC Pro.
Because you have duly noted the problems with bureaucracies, whether it be a big company, whether it be the government.
Have I ever?
Right. So how would you fix some of the bloated bureaucracies out there? Let's start with the federal government.
That comes in my too hard pile. I can't tell you how to do that. That would be really hard because you got the problem of A, figuring it out, and B, getting it done. And to solve both those problems are really, it's like picking the high pick on Everest and saying, I'll waltz up there in a day, you know. You aren't going to waltz up there. It takes several days to do.
There was a presidential candidate who recently said that his solution for that would just be to fire everybody in the federal government. His Social Security number ends with an odd number. Does that sound like a good way to fix it?
No. It does not. It's too arbitrary. It may be that you need some bigger fix than that. And it may be you're never going to get it, too. It may be that it's just something like old age that we're never going to get rid of.
But you are still a believer in the need for a government.
Of course. If you get right down to it, what I am is a lover of the progress of civilization. That turns me on. Oddly enough, the man whose name I bear, my father's father and my father's mother, both thought exactly the same way. And the great moral book, they took me to church. But when they really wanted to teach me something which turned them on, it was the legend of Robinson Crusoe, created by Daniel Defoe. And of course, it was good for me. And of course, I never got over it. I'm still following Robinson Crusoe's method of going at life. That's what I did. I imitated Robinson Crusoe. Then I was lucky with my ancestors on the other side of the family. I am very good at learning things from dead people. That's what everybody should learn. And so I had one grandfather on the other side whose life never overlapped mine. But Grandfather Ingham just talked endlessly about the end of days. Now he's surmounted all these hardships. And he says it looks pretty easy looking back at retrospect, but it was damn hard, I want you to know. And He said, in reviewing my life, what you grandchildren have to realize, it was his version of Robinson Crusoe. He taught every grandchild, if they give you a real opportunity, the world's not going to do it very often. And you're only going to get 3 or 4 of these invitations to the pie counter. And when you get your invitation, for God's sakes, don't take a small helping. he basically said, lever up when you're sure you're right. And of course, that's good advice. But be sure you're right is what makes it hard. How can you be sure you're right?
Yeah.
Well, but you can't, that's the point. You can't do it very often. Just a few times in a lifetime. Even if you're a Grandpa Ingham or a Warren Buffett, you only get a few trips to the pie counter. If you take out of Warren Buffett's life the 10 most important trips to the pie counter, his whole record would look like dung. We knew enough to take a good helping when we were over the trip to the pie counter. Now, we did take way smaller a helping than we could have easily handled. Berkshire could easily be worth twice what it is now, and the extra risk we would have taken would have been practically nothing. All we had to do was use a little more leverage that was easily available.
In hindsight, you're glad you didn't? Just from the potential risk?
It's an interesting example. The reason we didn't is the idea of disappointing a lot of people who had trusted us when we were young. Under a thing that left us, if we lost 3/4 of our money, we were still very rich.
Right.
That wasn't true of every shareholder. Losing 3/4 of the money would have been a big letdown. So we were very cautious in dealing with our shareholders' money. If Warren and I had owned Berkshire without any shareholders that we knew, we would have made more. We would have used more leverage.
Charlie, Warren Buffett has said that he could fix the budget deficit problem in Washington by simply saying that any member of Congress couldn't be eligible for re-election if the national deficit was more than 3% of the GDP.
Well, yes, that kind of thing has been done in some places that have gotten enough trouble. And it has worked. It isn't that it can't physically be done. He's certainly right about that. It can be done. Whether it will be done, neither Warren Buffett or I can tell you.
But is that the proper situation? Is just setting up the right incentives?
Well, we may come to a place where we simply have to, where we mismanage to the place where it's obviously we have to go back to something that's more like Adam Smith. And just take the inequality instead of the poverty. I like inequality a lot better than I like poverty.
I mean, is this modern monetary theory that's gotten out of control at this point, do you worry?
Of course, modern monetary theory was that a level of indebtedness, which in the past would have happened only during a war, can now be routinely created to avoid any kind of unpleasantness from some families getting squeezed by hardship at the very bottom of the economic order. I'm not sure the whole damn system works when some families aren't being squeezed at the bottom of the economic order. That may be our path to civilization, and maybe the only one we've got. In that case, we just have to be financially responsible whether it feels good or not, even whether it works well or not on a temporary basis. And maybe we just have to do it.
In thinking about age, a lot of companies are getting rid of mandatory retirement ages. Boards are getting rid of a lot of the mandatory retirements. But there are questions right now about whether Joe Biden or Donald Trump are too old to be president at 81 and 77 years old.
Well, it may be true that everyone in America is too old to be president. It may be just too hard a job the way things have worked out. Maybe it's just a hand too tough to play. Maybe you're not going to be allowed to play it out. We don't know.
You mean the age factor, or?
No, I'm talking about the atomic war
The
factor.
atomic war, just the idea of being president at all.
Yeah. If you've got a big ruin of smoking country, it's not much fun being president.
So that is something that really, you can say you set it aside and it's not worth worrying about, but.
I don't spend much time on it because I can't fix it.
Right.
It goes into my too hard pile. Even if I had all the power, I couldn't fix it.
Up next.
If you soldier through, you can get through almost anything. And it's your only option.
You are what Shark Tank is all about. You are the American dream. You were...
More than half the Munger money has already been passed to the descendants. So I've made exactly the opposite. It was a smaller amount of money, but I made exactly the opposite decision for the majority of our money. The majority of his money he gave away. And now he didn't exactly give it away. If it goes to Buffett Foundations to go on for another 100 years.
Is there anything left on your bucket list? Anything you'd like to do?
Well, that's an interesting question. I am so old and weak compared to what I was when I was 96 that I no longer want to catch a 200-pound tuna. It's just too goddamn much work. To get it in takes too much physical strength. So I don't know why I would have paid any amount to catch a 200-pound tuna when I was younger and never caught one. And now if given the opportunity, I would just decline going. I won't even go out after them. There are things you give up with time.
You're pretty active. You've got a busy social schedule. You're on Zoom. You have breakfasts and lunch.
Well, I like it that way.
Yeah.
That's my idea of a proper old age for me. And I didn't plan it. It just happened. And when it happened, I welcomed it. I am very good at recognizing unfair advantages. And I got unfair advantages in old age the way I got unfair advantages in non-old age. And when they came, I just grabbed them. Boom, boom, boom. The one grab I never made was for a third wife. Too late.
Why?
It's a little too late. There are people for whom it's a necessity. They're so much more comfortable in marriage than they are outside it, that they really need it to be human. It's just the way they're put together.
Your partnership with Nancy, your second wife.
Yes, it was a 52-year-old marriage.
Yeah.
It's a long marriage.
It is.
And she got to live it all the way to 86, which is a long life. Now, there are some tough stretches, but most lives have some tough stretches. And hers came very near the end.
I mean, Charlie, people probably look at you and think you're incredibly wealthy. You've had all these great opportunities and things that have happened in your life, but you've struggled too.
Of course, everybody struggles. The iron rule of life is everybody struggles.
I try and think back of what the toughest moments might have been and how you got through some of those. And I mean,
well, we all know how to get through them. The great philosophers of realism are also the great philosophers of what I call soldiering through. If you soldier through, you can get through almost anything. And it's your only option. You can't bring back the dead, you can't cure the dying child, you can't do all kinds of things. You have to soldier through, and you just, somehow you soldier through. If you have to walk through the streets crying for a few hours a day, it's part of soldiering through. Go ahead and cry away, but you can't quit. You can cry all right, but you can't quit.
you've had time in your life when you've done that?
Sure. I cried all the time when my first child died, but I knew I couldn't change the fate. In those days, the fatality with childhood leukemia was 100%.
That was your son.
That's gone away now. Now the cure rate is way up in the 90s, and it's an amazing development. Think of how much pleasure it's given me to watch the cure rate for leukemia. What mankind did, what mankind civilization did, was soldier through those tough years that took away my cousin Tommy from meningitis, and took away my son Teddy from leukemia. Imagine pretty well fixing that disease for families who came into life later. It's a huge achievement. You can see why I like civilization. To me, civilization is what man has done with the last 2 centuries. And it's been a good thing to watch.
Charlie, Warren Buffett told me that a long, long time ago. You told him he should live his life. He should write his obituary the way he wants it written and then live his life accordingly.
Yeah, sure.
I assume you've done the same thing for yourself.
Well, no, I've written my obituary the way I've lived my life, and if you want to pay attention to it, it's all right with me. And if they want to ignore it, that's okay with me too. I'll be dead, but what difference will it make? It's not a bad idea. Listen, Warren and I both live in the same house for decade after decade after decade. And all our friends get rich and build better, bigger and better houses. And naturally, we both considered bigger and better houses. And I had a huge number of children, so it was justifiable even. And I still decided not to live a life where I looked like the Duke of Westchester or something. I did it on purpose.
Why?
I didn't think it would be good for the children.
That it would spoil them?
Yeah, it's, you have a rich family, you think your duty is to use the wealth to live grandly. That's what everybody's doing with the money. You will learn from the people who are doing it.
Is the plan for your life, the obituary you would write in your 30s, the same you would write today?
Sure. I basically believe in the soldier-on system. Mm-hmm. Lots of hardship will come, and you gotta handle it well by soldiering through. And a few rare opportunities will come. You gotta learn how to recognize them when they come, and not make too minor a trip to the pie counter when the opportunity is available. And those are simple lessons.
Welcome to the Shark Tank, where entrepreneurs seeking an investment will face these sharks. If they hear a great idea, they'll invest their own money or fight each other for a deal. This is Shark Tank. First into the tank is an entrepreneur with a revolutionary new bike accessory.